film begins.
Some degree by Bernstein again. Tony Saganaki reiterating underweight 150. His view is they're going to disappoint on margins and volume this year. They're trading at almost 100 times fiscal 24 earnings.
Being up all the stuff down below
look,
here.
I think the Tesla mobility ride sharing, that's questionable because
daily
it didn't
triggers
work for
at
Hertz.
464.11.
Look, you know, 10% of our fleet is Tesla, just like 10% of the car companies. Cars on the road are Tesla. But, you know, I think that this work that Adam Jonas is doing on the true value of.
So yesterday into the close, we were talking about not buying calls, and that you would have dealers, market makers getting neutral into that bell, and that this was a bear or a bull trap, excuse me. And you saw that teeing off just once again on that gray love bar up here. So that's 2 in a row. We got 3 actually, 1 up top, 2 and 3. Should see some acceleration on the downside. There is a bounce, or I shouldn't say acceleration. Q's down here. So this is Q's in the bottom left-hand side of your chart down here. I'm going to expect a bounce on Q's, but then maybe some consolidation down here and try to get underneath at some point today. So just be careful on the Q's on the open this morning for some bounceability. Hang tight 1 second here, boys and girls. There is some more supply down below on Bookmap as well. Right down in here. See that? That's that nice market down there. Tight here. Right down there. If we can get down here and break through on SPX and SPY, SPOOs, and ES to get down here. We also talked yesterday about that bounce on NASDAQ, but not SPY. So I'm a little bit more bearish on SPY or grinding down consolidation than I am on tech. So just be wary on tech of the bounce, but yet some dogging action inside of ES this morning. SPOOs. Hang tight 1 second here. Santa Claus rally is in trouble. Reading the headlines right now by. Hang tight 1 second here. Give me 1 quick second here. And I'm going to take a look at a couple things for you this morning just to get you up to speed for the day. 1 quick second here. Let's check the gamma levels this morning, see if anything has changed. Yeah, nothing that I can see right now has changed. If your bottom left-hand screen, you'll see yesterday we crossed below the gamma flip. And this looks like a positive, or for bears at least, a positive outcome right here. We had a blast down below. You watched your bottom screen, that bottom right hand, or that bottom left hand, or here, let me do the famous Mr. Yen down here. Follow my cursor down here. And you'll see price action. We broke below the gamma flip. That's the gamma flip right there. We traded below it. Have a nice confirmation underneath that gamma flip. So I'd like to see some more action to the downside here on SPX today. Target down below, 4661.45. Sorry for my nose. I got very sick over New Year's, and I've got RSV. So RSV is a weird thing. I don't think I've ever had it since maybe I was a kid. So I guess this stuff like comes in waves. Like first you get the temperature, then you get the like strep throat or some shit, and then it goes to your lungs and you get like lung sick and stuff. So still battling that right now. Let's keep your eye on this daily trigger down below here, and note that the gamma flip currently is sitting at 47.40 this morning, so about 10 ticks off from that 47.50 yesterday. So it has dropped slightly. You got S3 below down here at 467.68, and then the target of 464.11. It would be nice to see this morning on these minutes if we can get it. I'd love to see it down here. Catch that nice bounce off the daily trigger or a break below. Trap in some of these sellers, and then the actual move higher. So I'm going to leave this up like this. If anything changes, we'll switch back to or we'll start looking at that target to the downside. But just keep note of that this morning. If anyone asks inside of the chats, the target or the daily trigger is 4611.
That efforts have been evident in supporting the global economy
on SPY
to
specifically
over the past years and have ensured market stability.
One quick second here. Get some stuff I got to do. Hopefully, if you were a bull yesterday, you heeded my warning yesterday. You did not. You didn't get all bulled up yesterday. Showed you where the sell points were on SPY. That gray love bars. We talked even about that yesterday, about how almost it's exactly to the tick where they step in to sell. Good morning, by the way. Still happy New Year to everybody. I also want you to remember that trading is still light. Don't be all geeked out because we're selling the past couple days. Market gets really back into it this upcoming Monday. Let me see here. One quick second here. Mom and Dad comes back, all the partying going on. Move all that right there. Save. What else we got going on here? Edit that right there. Good morning to all of you out there. Let me see here. What am I doing in the background here? There we go. Okay, we're good on that end. I'm going to read some stuff off to you this morning as well before your day starts here. Give me one quick second here. Remember, if you're a seller, you just one more word of warning to you this morning that if you are a seller, you need to be very tactful. You need your blinders on more than a bull does. A bull is looking for a dip to buy. We are still on an upside trend. So if you're a seller here, right, don't get all crazy town. Number one, do not get crazy town. If you're a seller, you're being tactful here, right? You're selling below the hourly trigger, targeting that daily trigger. If we get underneath the daily trigger and you get some rejection there, we'll start talking about an actual trend reversal. Bulls are still on trend right now. I know it can seem extremely bearish or whatever out there to you on social media. So if you are a seller, you are still very tactful. Buyers are still there to stay on trend. What do I got for you here? Tensions in the Middle East are heating up, but treasuries, the former ultimate safe haven asset, are not getting bought, with 2-year yields up 2 BPS and 10-year yields up 3.6 BPS currently, but are rather sold due to the impact of oil on the inflation premium. SPX dealer Gamma is turning negative, while at the money volatility has shifted higher relative to yesterday. SPX Gamma at a glance this morning. The Gamma flip already went over this. It's at 47.40, so it's down 10 points. The XPX straddle is at $26. The put wall right now sits at 4,600. Negative Gamma is abundant in the zone between 4,600 and 4,750. So be aware of that, okay? So I heard someone talking about 4,700 as a target. There is, with ease, we can trade 4,600. And from a systematic investor standpoint, CTAs continue to be max long in equities and bonds, which skews the risk to the downside. For the Middle East this morning is on top. It is being monitored closely, according to Reuters. 2 explosions caused by terrorist attacks killed more than 70 people and wounded scores at a ceremony in Iran to commemorate top commander Soleimani, who was killed in a 2020 U.S. drone attack. Libya's Shaharara oil field unexpectedly shut down amid mass protests, removing 265K BPD in daily output. Per Libyan Al-Arar, protesters from the local residents of Ubari, southwestern Libya, have shut down the Shahara oil field, one of the largest and most important fields in the oil revenue-reliant country. In a video statement on Tuesday, the protesters said they would not reopen the field until demands and those of the entire region of Fezzan, South Libya, are answered, blaming the National Oil Corp for consequences of the abrupt closure. Shahara oil field, one of Libya's largest production areas, the capacity of about 300,000 barrels per day, has been a frequent target for several political reasons, demands by local protesters. In other news, Israel's Mossad is implicitly hinting at its involvement in the killing of a top Hamas leader in Beirut yesterday. I don't know if any of you guys saw that video of the. Now they're saying, they're not saying exactly how he was killed, but if you saw that video, it was tough to make out if it was a drone strike or a missile strike. It looked like an inside job. It looked like there was a secondary explosion. So some real whoever did that strike, whoever did that that assassination yesterday was quite good at what they do. Yeah, so let's take a look around right now. We'll take a quick look around the market for you guys. Give me just one quick second here. So we'll take a peek here. On the right screener? Yeah, here we go. So get your snipping tools out. You're following along this morning. Get your little snipping tools out here. We're going to take a look at the half-hour chart. This is the one you want to be trading. This is your baseline for the day. One quick second here. So, excuse me. So hourly velo's coming into, we got a higher bottom here. We got we're losing a little bit of velocity down here, but even so, I want you to take a peek here. You want to take into consideration the daily velo as well. And we got this nice daily velo coming down. We'd like to see more come down on the daily. So even if we catch a bounce here, we're still in a downward track. Right, so you can see this hourly velo go positive again, come back down negative again. as we begin to move down in positive velocity to the daily. So no dip buy here yet for bulls. They got nothing so far. You just keep selling this half-hour trigger, right? We talked about this yesterday. This half-hour trigger, selling it. So every time I come up here to this half-hour trigger, just keep selling it. Staircase it down with a target of that 464.11. So I'm going to give you a something here to target. Take a little snapshot of this. Just remember, there's no doom and gloom yet, right? Even if you break down underneath this daily trigger. So let's say we come down here, right? We slam through this daily trigger. It's not good enough for the bears yet. Not good enough. It's a good, nice sell down here, right? But if you are a bear and you want some continuation, you then want you're going to see a bounce, of course, but you're going to want the confirmation for the next leg down, okay? So if you're looking for the next leg down, it's not just blast down here and you're holding short. You should be closing your shorts and waiting for more distribution, signs of distribution, and then another sell signal to the downside. Otherwise, I would expect this downside move to be done. If you're looking for a fundamental change in the movement of SPOOs to the downside, so you want to be rejecting below 464.11 for a target of 442.07. So this is a whole new trade down here, okay? Remember that. We don't trade like we blast down below this daily trigger and then all of a sudden we're, careening down to the depths of hell. All doom and gloom, that kind of stuff. We'll take a look at as well on the Qs, and we'll look at NQ as well. We'll take a quick look at
QQQs. We get US ISM manufacturing,
and then we'll do
PMI
NQ
forecast 47.1
on a 30-minute basis. Same deal down here, right?
With a range of 48.1 to 45.
You got nice
US JOLTS job openings forecast 8
bottoming-ish
1 million
on the half-hour trigger, but you're still losing the daily.
With a range of 9.02.
The idea here is even if you get the bounce up here, right, it's still going to come down a little bit.
US ISM manufacturing prices paid forecast
49.5 this for a
on
minute.
the prior 49 spot.
Now, someone asked this morning on Twitter, do you still think that you get outsized moves on small caps? And I do. And small caps is going to trade a lot like NASDAQ relative to like SPX, okay? So so whereas SPX is a little bit more muted in its moves, it has a little bit more exposure across the market, you always get these violent upside and downside moves on Qs, and I'm going to expect the same on IWM as well. We'll take a look at RUT this morning. So it would not shock or surprise me to see Qs actually go lower than the daily trigger, right? Close some of this stuff out down here. Possibly trade that 388. The one key here is that you want to see that V-shaped recovery. You don't want to see Qs peter out up here at 396, 398 to begin a real roll to the downside. So this portion of this more outsized on Qs than SPX, I would say. So we'll move this over here for you so you can snap this and take a look at it. So no dip. There wouldn't be no dip buy for me here on Qs. You can snap that if you like, but you can see down here. You can see down there, we're like a little bit more bearish on this side than we are over here, right? We're coming up into positive daily velocity. We're now losing daily velocity. So I'm not. I don't believe this holds. This 398.18. I don't think that this holds. So I would like to see that bloodbath to the downside. Woof. But then an immediate reaction down here. Target 386 possibly on Qs because we are on the downside of velocity. If we're proven wrong, we can see the bounce here. If you want to get bullish on Qs again, If you are a bull and you're like, "Ah, Cap, you're wrong. You're out of your mind. There's no way we're going that low." You are looking to regain 403.97. So if you regain 403.97, you see a bounce down here on this daily trigger. Minutes and all that are great. We get above that hourly trigger and we successfully backtest it. Then I'm wrong, and you jump right back in again, right in here somewhere. Okay, so that's what you're looking for currently today, and you don't get bullish until you're up here, right? No dicking around down here, none of that stuff, because we are coming into daily trigger that is not supportive. Not supportive. I'm going to call this a fake ass support right here. So where bulls will be likely trying to buy it, there's a high chance they're going to get trapped and they're going to roll Qs down. Now IWM RTY. Let's take a look here. Outsized moves on RTY, right? Nothing's changed here. I know that people like to say that stuff has changed, but let's take a look at RTY, right? RTY, big outsized moves. So any big outsized moves, they've always had this nice big pullback, big outsized move, pullback. Same thing, right? Giant move, pullback, giant move, pullback. So the key on RTY, though, is this, or on small caps. So we're going to take a look back in time on it really quick, because I want you to pay attention right now to the weekly cross crossing the monthly here, okay? And this is an important thing, because as long as price is above the weekly, and the weekly is making this cross right here, right, starting to happen here, by the end of the week here, okay, by Friday, you're going to get a week cross of the month trigger. And what's important here is that price stays above only this here, okay? And, of course, I'd like to see it regain and head north again for the next leg here. But this is crucial right here for small caps, that you stay above 1875. Okay, it's crucial. Now, why do I say that? We're going to look back in time, and I'm going to show you why here. One quick second here so we can bring this up. Every time this weekly here, I want you to pay attention right here. You see this weekly here, right? You see this weekly, this orange line coming up here. Every time it wants to cross, right, we back check for bullishness of small caps. And if we can't get above, right, we start rejecting lower. We get some real nasty downside here. So let me show you an example, another example here too. Watch that orange and blue line with me here. And the reason I'm saying that is because back in 2020, we did get a cross, and it confirmed a much larger move to the upside. Here, let's go to the daily, make it easy. Same lines or whatever. Give me one quick second. I'm going to show you why I'm talking about this. And it's right here, okay? So see that cross of that weekly cross here? And see the back checks that take place as it's happening? So you see this violent move backwards, bam, retest the cross of that weekly. Now, if that cross is successful, we should get a nice move to the upside. But the back check must be successful. Okay, so on this 30-minute chart here on RTY, right? However doom and gloomish this looks to you, if you get a successful retest of this cross here as this happens into Friday, Monday of next week, you're talking about a move that is insane, right? So if you're a bull, you're just sitting on your hands. That's all you're doing. You're just watching this action here, and you are looking for this to happen. If this happens, you're going to get an outsized move in the month of January, February, and March. So there's a giant catalyst coming up here for small caps this week, from, I would say, Friday, Monday, because you're going to get a closing price here on this weekly, and you're going to see this weekly come up, and then next week start to move higher. You'll see a retest here into the weekend, price retest. If that retest is successful, you should see a massive January through March run on small caps. So this is probably the one I'm paying attention to, or the closest coming into this weekend, into next week at some point. Excuse me here. See if you gotta make sure you guys can see that down there. I think we can flush 46, believe it or not. I think 46 is possible. We got 464.11 down here, so you blast through the daily trigger, right? Now here, I'm going to bring this up for you again, okay? So I think we can hit 4,600. But if you're a bear, I want to tell you something. Okay, I keep saying this. You guys know how these streams go, right? Blast down here. Hold on a second. Let me make it nice and red for you. So you blast down here, right? Ooh, we're blasting down. And in the excitement of everything, you're entering puts here, right? Not up here, right? And then we hit that 460. Let's say wherever that 460 is. And you're extremely bearish. And in reality, it's the place to take the money and run. There's your bear raid, right? Come above here, and then we're off and back to the upside. So be tactful, right? You guys know what happens. I come into the stream, and it's 4 o'clock on a Friday or something, and I'm asking you if you're closing, and you're just fucking holding. You probably entered here, and you're going to hold, and you think you're going to wake up on Monday or something, and it's going to be down here, and in reality, we're way the fuck up here. So have awareness, market awareness of where we are, right, where we're headed, and who you're listening to when they're the most bearish. Okay, so just be aware of that as we staircase down. Be tactful. You want to be, selling from above and closing from below, and not entering. So we just tagged right now. This is that. Remember yesterday we plotted out this small little gap closure, so that one's now gone. We'll get rid of that one. All right, you know where to be selling. You're selling that 30-minute trigger. You're selling that hourly trigger. And here, let me move some of that over. You're tactful. I know I say it, but I have to say it to bulls too, so don't feel bad like I'm yelling at you. I got to say it to bulls at the same fucking time. Bulls do the same stupid shit, so careful who you listen to. Make sure you're following the people that are already short. Make sure you're looking for your sell signals, and then make sure you're wrapping it up when you're supposed to wrap it up. And then you're re-entering if that does happen. So let's look at that one more time, right? So we know we've got negative gamma down to 4,600, right? We know that if we sell down here, if we do, let's say we keep selling down and we staircase down with a capitulation phase, right? You hit that 4,600 down there, and everybody's extremely bearish down there. Doesn't matter if we have more continuation of the downside. The matter would be that you get the bounce here, right? So you get that V-shaped recovery. You're taking your money right here, right? You're like, I'm taking my money. I'm gonna realize all my profit, and then you're waiting for the rejection here to then reposition for more downside, right? 1, 2, right? You reject once, reject a second time, and start heading lower, and you break this previous low right here, just like previous highs, right? And you're Johnny on the spot with more shorts right here, right? So you're tactful the entire way down, right? You're maximizing your gains on the downside and on the upside. Leave that up there for you right now. Yeah, right there for you. All right, good morning, everybody. Hope you're all doing well. Good to see everybody out there. Chase, thanks for dropping some data inside of the chat this morning. What else we got going on out there? Let's see here. Move this, bring this up really quick. Morning, Twitch. How are y'all doing? I got triggers coming out for you guys this week, or not this week. I think they said all the stuff comes out on by the 31st or something like that. We've got a bunch of contracts and shit I got to get signed and agreements signed and all that kind of stuff. You had attorneys yelling at me for wanting to launch early and stuff like that. So you guys are gonna get access here real soon. I got another one down here too. Got this one little guy down here. This little gap down here is still left behind. All right. Morning, everybody. Good morning. Good morning, Manvera. Good morning, Bullshite. Good morning, JT Riva. Oh, dude, bullshit, dude. Seriously, like, that Dallas thing was a fucking scam. I mean, talk about a fucking scam, right? And it's not just the scam. It's like they want Dallas to host. Then, they don't. I'll be honest with you guys. This is the truth, okay? Detroit, for some reason, still markets itself as a shithole. I even read a story from the New York Times that was not correct this week. It's just two things, right? The NFL wants asses in seats. They want money. They want to bring money places. They don't want things going on in Detroit. They don't want to see Detroit hold or host three football games, right, in the playoffs. Some of that is Detroit's fault for how they portray themselves. They want more investment. They want more Fed dollars, that kind of shit. And then also there's a lot of development going on in Detroit right now. So, some people like myself, you want to keep it hush hush as long as possible so you can sell into once Detroit has made that comeback. But it is coming back. It's a kick-ass city. This city has changed. The past 8 years, Detroit has been fucking booming. So I'm with the Kings of the North, right? I'm from Boston. I understand why everybody hates the Patriots now, but the Patriots were in a similar situation to some extent. So I love seeing Detroit. Michigan. What up, Michigan, right? SEC, baby. Not gonna have a championship this year. Georgia. What's going on with my boys Georgia down there? Then you got Bama, right? You got all that heat with Bama. So for this year, at least for football, man, you guys know I go to University of Michigan football games. I got a cool story too. I haven't made this announcement, but my oldest daughter, was accepted into the University of Michigan early. So she is still in high school, and she has cut back on her winter semester heading into spring semester. She is now going to the University of Michigan as well. She has not graduated high school. She's taken she was waiting on some SATs. She's taken 200 level courses at the University of Michigan. My daughter has made me the proudest man in the entire world. They are the number 3 public university in the United States of America. They're a top 25. I think they're now ranked number 23 for research, private and public universities in the United States. They're like Penn State and shit in terms of research. My daughter, baby, she is a Wolverine officially. And she starts school here in the next couple weeks. I am beyond ecstatic for my daughter. And, of course, now what's looking like a national champion, baby. I'm so stoked. So proud of her. There's nothing I can. I have been glowing. I'm going to be like that guy with, like, all the gear and stuff like that. So I am really, really proud of my daughter. I'm going to do a little humble bragging on that. I know you shouldn't humble brag, but dude, I'll tell you what, that girl has been nose to the grinder. And the expectations that my wife specifically has put on her, and her want for discovery. And I can't, we moved to Detroit, man. Like, I took my daughter out of a very wealthy place and was like, we're moving to a place that that you're gonna have to survive. You're gonna have to dodge and weave, right? You have to like. I really wanted her to uh, have this experience of Detroit and have a more than an experience, but more than an experience too. Make lifelong friends, understand what Detroit's all about, what happened in Detroit, what happened, a microcosm of what happens in America, but at the same time, uh, to work her ass off while she's here. Truly, right? Have that experience, right? And she's done it, and she makes me so proud. She she has she has some experience that a lot of kids don't get in quiet suburbs or rural area somewhere, and I'm hoping that that carries over into empathy in life and real true empathy in life, and be able to identify carry that on into her career and her being a human and being a better person for the next generation, right? Being a beacon for that next generation, that kind of stuff. And my daughter has uh, blown my mind. Telling you what. Telling you what. Dude, big balls, dude. We'll talk about it at some point more in depth, but she's made me so proud. She really has, and she's the sweetest person I've ever met. Um, I don't know what else to say about that. I love her. I love her. I hope that she. Well, it's kind of crazy. She wanted to be a doctor and stuff like that, but now she wants to go to school for coding and finance and stuff. And I don't know. I don't know if I want her to do that. I think I still want her to stay on that track to be a family doctor or something like that, and work in the inner cities and help people. But we'll cross that bridge when we get to it. I want her to do what makes her happy. So, yeah, dude, I'm stoked, man. I really am, and I'm uber proud, uber proud of her. I'm really excited for her to uh be in classes where there's more self-learning and self-directed learning. She can prove herself for her next year when she actually attends a school full time. Critical thinking, all these really cool things that you really do need to. I don't know. You know what I'm saying. I'm not going to get into it here. Yeah, Primal. I did. So originally, I said to her, I was like, look, if you're gonna go down the medical path, I was like, get a 4-year degree in some kind of like phlebotomist certificate or some kind of like a respiratory therapy, something that it's not huge licensing and huge continuing ed. So I'm like, if you don't, like, my mom is a nurse practitioner, and I'm like, if you get on the nursing pathway, you're kind of locked in. There are some nice certificates that you can get if you want to, like, circumvent all this to become a doctor. Because I do agree with you, man. If my daughter just wants a 4-year degree, I'm fine with that, or a certificate or something like that, or something down the road, something to make real money right away. I'm open to that as well. I don't want her to get like a degree that doesn't pay, or not doesn't pay, but you get what I'm saying. You get your college bills, and you're stuck with all this debt, and you got a degree that's not going to pay you 90,000 out the gate, like, no matter what, right? You kind of want that fallback. I know. When she's full degen zero dates, I know. So that's weird. So she's still flopping around right now, but she does a lot of so she does gamma modeling for us. She does some really cool stuff for us, and I have her do a lot of research for me in the background. So she is coming around, like that prodigal daughter, man, prodigal daughter, and I don't want her to do that, be that prodigal daughter. I want her to, well, I didn't want her to follow and join the military. I thought she'd be better served. Um, she'd be better served not joining the military, but so I have this thing where I think every kid should do some kind of service. It doesn't necessarily need to be in the military. It could be like Teach America, or it could be anything. It could be cleaning national parks. But it's spending some time of selfless service to your country. Now, this isn't political either. I don't care what political spectrum you're on, or I don't care if you're I don't care if you're even far right or far left. There's an aspect to youth where if you can have a child, a young person, they can spend time caring about where and where they live, right? So if you ever see someone that litters, or someone that doesn't care about kids or children, there's ways for you as a young person to give some selfless service with no expectation of anything in return. If it's possible for you to have that ability to do that, so that you can learn what it means to be a good citizen. So if she could, I think Detroit's helping her with that. I don't know that the military's for her, but I'm hoping that I've got her right now. She's working on some stuff, so hopefully she can do something with finance for people in need. So maybe she can work on that. Yeah, I would be fine with that, believe it or not. If she comes back with a second semester majoring in philosophy, the one thing I do tell her, it's hard. I really want her to have some way to always be able to take care of herself. I don't want her to ever have to rely upon a man to take care of her. I want her to be able to make her own decisions in life, and but if she does, man, I don't know what I'm gonna do. Hopefully she doesn't. That's all. I think that's my only counter argument. I know. She comes. That's my biggest fear. Like, I believe in the humanities today. I believe that they're going to be even more important as well, as time moves on, because nobody's majoring in the humanities anymore, and we do need people that major in the humanities. But you know how it is. It's like you just don't ever get paid. You don't ever. Some people do, but it's still a unicorn to be paid in the humanities. Yeah, humanities are dying right now, and I think they're going to be. I think it's going to be. We're going to need a resurgence of the humanities. I'm scared of that. We've gone on diatribes about that around here, right? Like, my thoughts on the humanities is we can't lose them. It's very dangerous to society to lose the humanities. Yeah, I know, Plimpton. Plimpton, I don't know what to do, man. I really, what do I say to her, right? What do I say to her? You want to be poor forever? You know? I don't know what to say to her if she pulls a humanities card out. That would be like that's the stripper pole for my daughter, I guess. My mom, Plimpton, my mom, right? So here's another thing, Plimpton, for you. My youngest is becoming a serious artist at a very young age, and it's really shining through. We just got her an Apple Air or something like that with the drawing stick for Christmas. And my other thought is, well, when AI comes along, it's going to be a useless degree to some extent. So I don't know. My youngest daughter, though, I want to send her to an art geared private school. If that's really what she wants to do, and to stay away from digital art, try to maybe go down a classic art path rather than digital arts. Believe it or not, because I really think that digital art is we're gonna be kind of fucked here at some point. Not quite a dead degree, but AI is coming for it, right? But I was thinking about my youngest because when I was a kid, I did really well in art, and my mom moved me to a private school focused on the arts in Boston, and she removed me. She disenrolled me. She literally walked into my homeroom one morning after dropping me off at school. She came into the school, back into the school, took me out of the school, disenrolled me, and said that she had told me, she's like, I'm having an existential crisis that you're going to be poor for the rest of your life if you become an artist. That's a true story. And now, of course, I'm looking at my youngest, and I'm going the opposite route. If that's going to make her happy, I guess we'll do it. Yeah, exactly, Plimpton. Something more tangible, right? Something that you would need I think robotics are farther away than AI is. Robotics, I think, we're 50 to 100 years away from real, like the catching up of robotics, where they could actually put a human touch on art. Not the exactingness, the uncanny valley of manufactured goods today. That it's been manufactured and not from a human hand. Human hand has a beauty to it that you can't replicate right just yet. And I think robotics will be the laggard, and not like digital art versus digital art, I should say. All right, so I'm going to leave this down here. There's your daily trigger down below here. I'm going to show you this hourly trigger up there, so you've got that action right there. And I'll be back with you guys. One last thing I want to say this morning is when we have emotional moments in the market, I'm expecting you as a moderator to keep yourself sober inside that chat. Make sure you guys can party and shit. Just make sure when you're partying that you're hyper aware of where the inflection points are, where the real true support, real true or where supply and demand is, okay?
Disney has the support of this institution that has helped other companies through proxy battles, and we'll see if that influences some of these other big stakeholders in Disney to vote in support of Disney's stake. And don't forget.
Also, a note here, I'm watching the Daily Trigger. We're getting a touch right now of the Daily Trigger on Q's. Looking for a here. Give me one quick second here. Yeah, 390 down here is what I've got for what I want to see. So I want to see a tag of 390. We're down here testing this. I'm going to go over to this 1 minute trigger right now. Right down there. And I'm going to leave this Q's up right here. Matter of fact, let me switch through and just look at NDX and NQ really quick. Yeah, so I'm going to leave NDX up right now for you. Okay, I'm going to switch from NDX to Q, from Q's to NDX. We got more downside. I'm going to leave NDX up instead of Q's. So just right down here, look for 16,369.52. So Q's can easily break here. You guys can see all that, right? Make sure you guys can see all this here. There you go. Just heads up, this is NDX. There you go. Morning, everybody. Morning, Alex. Morning, Trader Podcast. Morning, Sam. How are you doing? Bork, good morning to you if you're out there. Morning, Binky. Morning, Joey Donut. Morning, Chaz. Morning, Jimmy Barry. Morning, John H. Morning, Chase. Morning, Nino. Got one more thing for you this morning. Nothing's changed. Geopolitical tensions up, oil up, yields up. Mega caps getting hammered in pre-market. MGK down 0.6%. Chinese press speculated that more rate cuts and reserve requirement ratio cuts will take place in 2024, while over in Germany, rose to 5.9% from the 5.8% as expected. And UK business leaders are reporting calling for rate cuts to begin soon. You see the world cutting rates, and of course, they're all thinking that the U.S. is going to cut rates as well. Happy New Year to you as well. Yeah, Primal, exactly. I want her to get that, like that medical lab tech, any of that kind of stuff. All right, I gotta go. I'll be back. I did post, if you guys are Tesla bulls, I did post a chart on Tesla this morning. Even if there's any recovery in Tesla, remember, if you're a Tesla bull, always be buying. Tesla trades on that daily velo, so even if you get bounces on the hourly, you're always looking for that big dip on Tesla. So I'm still waiting on Tesla for a dip buy. Why am I not short this market? So I've got New Year's that just took place, right? Christmas and New Year's. I got seriously sick during Christmas. I ended up having to leave my mother-in-law's house and then go back to my mother-in-law's house to like redo the holiday.
Welcome back to Squawk on the Street.
Now, my kids are also off of school right now, right? Until Friday. I have a family. I've got like wife, children, 2 dogs, 2 cats. I got 3 houses that are Airbnbs. So you figure, for me at least in my life, right? I've got family to see still. I've got doctor's appointments, dentist appointments for kids. I got doctor's appointments for dogs. So whenever we come into like a holiday period, something like that, I've got a ton of shit going on. Most market participants, just so you know, are not in the market right now. Okay, I know you might think that it's like that reading Twitter and shit, but FinTwit and shit. But most of the market is still on vacation due to the timing of dates this year. So kids are out of school until next Monday. Most people are still on vacation. Most of Wall Street is not back in the office, believe it or not. I know you guys don't think that, but you hedge fund, like if you're day trading, you'll be back in the office. But most people out there, or at least in my kind of a situation, are still on some form of vacation, or at least what like. There's a lot of people still on vacation right now. You go to like Vail right now, it's packed. You go to Park City right now, it's packed. Everybody's still skiing. Now, I think that's just more of a function of the dates this year, like where Christmas and New Year's fell. So rather than the back end of having that vacation, it's the front end. So just right now, I still have RSV. I still have it right now. But at any rate, I'm still on vacation until Monday myself, too. So and I'm doing a bunch of work for the review for the year and getting the website launched, all that kind of stuff. Been having 8-hour day meetings with attorneys and startup people and what. So yeah, if I'm gonna be short right here, you know what it is, right? I got to be watching the markets all day long, all night long. So I'm not gonna just take out like a short or a put spread. You guys know how that is, right? If you're positioned, you eat, sleep, or I don't know about you, but I eat, sleep, and drink this shit. I'm like, this is my life. It's all I do. So I can't be positioned if I'm not in my brain. I can't be positioned if I'm not focused 100% on the market. So that's why I'm not short right now. We got 365 days in a year. We streamed last year 280 no, or sorry, 82. Yeah. No. What do we do? I think we streamed last year. I had ready for this. Here's an I don't talk about a lot of this stuff. So last year, okay, I was in the market last year 230 days of the market. I was actually in the market last year. That's obscene. Way over trading, way over. That wouldn't be the norm for me. On any good year. Now with the streaming, right? What happens for me at least is people trade or invest when they can, right? So people come into the stream, or it'll be an inflection point for a trade they want to put on, right? So there's always someone wanting to trade, and so I trade a lot. For me, right, versus a lot of people out there. So you'll see people come and go in the stream, right? If they're in a trade, coming into a trade, out of a trade, stuff like that. But just like for me to take a week off or 2 weeks off or a week off of not trading, if you look at my whole for the year, I'm in like a 0.01% of exposure in the market for the year in terms of like day trading, swing trading, investing, all that kind of stuff. I'm really overdoing it a little bit. I need to trade less. Is my point. Yeah, exactly. There's my year last year was not as good as it should have been because I have overexposure to the market. I fuck around with you guys. You guys know that, right? Like I'll be sitting here and like not want to trade, and then I'm like, all right, I'll throw 20 on. I'll throw another 20 on. I'll throw 50 on. All right, we're at 100 now, right? Now we're at 200. we're going to trade 10 grand, try to turn it to 100K. Let's do it, right? And mostly it's fucking around with like winnings, right? You know how this goes, guys. Like you can easily take 9, 10 perfect trades in a year. But you guys love the sizzle, right? You guys love social media. You guys watch Bloomberg, you watch CNBC, you watch live streams, you watch your nighttime videos, you recorded videos from people out there. You read your reports from Spot Gamma and wherever. You get on FinTwit, you stir the shit pot, and you interact. This is the world's greatest soap opera. And so, I know how it is. I get it. Most like the same shit. You make most of your money with spreads or stuff like that, and then you go around, you fuck around with zero dates, or you dick around selling and buying and selling futures, and that's how it goes. So all right, I gotta go. I'm gonna check back in if we have any major moves in the market, stuff like that this morning. I'll be here for that 2:00 hour today. So. Anything big happen today, I will be back with you guys, stopping in throughout the day. I'm going to put the CNBC back on now.
Welcome back to Squawk on the Street. I'm Bertha Coombs with your CNBC News Update. More than 100 attack. According to state media, 2 explosions took place just minutes apart at an event marking the death of a top Iranian general who the U.S. killed in a 2020 drone strike. There are conflicting reports right now on what might have caused the explosions, and no group has claimed responsibility. Israel will face genocide charges next week at the International Court of Justice at The Hague in the Netherlands. The hearing is scheduled to take place on January 11th and 12th. It comes after South Africa leveled the claims against Israel and its war with Hamas. The Biden administration plans to reopen 4 ports of entry at the U.S. southern border that had been closed to address a record influx of immigrants in December. Customs and Border Patrol agents encountered 300,000 migrants last month at the border. 2 of the sites reopening tomorrow are in Arizona. 1 is in Texas, and the 4th is in California. And Carl, of course, the Speaker of the House, will be at the border today. Back over to you.
Bertha, thanks. Bertha Coombs. AI, of course, top of mind for investors in the last year. Let's turn to AI in the year ahead, talk about the challenges widespread adoption may bring. Our next guest says regulation will be a major theme, but questions, quote, what kind we will see versus what we actually need. Gary Marcus, AI expert, NYU Emeritus Professor of Psychology and Neuroscience, and author of Rebooting AI, joins us this morning. Professor, great to see you. Thanks for being with us.
Thanks for having me back on the show.
I guess I'll start with whether or not you think the Times lawsuit is a sign of things to come.
Absolutely. I think we're going to see a lot more litigation this year. I think the Times lawsuit is fairly solid. I'm sure that there will be lots of things to skirmish about, but they kind of have OpenAI dead to rights. They show that it's possible to make the systems plagiarize pretty much in exact words things that are in the New York Times database. I have some work myself that I'll put out in IEEE Spectrum tomorrow with Reed Southen, showing basically the same thing with the visual domain. So showing that Midjourney and OpenAI are capable of replicating trademarked characters, even full frames of movies, almost identically. And I think we'll see litigation from film studios, from game studios, from independent artists, and so forth. I think there's going to be a lot of litigation this year.
What do you think will be the bigger dynamic, the litigation that we're talking about right now, or more broad-based law, government regulation, whether it's in the United States or Europe or elsewhere?
So there's a lot of laws that may come out in Europe soon. So there's the EU AI Act. There's a tentative agreement on it, but it's not actually signed yet. If it takes effect, it won't take effect immediately. There's still some things to work out, but there's a lot there. The United States, I think, is lagging behind.
According to 2 engineers, a full shutdown of production at Libya's 300,000 barrel per day Sharara oil field is on the back of protests.
Just before Christmas, there was a bill about data transparency. Where do you get your things from? Have you taken copyrighted sources? How many? By Anna Eshoo, and I think his name is Don Beyer. That's an interesting piece of legislation that could really change the game if that gets all the way through. and becomes a law.
What do you think about the commercialization prospects of AI? I think about how people have been analogizing this whole AI wave as akin to what we saw with the internet back in the 90s. But the internet, I mean, largely it's usable by everybody. You don't necessarily have to pay to use it, except for to service providers to get access. In terms of AI, we've seen this tension between the for-profit side, the nonprofit side. What do you make of kind of just the overall business models and how those will develop in the forthcoming years?
I don't think there's a business model yet that fully justifies the valuations that these companies are getting. So OpenAI is valued most recently at, I think, $86 billion. It's not clear where that revenue is going to come from, or where the profits are going to come from. They apparently made something like $1.5 billion or $2 billion last year, but that was not in profit. That was just revenue. It's very expensive to run their thing. So that's one issue. Another issue is whether people will actually, in Fortune 500 companies, use this stuff systematically. So there's a little bit of background noise there. People are doing a lot of proof of concept testing things, but not too many Fortune 500 companies have said, okay, we're going to go with this now, it really works. You know, the fundamental problem with the current technologies, it makes stuff up. People call those hallucinations. In fact, the word hallucination was the word of the year for dictionary.com last year because large language models do it so much. Like if you put in your own biography, it will make some stuff up. And so the systems are not yet reliable enough to support some of the applications people have talked about. They're reliable enough for computer programs to use them as a kind of fancy form of autocomplete, but computer programmers by themselves aren't a big enough market to justify the valuations that we're seeing. So there's a lot still open about that.
I'm sure you understand the street's on the lookout for case studies that are legitimate and productive. What would you imagine might be one of those I guess, early this year, if we get one, where there is the most promise?
I think the most promise, the clearest use case right now is computer programmers. That's already established, but it's not the breakout economics that I think people are hoping for. People have talked about doing chat-based search or generative search. It doesn't really work reliably enough yet. I don't think that there is a breakout immediate use case the way people are hoping for. I just don't see it. The big problem is you still need humans in the loop for most things because the systems aren't reliable enough. So autocorrect or autocomplete the way programmers use it, that's fine. There's some actual money there. People are using it. Writing copy text might work for like people who want to make a whole lot of blog sites quickly. There's probably some money there. But the killer app that people talked about a year ago was chat-based search. You just type in your search query and get an answer. But what we really have for that is a prototype that doesn't work. And I don't think the current technology actually can support it because these systems are not based in facts. They're just based in models of what do people say in particular circumstances. And that's why we get the hallucinations. And that's why these search things are not really materializing the way that people expected.
Certainly a gut check as the street wrestles with some profound questions about its use and universality in the years ahead. Professor, thanks. We'll check in with you soon. Gary Marcus.
Thanks for having me.
As we head to break, check out this mystery chart. It's a healthcare name that underperformed in 2023, but more than 80% of analysts call it a buy, including our next guest, who's forecasting big gains ahead. He'll tell us why and give us some other top picks in the sector. Next.
The euro falls to a fresh 2-week low versus the US dollar, last down 0.3% at $1.09.
Market continues to struggle on this second trading session of the year. Dow down almost 300 here, 1% declines on the NASDAQ. Another tough day for tech. Sector-wise, energy really the only one that's working in the early going today, although utilities and communication services trying to play along here at the moment. Healthcare, meantime, trailed the overall market last year, but our next guest believes M&A, conversations, the weight loss drugs will continue to drive the sector higher in 2024. Jared Holmes,
Morgan
CMO
Stanley
Healthcare Strategist,
CEO
joins us
Gorman
this morning.
says rates
Some of his
could go
topics
down this
include
year,
Merck
maybe a
and
couple of
Biogen. It's great to
times.
see you. Happy New Year to you.
You too. Thank you.
Is the conversation going to change much this year, do you think, prior to what we've been talking about last 12 months?
I don't think tremendously. You know, maybe on the margin, I feel like most of the topics are similar. Utilization, the GOPs,
And Gorman
how
says
that all
the
plays
economy
out.
is fine and a
M&A has been
recession is
massive
unlikely.
topic,
The
obviously,
Fed's
the
done
past
a
couple
good
months,
job.
We've seen a real buying spree from pharma into biotech. That will likely continue. It's obviously intermittent, but pretty consistent. So I think those are the three things really driving the sector. Obviously, the election year throws a little bit of a monkey wrench into things at times, but I doubt it's a major topic, all things considered.
Is M&A part of the Merck and Biogen trade?
Not really. I feel like both can work. They've both underperformed as of late. Merck's started to work. The chart's been better last couple of weeks, so finally there's a little bit of mojo there. Biogen's just been a horrible stock for so long. I think expectations are really low. Clearly they're going to be the leader for a while in Alzheimer's until other players get to the market. But it seems like, you know, we've been talking about Alzheimer's disease for so many years. Finally, there's a drug, and the street doesn't care. So maybe there's like a little bit of a sentiment shift at some point this year if they can get their act together.
But Pfizer doesn't get included in that camp. In terms of names that have struggled for so long, it's time for a turn.
Pfizer's not. It just feels like there's not much to do there. They've done so many deals. They've done at least 6 deals since 2021. I think they've loaded the boat from an M&A perspective. Now they've got to execute. Stock is not that cheap on earnings if you look at 24 and 25 estimates. So I feel like the Pfizer move has been made. They obviously tried to put out very conservative guidance a few weeks ago. Stock went to 26, 27, back near 30. Not much to do.
What do you think about the prospect for weight loss drugs in this year? Obviously, we've seen a huge run up. It's been a big talking point for the sector in 2023. What do we have on the docket in terms of studies, approvals, various use cases, total addressable market for 2024?
Yeah, there's a lot. I think we're still in the very early innings of this conversation. It's obviously going to evolve over time. You know, this will be the first year that both Novo and Lilly both have an approved drug just for obesity. So we're going to see the scripts kind of start to inflect. I think most of the street is very positive, as am I, on the adoption rate and things of that nature. And yes, there are going to be a number of studies from both companies looking at the GLPs in arthritis, looking at it in sleep apnea, even inflammation in neurodegenerative diseases in time. So I think all of that is really going to boost the interest. I don't really see the conversation dying at all. The stock price performance may not be as elevated as it was last year. Really going to be tough for Novo and Lilly to put up 50% gains again. But as far as like the narrative, this is definitely the number one storyline in healthcare still in 24.
Back above 600 today. Langone with nice remarks the other day about it one day becoming the first $1 trillion drug company. When do they use their currency, so to speak?
They've done a couple small deals recently. I've been a little bit surprised that they haven't been more aggressive. But on the other hand, they really don't need to. I think a lot of the business development, the strategy at the large cap pharma level is based on the need to acquire in order to kind of elevate revenue. They don't have that issue. So again, a little bit surprised they've been this conservative. They've done a couple small billion-dollar-ish deals along the way, but they could easily use it for something bigger if they wanted to.
Something to keep an eye on for sure.
Yeah.
Jared, thank you.
Thank you, guys.
Still to come this morning, 2023 ending with a big plunge in mortgage activity, what that may signal about the health of housing as we go into the new year. We're back after a short break.
today.
Despite a sharp drop in mortgage rates to end the year, housing demand ended 23 on a pretty sour note. Our Diana Olick joins us with those details. Morning, Diana.
Good morning, Carl. Yeah, a big drop to end the year, actually, and we got 2 weeks worth since the MBA was closed last week. Now, these are the 2 weeks when mortgage rates sat below 7% for the first time since September. The average rate on the 30-year fixed ended the year at 6.76%, lower than where it was 2 weeks ago, but higher than where it was a week ago, but of course still well below the 8% high we saw in mid-October. But the sharp drop we saw at the start of December kind of got a bit choppier. So as a result, total mortgage application volume ended the year 9.4% lower than it was 2 weeks before, and that is seasonally adjusted. Because the numbers for 2 weeks are kind of messy, I'm going to give you year-over-year comparisons to break it down. Applications to refinance a home loan ended the year 15% higher than a year ago. Applications for a mortgage to buy a home ended the year 12% lower. Now, those who can benefit from a refi are clearly trying to get in while they can, but home buyers are still contending with very little supply and very high and still rising home prices. So the question now is, with rates in the 6% range, will they stay there? And if they do, will that be enough to get potential sellers off the fence and get some more supply into the market? Mortgage rates started this week higher after also edging up on Friday, so we are now, unfortunately, at the highest level in 2 weeks. Back to you guys.
Interested in your conversation with Robert Frank this morning, Diana. Sounds like you're a bit skeptical that rates at these levels are going to bring a lot of supply back online.
No, I think because so many people, the vast majority of current homeowners have rates in the 3 to 4% range. It's great that for buyers that rates are pulling back a little bit, but if you're a seller and you're looking at trading your 3% rate, I don't think a 6% rate is really going to do it. Maybe a 5 if you really need to move, and 4 would be better. But if we could get into the low 6s or 5s, that might help get sellers off the fence. I don't think 6 and 7% is going to do it.
Yeah, a lot of psychology that goes into it as well. Diana, thank you. Getting some auto sales numbers from Toyota this hour. Let's get to Phil LeBeau for more. Phil.
Leslie, strong December for Toyota. And remember, this is in comparison December of 2023 with December of 22. Still had some chip issues that were hurting production in December of 22. So it's not a surprise that for December, Toyota's overall sales in the U.S. up 30.3%.
According to Eleanor Terrace on Twitter, the SEC is holding meetings today with exchanges to finalize comments on the 19B4S submitted by the Bitcoin spot ETF issuers.
We have talked about it for months. There is a clear rotation in the market for people who want greater fuel economy, want to take a step towards EVs, but they don't see the full EV route yet, and therefore they're going towards hybrids, and that's why you see the Toyota
seeing
numbers
upside
that they
in Bitcoin.
In 63% increase in hybrids. The demand is there, guys.
Interesting, Phil, especially given in December we saw such low gas prices. I think a majority of the gas stations across the country are now below $3 a gallon. Is there still that interplay or correlation between where gas prices are and how many EVs or hybrid vehicles are sold?
No, because you really need gas prices to make a new high and then stay there. And we haven't seen that in a long time. That's really what drives people to say, I can't take it. I got to get into an EV, or I've got to get into a hybrid. I think what we're seeing right now, Leslie, in terms of the demand for EVs, not just at Toyota, but with other automakers as well, is a clear understanding. This makes total sense in terms of the mileage and the cost and the price point for hybrids relative to internal combustion and to EVs. It just makes more sense right now. And that's why you see the rotation that we're seeing.
Pretty interesting push and pull on Tesla today, Phil, whether it's the headline about deliveries, beating expectations, but also falling to BYD. And then Morgan Stanley today arguing that the stock's going to be valued on less about cars, whereas Bernstein today reiterates 150 underweight, saying they're going to disappoint on volumes and margin.
Talking about two different things here, Carl. Bernstein, with Tony Sacconaghi, he has said this for some time. He is not very optimistic about the next couple of years for Tesla. His estimate for deliveries next year, 2.15 million. The street's at about 2.2 million. He thinks they're not only going to disappoint in terms of deliveries, but also in terms of margins. And then when you mentioned Morgan Stanley, Adam Jonas has said for some time, the real value within Tesla It's not the automobile and the deliveries there. It's what the entire ecosystem may represent in the future. And that's why he believes there's so much untapped potential valuation growth in the future. And that's what you get when you listen to Adam Jonas. And that's his theory right now. Not to say that it's right or wrong, but that's what he talks about largely in most of his notes.
Yeah, right above the 50-day this morning at about 2:34. Phil, thanks. Interesting story regarding the auto business right now. Our Phil DeBow. Dow down 286 here. Our live market coverage continues after this.
CNBC.
Good Wednesday morning. Welcome to Money Movers. I'm Carl Quintanilla with Leslie Picker on the floor of the New York Stock Exchange. Today, economist David Rosenberg on why he says the U.S. has not skirted a recession and why it might be time to have a stash of cash on hand.
Plus, U.S. Transportation Secretary Pete Buttigieg on expiring EV incentives and the latest in the Red Sea and what it means for the supply chain.
Then inside the drama surrounding Disney's board as activists ValueAct and Blackwell's back the company in its battle with Contrarian and Nelson Peltz.
Right now, though, currently the equity markets are firmly in the red. The Dow down about 0.6%, S&P down about the same, NASDAQ, the laggard there, down about 0.7%. Topping the tape for us today, the market reversal this morning. HSBC saying the next stage for stocks is a return to, quote, reverse Goldilocks, and it's time to hit the pause button on risk assets. Let's bring in CNBC senior markets commentator Mike Santoli. Mike, we kind of saw that yesterday with growth very much underperforming value, especially among those smaller cap names.
For sure. And HSBC is one of the firms that actually has been in the bullish soft landing camp for a while. So they made these timely calls believing growth was going to hold up, inflation was going to be friendly, yields could come down. I think really the feature of their call now is the market priced a lot of that in going into this year. And that was what yesterday was about, as well as today. So reverse Goldilocks means we start to pay a little more attention to the risks, both to growth and to inflation being stickier. Today's data, it's not about inflation being a problem. It's actually continuing to leak out of the system. It's much more about, growth maybe looking a little more wobbly, but more than anything, it's sentiment and positioning, overheated, need to digest, need to cool off. That seems like the process that's underway.
Yeah, we've been watching prices paid on the ISM down again, sub 50. Does that mean that the jobs number's worth worrying about? I'm seeing Morgan Stanley at 180.
I don't know about worrying about, but I think people looking into the JOLTS numbers today say there's a little more pronounced slackening of labor demand that you can see in the numbers, in the quit rate, in the hire rate. Not that where you'd say, okay, we're looking at negative payrolls, but more to the point of we want to slow down, we expect to slow down. How much of a slowdown are we prepared to get and have earnings estimates hold up? I think a lot of it, the debate is sharpened by the fact that cyclical stocks have ripped, small caps have ramped into year end, and today it's more of a broad-based sell-off, not really a rotation like it was yesterday. It's kind of industrials and financials and consumer discretionary, taking a step back because they priced in perfection or something close to it. I think that the way I've been thinking about it is, after what happened in the last 2 months, the market's pleasure threshold is much higher. It's going to take a lot more good news to have that feed into price.
And in terms of news, it feels like we've gotten back from the holiday break, some of us who had a break, and there have been a slew of downgrades. There's also just more liquidity in the market, people kind of coming refreshed and looking at their computers and saying, you know what? We saw this massive run-up, this sentiment that kind of everybody was able to get away with when there were fewer people in their seats.
And it's a question of what do you do with the normal pullback? If it is just about sentiment having to be reset a little bit lower, the underlying trends look okay. All the market-based stuff, in terms of when you get this kind of momentum push into a year end, it tends to have good implications months ahead. Just in the short term, it gets to be a little bit choppy. 9 straight weeks higher doesn't happen that often. So this is the process that seems to be underway right now. The Fed is trying to push back against the market. Meanwhile, the market can point to the ISM prices paid numbers and say, look, we don't know where this is going in the next 3 or 4 months. We could have the makings of a decent easing cycle. Whether it's for the right or wrong reasons, we can argue, but it's not completely off base to think that's where we are.
Yeah, definitely a tug of war there. Mike, thank you so much. Appreciate it. Staying on the market, Richmond Fed President Tom Barkin saying this morning that a soft landing for the economy is looking more likely, but is hardly certain, kind of going to what Mike was just talking about, and a potential for additional rate hikes remain on the table. So as we enter the new year, have we truly left recessionary fears behind us? Joining us now, Rosenberg Research founder and president David Rosenberg. David, that's a great place for us to start today. Have we left those recessionary fears behind us? It feels like the market, notwithstanding the last 2 days, really kind of has baked in this idea that a soft landing is kind of more in that inevitable camp.
Well, I think that is fully baked in the cake as far as equity valuations are concerned. I think it's premature, and I thought all along premature to throw in the recession towel like so many others have because it hasn't happened yet. What happened last year was very unusual in the sense that we had massive fiscal stimulus. In fact, the fiscal stimulus last year, both through the last chapters of the excess savings file on the consumer side, but also all the Biden subsidies. I mean, we had a boom in industrial construction in 2023 with all sorts of other spin-off effects. Fiscal policy last year added more than 4 percentage points to nominal GDP growth, which was just over 6%. So 2/3 of the growth last year in the economy came from the juice from fiscal policy, and that acted as a huge antidote to what the Fed was doing. The problem for this year is that we're going to morph from fiscal stimulus to fiscal drag. The fiscal drag is going to be between 1 and 1.5 percentage points on GDP. And as Jay Powell told us at the podium at the December meeting, is that there's still a significant pipeline of tightening from the damage the Fed's already done that's going to be seeping into the economy this year. So this year is when we really see the rubber meet the road in terms of the ongoing lags between Fed policy and the economy, but this time around, no offset from what's happening on the fiscal side.
Is the fiscal side done? I ask only because I spoke with Robert Kaplan, the former Dallas Fed president, a few weeks ago, who said that this will continue to be a year of significant fiscal stimulus and potentially coinciding with a Fed pivot, which could yet again rear inflation. So, you know, who's to say that it's really truly worked its way through the system?
Well, you have to differentiate between levels and growth. So I'm not talking, a recession is not about the level of GDP, and it's not about the level of fiscal stimulus. It's about the change. And so what's going to be happening is that, yes, the level of fiscal stimulus will still be very high, but incrementally, it's going to be detracting from GDP growth in the coming year. So we have to differentiate between levels and growth. It's going to be in terms of the impact on growth. The change is going to be squarely negative in the coming 12 months. Then the question is going to be, especially because we have a mountain of these debt rollovers, whether it's in the non-mortgage personal sector or in the corporate sector and commercial real estate, it's going to be a very interesting year from a debt service perspective because we haven't seen all the lags from what the Fed has done kick in already. Remember, the Fed was done tightening in 2006, and then all the bad stuff hit the fan in late 07 into 08. People just do not respect the policy lags. And the fact that we did have a significant offset last year, which was fiscal policy, that is not going to be repeated, will not be repeated in 2024. So that's the big differential. And I think that, you know, people who have said, well, you know, the recession hasn't happened yet, therefore it's not going to happen at all, is like me sitting in my office here in Toronto saying, well, it didn't snow in December in Toronto, Canada. So winter's been called off. You know, everybody did the same thing in 07. Where's this recession? Where's this recession? Then in 08, oops. Same thing in 2000. You know, where's the recession? Where's the recession? And then in 2001, oops, there it is. You know, to say that there's not going to be a recession is to tell me after the most pernicious Fed tightening cycle in over 40 years, is to tell me that the business cycle's been repealed and interest rates just don't matter anymore. And I'm just not a believer in those two new era caveats.
David, people still point to charts that look at household debt relative to personal or disposable income. Are you on the lookout for things to crack first in the household or more in CRE and corporate CapEx and so forth?
Well, I think that it's going to be, it's going to occur in tandem, but it's a great question because I think that business spending is probably going to take it on the chin first. And I say that because we do have a large-scale debt rollovers in the corporate sector starting this year, but it really cascades in 2025. So what's the corporate sector going to do with its profits? It's going to keep it as retained earnings. I think this is going to be a very difficult year for capital spending. And then there's arteries in the rest of the economy. Like, what does that mean for employment? You know, people talk about, you know, the household balance sheet being in great shape, but, you know, we look at aggregates, you know. Everybody looks at averages, they look at aggregates, you know, aggregates or averages. I mean, between me and Bill Gates, I guess the average is that I'm a billionaire all of a sudden. You know, but when the one thing that I am starting to notice, for all the talk about how great the consumer balance sheet is, because remember I said before, change is always at the margin, and recessions are not about levels, they're about change at the margin. Why are we seeing auto loan delinquency rates go up to the highest level in more than a decade? Credit card delinquency rates, highest level in more than a decade. Non-mortgage personal loan delinquency rates are starting to rise visibly with the unemployment rate below 4%. That just shows you all, once again, the bad lending behavior and I guess the bad borrowing behavior that typically takes place when interest rates are held at zero for so long, and you have the Fed pledging that they're going to keep rates at zero for the perpetuity. Well, that call didn't turn out so well. But once again, a classic late cycle, reckless lending behavior. It's not on the residential mortgage side this time around. You know, lightning doesn't strike twice. But for all the talk about how great the household balance sheet is, the pundits out there that promulgate, you know, that thesis have to answer the question, why is it, with such a tight labor market, that delinquency rates across a wide swath of consumer loans are starting to rise inexorably? Yeah. And where do we go? If the unemployment rate climbs above 4%, or God forbid goes to 4.5 or 5, where do these delinquency rates go? So I think it's going to be, I think that you could argue that this will be touched off by capital spending for the reasons I cited earlier. But
Yeah.
I think people are going to get surprised at what happens with the consumer in the coming year, especially with the fiscal side. Remember, the Republicans
David,
are not.
Sorry to cut you off. It's just interesting because with the delinquencies that we're seeing, you had J.P. Morgan hitting an all-time
Euro
high
pound
yesterday. So
falls
bank
at
investors don't
0.5%
appear
to
to be too concerned
0.86
about
to
what they're
a
seeing with regard
two-week
to
low.
delinquencies, but definitely something to keep an eye on next week when the big banks start reporting their earnings. We really appreciate your perspective today. Thank you so much, David Rosenberg.
Happy New Year. Take care.
Got a news alert on Xerox this morning. Let's get to Dom Chu with details. Hey, Dom.
All right, so Carl, those shares of Xerox have been sliding since the opening bell. Now at session lows, off roughly 9.5% to 10%. The company is announcing a new strategic initiative to streamline its business operations and stabilize its core print business. That plan will unfortunately result in job cuts to around 15% of Xerox's workforce and a newly shuffled executive team to lead 3 key initiatives, one in core print, one in global business services, and one in IT and digital services. Carl, the street not reacting too kindly to the news right now. Again, shares down about 9%. I'll send things back over to you.
All right, Tom, thanks for that. Meantime, Transportation Secretary Pete Buttigieg on the other side of this break. We'll get his take on some of these expiring EV incentives, plus the new investments the government's making to improve airport infrastructure around the country.
And mortgage demand seeing its biggest weekly decline in almost a year, despite the 30-year fixed mortgage rate at May lows. Zillow co-founder Spencer Rascoff gives us his outlook for the housing market. Money Movers returns after this. Welcome back. GM sales numbers are out. Let's get to Phil LeBeau for those.
Leslie, we are looking at fourth quarter results for General Motors. Sales increasing fractionally up 0.3% for the fourth quarter for General Motors, capping a strong year for the company. Its U.S. market share increasing 0.3 of a percentage point, going up to 16.3% for all of 2023. One other note from GM's sales release, the company is forecasting that the U.S. auto industry overall will hit 16 million vehicles sold for 2024. By the way, 23, best sales since 19. They are going to be increasing up to 16 million. At least that's the estimate from General Motors for 2024. Guys, back to you.
All right, Phil, thank you very much, Phil LeBeau. Meantime, the Transportation Department ended 23 on a high note. Airline cancellations at a decade low. New rail programs, new low gas prices, and improving supply chain. 24, though, bringing a full new agenda, tightened regulations for EV tax credits, escalating tensions in the Red Sea, of course, while juggling an election year. Joining us first on CNBC this morning is the Transportation Secretary, Pete Buttigieg. Mr. Secretary, great to have you. I guess first question is, what accounts for this cancellation rate?
Well, we've been pushing the airlines hard, especially after what we saw about a year and a half ago, where even on days when the weather was fine, there were unacceptable levels of cancellations and disruptions. We pressed them on realistic scheduling, we pressed them on staffing, and we made sure that we took steps that were under our own responsibility, especially with things that the FAA could have some control over, like improving the routes that aircraft are allowed to fly on, deconflicting parts of the Florida airspace where there's a lot of competition for the airspace with space launches and military activity. All of that has added up into a dramatically better picture last year than the year before. Matter of fact, as you noted, it's a 10-year low in terms of the cancellation rate. Now, we're not sitting comfortably with that. It's going to take a lot to keep that up. We're also turning our attention to delays and driving the rate of delays further down. But I think this does reflect major improvement in the flexibility and the fluidity of our national airspace at a time, by the way, where we're seeing huge volumes. Matter of fact, some of the holidays last year, like Thanksgiving and the summer holidays, had all-time record highs in terms of the number of passengers streamed by TSA. The Sunday after Thanksgiving was the most recorded in American history. So really pleased to see these dramatic improvements in performance by the airlines here.
Is the collision in Japan in the last 24 hours important to watch, instructive for what ground safety may mean at airports here?
Yeah, anytime we see an incident anywhere in the world, we pay attention. FAA pays close attention. Obviously, that's something that should never happen. We have the safest, most complex airspace in the world here in the U.S. If you think about it, it's an astonishing fact that this is the safest means of travel available in the U.S. In order to keep it that way, that means anytime there is a crash anywhere in the world, or never mind a crash, anytime there's a close call, we're paying close attention. I mean, our definition of a close call sometimes includes an airplane coming half a mile away from another airplane when it shouldn't have. That's enough to get our attention, lead to an after-action review. And so we're going to continue pushing, with safety being the top focus of our new FAA Administrator Michael Whitaker, who was confirmed late last year by the Senate.
Secretary Buttigieg, it's Leslie Picker here. There have been so many headlines this year about these near-miss collisions and the alarming rise therein. Any color you can share in terms of why that has been rising and what your administration is doing to thwart them in the future?
Yeah, again, last year we saw an exceptionally high level of traffic and volume. We need to make sure the system is able to keep up with that. And, in some ways, a testament to the safety of our system is, it's not like car crashes where there's, thousands of them, hundreds of fatalities a day, and we're sifting through the data to learn from that. With aviation, in the absence of commercial airliner crashes, we pay attention to near misses as if they had been, because that's really where we can get the data on what the system needs to see going forward. We saw a number of different issues, some of them on the part of pilots, some of them on the part of air traffic control, some of them on the part of ground crews. And the real focus now is making sure we have the technology, the staffing, the equipment, and the training to prevent these from happening. I do need to mention that a big part of this is growing our ATC workforce. It's been on the decline for decades. If you look at the number of air traffic controllers, it's gone down and down and down, which means the controllers we have are overworked. We've finally changed that. The number is going up. We're finally hiring faster than we have departures. But one thing that would stop us in our tracks is if we had to shut down the Air Traffic Control Academy because of a shutdown. It's one of about 1,000 reasons why America cannot afford a government shutdown this month.
One of the things the street's been struggling with in the last couple of quarters has been what appears to be a slowdown in EV demand. We mentioned the tax credits. We talked about low gas prices. You got any theories as to why the adoption curve may not be what some forecasted a couple of years ago?
Yeah, I mean, at the outset, I want to make clear it's still growing. It's just a matter of the rate of growth. But we are seeing it go through some ups and downs. We need to make sure that we keep pushing the upfront cost, the sticker price of EVs into a range where more and more Americans feel like it's to their benefit and feel confident making that choice. But we know that there are going to be some fluctuations. We also have to make sure there's the charging infrastructure to support that for long road trips. And simultaneously, we need to make sure that there's a level of education domestically about the charging capacity many people already have and don't know it. What I mean by that is a majority of Americans live in a single-family home where they might be surprised to realize that all you need technically for charging infrastructure is a plug in the wall. Of course, some people might get a level 2 charger or something that's a little faster, but a lot of people have more capacity than they already realize for charging these EVs. So all of this are going to be a factor. The cost, the charging. There's no question that the industry is headed this way. Our focus as an administration is making sure that it's an America-led industry. It's why we have these strict requirements that are getting stricter each year in terms of how you qualify for those EV tax credits. And it's why we have a whole policy focused on making sure that the next generation of great auto jobs are right here in America, just like the generation of auto jobs that created communities like the town I grew up in Indiana.
As we think about the supply chain, there's been so much attention on the Red Sea. Just this morning, the Houthis are claiming yet another attack on a container ship in a very critical shipping route there. What are you seeing in terms of, your conversations with shippers and their willingness to go through that route, given just the Navy presence that has been there and the international effort to ensure that the passageway is safe?
Yeah, we're talking about a key global shipping route here, and anytime you see that kind of instability, that's a major concern. Our department's talking to shippers every day. Of course, the Department of Defense has the lead on the military side of this. We're engaging shippers who are, in many cases, looking at alternatives, even if that adds days and dollars to a shipment, just so that they don't have to face that kind of concern and instability. For those that do, of course, the Navy has been there, and there's a multinational effort to see to their safety and security. But needless to say, for this supply chain or any supply chain, the less you have that kind of activity, the more we can have geopolitical stability, the better it's going to be for our supply chains, all the way here to the prices that we're paying on the shelf here at home.
Would you argue, Mr. Secretary, if we went back to a period where supply chains were as challenged as they were coming out of COVID, that the playbook, the American playbook in response has been refined, that response would be different than it was then?
It's a great question. I think we've learned a lot of lessons from what happened 2 or 3 years ago, but honestly, we haven't fully digested them because we have to really rebuild our machinery, so to speak, around this. Companies are doing that, shippers are doing that, customers and cargo owners are doing that. We're investing in more and better port capacity around the country. It's one of the parts of the president's infrastructure plan that probably doesn't get enough attention, is what we've been doing at everything from some of the biggest ports in the country, like LA Long Beach, to some small ports along the Mississippi River that are a really important part of our supply chain. I think moving forward, we're going to see more attention to friendshoring, more focus on onshoring, which can obviously make a big difference here. But we also just need to make sure that we have the right kind of data and information. It is not the data sharing that goes on in shipping is not nearly as fluid as people would assume. We're working on that with a newly created freight office here at the US DOT, and really appreciate a lot of private sector players that have come to the table willing to share data in a way that's appropriate and obviously not sharing data that shouldn't be shared, but just getting more information so people can predict the ups and downs and make good business decisions based on that instead of responding and being reactive.
And finally, Mr. Secretary, you mentioned earlier the potential for a shutdown. I know we're looking at several funding cliffs in the next few weeks. Based on my colleagues reporting in Washington, there isn't even a top-level number that they've agreed upon in Congress to come up with these budgets. What's your concern as you look at the efficiency that we're seeing in the transportation sector, that a shutdown might have some potential damage there?
Look, imagine running a business and not knowing whether a certain day, 2 or 3 weeks from now, you're going to have to shut down completely. That would consume your attention. And a lot of time, a lot of money was wasted during the run-up to the unnecessary shutdown countdown that happened in October. Thankfully, we got through that without a shutdown happening. But now it feels like here we are again. It's not needed. All we're asking House Republicans to do is honor the deal that was made last year between them and the president, because this really is a politically manufactured crisis that would have very real consequences for our economy, for so many hardworking public servants and military members around the country, and for things like our transportation systems that are finally moving in a direction where we're seeing better performance, more fluidity. The last thing we would want to do is throw a wrench in the works with an extreme Republican-driven, House-driven shutdown that really I don't think is necessary for anyone's policy goals, conservative, liberal, or in between, to be met. It just doesn't make sense to play these kinds of games with the American economy.
Well, from airlines to EVs to the ports to funding, we covered a lot. I really appreciate it, Mr. Secretary. Thank you. Pete Buttigieg.
Good being with you. Thanks.
Thank you. Still to come, a deep dive inside the battle for Disney's board, the latest move from activists Value Act and Blackwell's Capital, attempting to fend off an attack from Contrarian and Nelson Peltz. Money Movers returns in a moment.
couple hours into trading, just coming off a session lows. Let's get post to post with Bob Pisani. Hey, Bob.
You know, Carl, unusual. 2 down days to start the year. That doesn't happen very often. Now, there's 2 groups people are continuing to buy. I mentioned this yesterday. Energy and healthcare. There's Marathon Petroleum. Big refiners up about 6%. Exxon's been up the last couple of days. That's a group. The other group moving, healthcare. We're seeing Merck move. Pfizer move up. These stocks all had a tough time last year. So that's the 2 groups. Other than that, though, pretty thin pickings on the bullish side here. So the banks, the regional banks like Synovus, they've stopped going up a couple of weeks ago. They really haven't participated in the rally. I'd call that sideways for the last couple of weeks. Got to keep an eye on that. Consumer discretionary, big moves up in November, December. I kept putting up all the cruise lines. The Norwegian was up 50% last year. But look at this, down 4%. It was down big yesterday. It's down 11 or 12% in the last couple of days. So discretionary sectors are losing a little steam. And then, of course, you know about tech. You didn't need an Apple downgrade. They were selling right across the board yesterday. There's Taiwan Semi trades right here. That's been down, probably 4% so far this week. So the bottom line is the S&P 500 is heading for 2 down days on the beginning of the year. That hasn't happened since 2015. So it's a little unusual to see that. And the Santa Claus rally, we keep talking about that. That's really in trouble. That's the tendency for stocks to rise in the last 5 days of the old year, the first 2. So it ends today. This is 7 days. And so far, look at this. We're down 0.7%. Now, fortunately, it doesn't fail that often. Usually you get a rally in these 7 days, so it's only about 22% of the time it fails. The tendency when it fails is for the year ahead to be subpar, typically, not necessarily down, but subpar, and that's what goes on here. We also have the January barometer. As goes January, so goes the year. We're starting that, and that has a pretty good accuracy rate. That's about 84%. That's the Stock Traders Almanac number. We'll keep an eye on that. Finally, the most interesting thing to me about 2024 is what I call the political barometer. In years when there is a sitting president, the S&P tends to outperform because the president has various levers they can pull to help the economy out. The S&P has been up every single year when there has been a sitting president in an election year since 1944. Every single time. I think there was 16 times this happened. Every single time the S&P has been up. And by the way, Leslie, there are a lot of global elections this year, over 40 of them, including Mexico and India, Pakistan. There's a bunch of elections in Europe. And what that means is, well, politicians can pull levers to help the economy, but they can also make controversial statements to gain votes there. So a little bit of reward and a lot of risk out there as well in the elections this year. Leslie?
Yeah, Bob, we heard from Daryl Cronk last hour who said expect more equity volatility this year. Last year, rates volatility. This year, equity volatility. So we'll see if that holds true. But you laid it out so nicely for us. Thank you, Bob.
Okay.
Time now for a news update. Bertha Coombs has that for us. Bertha?
Hi, Leslie. House Republicans plan to start impeachment proceedings against Secretary of Homeland Security Alejandro Mayorkas next week. A spokesperson for the House Homeland Security Committee confirmed the move to NBC News today. The first hearing is set to take place January 10th. House Republicans claim Mayorkas has mishandled the migrant crisis at the U.S. southern border, but Homeland Security officials call the impeachment push a waste of valuable time and taxpayer dollars. The European Union targeted the world's biggest diamond mining company and its CEO today in its latest war sanctions against Russia. The move will freeze a lot of Alrosa's assets in Europe. The sanctions are in addition to a previously instituted import ban on Russian diamonds. And Starbucks customers on the go will now be able to bring their own cups. The coffee giant announced today personal cups will now be allowed for all visits, including drive-through and mobile orders. Starbucks says it will reduce the amount of cups sent to landfills. I'm not sure how you order ahead with your own cup unless they store it for you.
I don't think they do that. I think there's like a pre-measured amount that you give that they pour into your cup. But yeah, a lot of questions, more questions than answers. Bertha, thanks. Bertha Coombs. Coming up next, luxury real estate was a rare bright spot in 2023, but can that continue? Mortgage rates at their lowest level since May. Zillow's co-founder Spencer Raskoff is with us after the break.
Welcome back to Money Movers. Let's talk housing. Luxury real estate was a rare bright spot in 2023, but can it continue in 2024? Robert Frank is here with us for more on that. Hi, Robert.
Leslie, good morning. Manhattan home prices rising for the first time in over a year, driven largely by the high end. Median sales prices rose 5% in the fourth quarter to $1.16 million. That's according to Douglas Elliman and Miller Samuel. The average price for a Manhattan apartment also increased to just over $2 million. The total number of sales fell due to a lack of inventory, sales volume dropping 6% in the quarter, and it fell 29% for the year. But sales above $5 million, so that's sort of the middle to high end of Manhattan, those increased in the quarter. Most of those are wealthy buyers, of course. They pay in cash, so they're not as reliant on mortgage rates. 2/3 of all apartments sold in Manhattan were all cash. That marked an all-time record. Nationwide, the ultra high end held up fairly well last year. There were 34 homes sold in the U.S. for more than $50 million, and 5 of them were sold for over $100 million. Most of those were in Palm Beach, the Hamptons, and Connecticut. The most expensive deal of the year was that $190 million sale of an oceanfront home in Malibu bought by none other than Jay-Z and Beyonce. It had been listed for $295 million. So in their mind, they saved $100 million. Guys?
They got a bargain. Did they pay all cash or was
They got a bargain.
They take out a mortgage for that one?
We don't know. I think they could have. I think if anyone could pay cash, Jay-Z and Beyonce could.
They could do it for that oceanside Malibu home, indeed. Robert Frank, thank you. Sticking with the housing market, application volume was down 9.4% last week compared with the 2 weeks prior. Mortgage demand seeing its biggest decline since February 2023. Our next guest, more optimistic, though, as rates continue to tick down and believes sellers will lose patience and finally start listing. Joining us now, Zillow co-founder and former CEO and 75 and Sunny Ventures CEO Spencer Rascoff. Spencer, thank you for being here. Happy New Year. So I'm looking at the 10-year kind of hovering right around that 4% level. Is there any psychological implications for 4% as it pertains to mortgage rates? I guess it's still below the peaks that we saw earlier in 2023, but up significantly from the prior few weeks.
Yeah, I mean, last week's mortgage application data was kind of an oddity because of the holidays. I wouldn't put too much stock into it. You know, to take a step back, I would describe 2023 for housing as pretty grim. It was basically a frozen market. We had 4.3 million homes sold last year. That was down 14% from the prior year, down 30% from 2021, and it was the lowest sales volume in 12 years. So pretty slow, and that's because of high mortgage rates and low inventory. This year is going to be a little bit better. So first of all, you should know, though, buyers are still going to have a pretty tough affordability environment. So Zillow data shows that the average home buyer is spending about 40% of their income on housing. I wrote a book 8 or 9 years ago called Zillow Talk, in which I said that the 50-year rule of thumb was don't spend more than 30% of your income on housing. And now the average person is spending 40%. So clearly we're spending more on housing because of high rates, but rates are coming down. So they've already peaked. They were already in the 8 to 9% range in October. Now they're 6 to 7. Redfin predicts 6.5, 6.6 by the end of the year. Realtor.com predicts low 6s by the end of the year. What we're also seeing, though, and a sign for optimism in the housing market, is more house hacking. So this is people finding creative ways to drive affordability in a world of low inventory and high rates. And one common way to do that now is through co-ownership. And so that's why Picasso, my company, is growing so quickly. We're now in 40 markets in 5 countries. We passed $1 billion of sales. Co-buying, especially in vacation destinations, is a really attractive way to house hack and get your way into a market that you might be priced out of otherwise.
When you said
there
house
are other
hack,
tactics buyers are doing, like finding alternative destinations. So Mount Rose, Nevada, for example, instead of Reno, Tahoe. Bald Island, North Carolina, instead of Kiowa, South Carolina. Golden, Colorado, instead of Vail and Aspen. So Picasso data shows a lot of these secondary markets are stealing share from these primary markets that more and more people are getting priced out of.
Yeah, affordability obviously still a very key component here. And you mentioned patience being the key that could unlock some of the freezing of the markets that you're seeing. What changes patience? I mean, we've seen 2 years of this. What ultimately, if rates are kind of near these levels for the foreseeable future, what ultimately changes the patience equation for folks that gets them kind of out of their homes and a little bit more movement on the supply front?
Well, there's a lot of psychology, obviously, in all markets, but especially in the housing market. And the more time passes, the more people are getting used to 5, 6, 7% mortgage rates. So at first, it seemed like a total sticker shock a year ago when, after 5 years of 0 to 3% mortgage rates, all of a sudden we were seeing rates in the 6, 7, 8% range. Now we've had a little time to adjust. They have come down. That's starting to generate more and more interest. So I think we'll see a much better spring in terms of sales volume as compared with a year ago. The other big change that you're going to see is new inventory coming online. So first of all, you'll see new single-family rental inventory. These are owners that don't want to sell because they don't want to give up their low mortgage rate, but they're going to be willing to rent out their home. And then you have a huge supply of apartments. CBRE says that there are over 1 million units of apartments coming online this year. And as a result, Yardi predicts only 1.5% rent increases for rentals. That compares with 10 to 15% rent increases over each of the last 2 years. So more inventory coming online. That's good news for people, good news for buyers, also good news for renters.
You know, one of the dreams of housing bulls, Spencer, is that the boomer generation is going to start to downsize, and they don't care about interest rates because they're going to use their equity to pay cash for something else. Is that legit, or is that going to be such a slow-moving process that you can't really count on it?
No, I do think that's legit. I mean, Picasso's already seeing that in the data where people are moving. And again, it's partly about the psychology of adapting to lower rates and now saying, okay, I'm not in the house that's right for me anymore. Many Americans are not in the house that's right for them. They're kind of stuck because they have 2, 3, and 4% rates, which are great, but it keeps them in the house that's no longer right for them. And so that's true of boomers. That's true of other generations as well. That's going to become unstuck as people start to adjust to lower rates, more inventory comes online. So yes, I do think that's a real trend, Carl.
Fascinating. Spencer Rascoff, thank you very much. And house hacking is a term I learned. It doesn't mean people are breaking into your home, though. So that's reassuring.
Right. Thanks,
Spencer, thanks. Up next, activist tension mounts at Disney. Hedge funds, ValueAct, and Blackwell's pushing back against Trian. And Nelson Peltz in this battle over the board. Shares just about flat since Iger's November 2022 return as CEO. Stay with us.
According to a source, OPEC Plus is to hold monitoring meeting on February 1st.
Do you want to stay up to date with the latest and be on the bleeding edge of news for non-farm payrolls? Then sign up today and get our special offer of Financial Juice Pro for a year's worth of our service for the price of 1 month and save 92%.
According to a survey, OPEC December crude production little changed at 28.05 million barrels per day.
Welcome back. A board battle at Disney capturing the street's attention this morning. That's the focus of today's Tech Check with Julia Borston. Hi, Julia.
Hi, Leslie. That's right. Disney announcing an agreement with activist hedge fund ValueAct to advise it on strategy, and ValueAct will support Disney's slate of board of directors at its annual meeting. Disney CEO Bob Iger saying, quote, ValueAct Capital has a track record of collaboration and cooperation with the companies it invests in, and its co-CEO Mason Morfitt has been very constructive in the conversations we've had over the past year. Now, ValueAct owns 5 million shares in Disney, of course, according to sources close to the situation. This helps Disney defend against Trian, which votes nearly 33 million Disney shares. That includes about 25 million shares owned by former Marvel Entertainment chief Ike Perlmutter. Trian saying that Disney's agreement with ValueAct does not change its approach to this proxy battle. Now, Trian just last month nominated Nelson Peltz and former Disney CFO Jay Rizzullo to Disney's board. This after Disney named the addition of 2 high-profile new board members, Sir Jeremy Derrick, who is former head of Sky Media, and now former Morgan Stanley CEO James Gorman. He's had experience with proxy fights as well as succession planning. And in an interview just now on Bloomberg, Gorman praised Iger as a phenomenal executive, adding that Disney's focus should be on company strategy and not on the activist battle. Leslie?
Julia, it seems like Gorman, who is retiring from that CEO role, taking the role of executive chairman, but also a board seat, of course, at Disney, will still be quite busy given what's going on at Disney. How do you think that these activist battles influence the psychology of other investors? As one source kind of described it to me, you've got ValueAct, which is very pro-Disney, pro-Iger. You've got the Blackwell's situation, which they nominated 3 directors to the board. That is kind of anti-Peltz, sort of pro-Disney, but still putting directors on the board. And then, of course, you have the Trian Peltz, which is, in this source's terms, anti-Disney, anti-Iger in terms of their criticism. But as you think about just the remaining investors that are out there and how they might be voting their shares, how does this kind of whirlwind of proxy battles influence their thinking?
Well, I think that the alliance between Disney and ValueAct is most important, not because of those 5 million shares, but how it will influence millions of other shares that will be voted when it comes to the support of Bob Iger. So I think the support of ValueAct is most important for that reason. And I think the question now is what kind of argument Disney and ValueAct together make on behalf of their board. They obviously have the addition of these 2 new board members who both have great experience and also very high profile. And I think that's what's really key here about the ValueAct piece. The next shoe to drop here, Leslie, is we're waiting for the preliminary proxy filings, both from Disney as well as from Trian, and that will be the thing that pushes this forward for the rest of the shareholders out there.
Interesting to watch, Julia. Thank you for helping make some of that a little more clear. Julia Borston on Disney today. Coming up after the break, attacks continue on commercial vessels in the Red Sea, how those companies are responding, and the impact to the global supply chain when we're back in 2.
2025.
Welcome back. As the conflict in the Middle East continues, our next guest points to what he calls the ugly truth that the Iranian regime is key to the Middle East's worst problems and that U.S. inattention will only make matters worse. Joining us this morning, Atlantic Council CEO and CNBC contributor Fred Kemp. Fred, it's great to have you back. Thanks for the time this morning. It's an important day with the death of this deputy Hamas leader and, of course, Iranian warships in the Red Sea. What do you mean by U.S. inattention? What more needs to be done?
Well, look, it's getting more and more obvious. You don't have the October 7th Hamas attacks without Iranian support. You don't have the problems in the Red Sea, Houthis attacks without Iranian weaponry, without Iranian support. The same is true with Hezbollah, has thrown 1,000 rockets at the Israeli north, and things are tensioning up there. That also doesn't happen without Israel. And then on top of all of that, we've had an announcement just before Christmas from the International Atomic Energy Agency that Israel's ever closer to a nuclear weapon. It's tripled its near weapons grade uranium, so it could be as close as 2 weeks away. It has enough weapons. It has enough weapons grade, near weapons grade uranium that it could upgrade to produce 3 weapons. So all of this tells you that the problem's not just Hamas, the problem's not the Houthis, the problem's really Iran. And Carl, your question is, what do you do about that? Well, I think over the short term, you have to keep the shipping lanes open. You have to show that Iran is not going to succeed through its proxies. Over the medium term and long term, you have to put Saudi Arabia back on a normalization track with Israel. You have to put the Abraham Accords back together. And you have to almost build what you did in the Cold War vis-a-vis the Soviet Union, which is a whole area of modernizing, growing, prosperous countries so that the Iranian people see that what the regime is bringing them is not good.
Right. Shorter term, though, this Operation Prosperity Guardian, which was intended to make the Red Sea passable, is that a short-term tactical failure, not just on the U.S.'s part, but on our allies?
At the moment it is. You have both Hapag-Lloyd and Maersk and others saying that they're not going to send their ships through the Red Sea right now. I think that the U.S. is determined to open that up again. It may take a little bit, but 12% of the global economy runs through the sea. 1/3 of all containers runs through that area. And so I think the U.S. has to show that it can keep that open with its partners and allies. So I think for right now it's not succeeding, but I don't think the White House, I don't think its partners will allow that to last forever. I think they'll want to keep it open again.
And Fred, Israel has, said plans that they will be scaling back efforts in Gaza, but still will remain presence there for at least through 2024. What does that mean in terms of kind of the normalization efforts that we saw prior to October 7th with regard to Saudi Arabia and other neighbors in the region?
Yeah, the Biden administration officials talk about their prospects for normalization as a ticking time clock. That they feel that in the first quarter, if they can get Israel to get on a path of some sort of formula toward a Palestinian state, that you could begin to have some talks again with Saudi Arabia and perhaps open up and advance the Abraham Accords countries to more economic integration, etc. This really lies in Israel's hands. And I think the closer they get to an election and the prospect of a Trump victory, the harder it's going to get get President Netanyahu to make compromises. At least I think that's what officials believe.
Fred, appreciate that very much. Good to get your guidance on this one. Story's not going away anytime soon. Fred Kemp joining us talking about the Red Sea as we're continuing to trade in the red. Let's get to post 9.5.
Carl, thanks very much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour, playing the pullback in stocks. We'll ask the investment committee today how to navigate this early year market reshuffle. Joining me for the hour, Bryn Talkington, Joe Terranova, and Stephanie Link. Let's check the market, see what we're doing. It's red again. So that's how we're starting the year out. You see what's going on here. Less than 1% declines. NASDAQ's the biggest loser, coming off the worst day it is, as well as the NAS 100 since October. Tech's worst day since August. How about this from Bespoke, Stephanie Link? Tuesday was just the 5th time in the NASDAQ's history that it started off the year with a decline of 1.5% or more. I mentioned the reshuffle. You have new moves that have nothing to do with tech. It's your own personal reshuffle. You buy ExxonMobil, you buy Bristol Myers. Two areas of the market that were disappointing last year, energy and healthcare. And you're going in. Why?
Mean reversion. I think you're going to see it. I think you're going to continue to see the broadening out like we have been seeing since October, the lows. We saw the S&P equal weight outperform the S&P market cap weight by 200 basis points. Yesterday was much of the same. And I just think I'm a very big believer in mean reversion. That's not to say I think tech is going to crash. I don't. I still own a lot of tech. We're going to talk about that later. But I just think there are some opportunities that are presenting themselves. I haven't owned ExxonMobil in probably 10 years.
Wow, because you were Chevron.
I was Chevron.
Which you sold too, because you got fed up with that.
Yeah, you know what? Exxon has done such a better job in the last couple of years in terms of execution, in terms of M&A. I love this Pioneer deal. I'm sure Joe has an opinion on that as well. They're going to be the #1 player in the Permian, whereas Chevron, they're making M&A outside of the Permian, which I'm not really crazy about. There's a lot more volatility there. This stock trades at 5.5 times forward estimates. The long-term average is at 7.9 times. You get a nice dividend yield as well. So down 4% last year, Scott. I think we can see that. I think energy is going to rally this year, again, as a mean reversion trade as a sector as a whole. And I want to own Exxon because it's 22% of the XLE as well. People will be buying Exxon and Chevron as well, right? And I also own Schlumberger and Diamondback Energy. Bristol, we talked about this a couple weeks ago.
Well, you have J&J.
I have J&J.
Right, so you've legged into energy a little bit more of late. So why does this make sense as part of that?
Well, again, also mean reversion, and I had been buying a lot of J&J over the last month. In fact, offline, we were talking about healthcare, and the past month is probably the area where I've allocated the most in terms of a new sector. And so I'm getting close, actually, to market weight. But these are really concentrated portfolios in terms of positioning within the portfolio, rather. This stock was down 36% last year. It trades at 7 times forward estimates. It has one of the highest dividend yields, 4.5% in the sector. And they've got a bundle of cash too, a really good balance sheet, very little debt. What I think is going to take some time to see this play out because a lot of their drugs are going off patent in the next couple of years. But that's why we're seeing so much M&A from the company. In fact, since 2000,
they've been on a spending spree.
Since 2019, they have spent $119 billion on M&A to replenish that pipeline.
Yeah, well, I mean, since 2 weeks ago.
Oh yeah, no, I know.
Right?
3 deals, I know, and that kind of caught my eye, and that's what we talked about. Remember, I sold Nike, and I said I have a little cash on the sidelines. Then they did this other deal, and I was thinking to myself, it's so cheap, it's so hated, it's only going to grow revenues and earnings low single digits. That's not glamorous by any means, but I do think as these new products take hold, you will see a kind of a resurgence of interest in this name. And again, it's just so down and out at this point.
Okay, so does this reshuffle or whatever you want to characterize it as, it's not necessarily a rotation because a lot of stuff is red, but NASDAQ's down more than everything else again. Does this have legs? And if so, for how long?
I think the important question you have to ask yourself is, well, does this have legs and for how long? Potentially, yeah, I think it does.
Feels like it does, right?
It feels like this could extend into earnings season, and earnings season reverses it. Or potentially on Friday, we get a really bad unemployment report that sends the 10-year back towards last Wednesday's low at 379. And then, in fact, I think you'll see a little bit of a rally. But I think the bigger question is, what do you want to do with a market that's selling off aggressively at the beginning of the year? Do you want to treat that market as an opportunity to add to risk, or do you want to continue to trim? And we talked about yesterday trimming in the areas of the market where in 2023 you saw the outsized gains and where the market is technically overbought. Now, a lot of those were semis.
Yeah,
some
but
of the mega caps.
I mean, I look at, what I just go back to Cramer's commentary yesterday morning where it was like trim across the board. Because so much was up, so much so late that a lot of stuff got extended. It's just the valuations and the multiples of the mega caps are the ones that jumped out the most.
Okay, so I disagree with that. I like what Stephanie's doing. I like being tactical and identifying. I don't think anything has changed from the Q4 narrative that you're getting rate relief, that the potential is there for taking the hard landing off the table and getting the soft landing, and that you get the broadening out of the market. And you find the opportunity, like Stephanie is in a Bristol Myers, you find the opportunity in some of the energy names. You can find opportunities in the financials themselves. And I think on a pullback here, like you have over the first 2 trading days of 2024, you want to look to add risk into those areas of the market where they were neglected in 2023.
See, I think the GDP is running hotter than expected. At about 2.6% is the latest number from Atlanta Fed Tracker. So 2.5%, 3% doesn't really matter, but I think that translates into pretty good earnings on the top line. And then as we've talked about margins, as inflation has come down, input costs have come down, I think the margins are going to hold in better. And I think that's what's going on here. And also lower interest rates, so lower funding costs as well for corporations. And so I think earnings and the reality that earnings are going to be better than expected, not just for Mag 7, but for all of these other sectors, right? I mean, look, ExxonMobil, their break-even, cash break-even is at $35. I mean, they're minting money at this point, right? And so they are doing M&A and they are doing buybacks and all kinds of shareholder value creation. That's going to happen with a lot of the other 493 companies that didn't get respect in 2023.
So we just had a stat. I think it was the first time that we just showed at the bottom of the screen. First time the S&P has led the year with back-to-back losses since 2015, is I think what I read. Is that just because we had, Bryn, such a strong move into the end of the year? Should we not read anything more into what's taking place over these first trading days of 2024?
Well, I mean, history will tell you, as goes the first week, goes the first month, goes the first year. So I do think you have to read into what happens this week, because that's just not an adage. There is some history to that. I think, though, from a positioning perspective, we obviously talk a lot about the mega caps. To me, where you're really seeing the selling pressure and really have to think through allocation are in these small and mid-cap growth names. If I look at like an ARKK as like an overall ETF, but like a Square, a Unity, a lot of those names, Scott, are down 15% in 3 days. And so to me, that's where you're really seeing a lot of money coming out, because those were very, very short. You had short covering, and you had the market saying 6 to 7 rate cuts. I've always believed that I think that 6 to 7 rate cuts is too aggressive, and so you're seeing a lot of money coming out of that. I think once the CTAs, who have been very, very levered long, let's see what happens with that. That could cause some more pressure. But I agree with Joe. The narrative for the year, I mean, we're in a presidential cycle. That's positive. The soft landing is still in place. So I think that really you have some repositioning, especially within those small and mid-cap growth names. But I love Steph's moves, though. I think that these companies were, to me, very consistent with Steph's move, have a very high free cash flow yield. And to me, that's going to be a consistent narrative over the year of being able to generate returns outside of these 7 names that we spend a lot of times talking about.
Of the 7 names, though, Bryn, I guess the central question is, how much do mega cap multiples need to correct? We need to figure out what the right answer is before we know what the story of those stocks is going to be. When I tell you that, and we did some of this yesterday, but a year ago, Apple's valuation was 20.5. Now it's 27.5. Now yesterday was more than that, but it's down obviously again. The 10-year average is it's less than 19. There are a lot of stocks in that boat. Microsoft a year ago 23. Today it's 30. The 10-year average is 23. So how much more do those multiples need to correct?
You got to be really careful. Multiples are a terrible metric for timing.
Everybody keeps saying that. I hear you on that. I heard that 2 or 3 times yesterday as well. But the bottom line is, if there's a view that these multiples are extended, they need to correct to something before people deem that they're going to jump in and buy the dip.
Well, I think you have to separate these names. And so when I look at Apple, which I own, which everybody owns, it's like Tim Cook is amazing. They have a great team. But the bugaboo I've always had about Apple the past couple of years is outside of COVID, pre-COVID and now post-COVID, their revenue growth is around 3%. They make a bunch of cash, they buy back their shares, they have a flywheel, et cetera. But ultimately, the expectations for Apple's revenue growth for 2024 is just 3%. So does that deserve a 30 multiple? I mean, we'll see what the market. That seems kind of high to me. As a juxtaposition, NVIDIA, to me, could be one of the cheapest names, because not only did they have 18% revenue growth for 2023, but for next year, it's expected they do 54% revenue growth. So I could separate the two and say, well, the market doesn't believe NVIDIA's revenue growth is going to come in, but if it does, that stock is actually one of the cheapest of the mega caps because of that really strong revenue growth.
I want to bring in, since you mentioned NVIDIA, Joe, since Bryn mentioned that, there's a note out from D.A. Davidson that deserves our attention today. What if AI is just another cycle? That's the title of it, but they go deeper, and this is where it gets controversial. We believe out-year consensus expectations are unlikely to materialize and will start reverting to trend line within the next 2 to 6 quarters. What if AI is just another cycle, they ask? NVIDIA may be vulnerable as AI hype approaches the trough of disillusionment. Those are pretty powerful cold water words.
Okay, so
on a stock that absolutely ripped more than 200% last year.
I want to separate my answers into two buckets, if you would. The first thing I would respond to that is I completely disagree with the premise, because for that to unfold, you have to believe that the overwhelming amount of spending that currently right now is going on with the mega cap companies, with all these companies pushing towards advancing the innovation, right? And remember, these are the world's strongest financial corporations. We know who they are: Alphabet, Microsoft. So you have to believe that they're going to stop spending on buying those chips from NVIDIA. And I just don't think that is plausible at all. I think the spending continues. But the other thing that's important, and it goes back to what Bryn was kind of talking about, you have to remember something, in particular as it relates not only to the mega cap 7, but the semis. In September and October, everyone on this desk sat here and talked about this incredible chase for performance that they believed was going to happen in the fourth quarter. And it did happen. And it began with the semis and mega caps, and it broadened out a little bit into the other 493. There is no way you could present me the evidence 2 trading days into 2024 that we have worked off the excesses of that exercise where everyone chased the mega caps and everyone chased the semis. So guess what? The semis and the mega caps, they're still crowded trades. Mm-hmm. They're still being held at overweight positioning. And that's why you have to be skeptical in terms of positioning needing to be unwound, that these companies will not see further corrections.
How vulnerable then, Steph, is a Broadcom?
Oh, absolutely.
How vulnerable is a Lam? How vulnerable are any of these names that helped the SMH to its best year in 20?
There's no question. Everybody's on the same side of the boat right now with all of these names. There was massive chasing going on because there was massive portfolio management underperformance. And so everyone was really kind of just jumping in. I think that these stocks take a breather. I think we all have to figure out, is there double and triple ordering happening? That is a big question in my mind. And so could we see bucket filling kind of thing? Sure, absolutely. Could these stocks correct 10, 15%? Sure, they're still up massively from last year. And so I don't have a problem taking profits. I don't have a problem taking profits in a Broadcom because I've made a lot of money. But that valuation is very reasonable to me, 23 times forward. And their AI business is going to, they've guided anyway, to go from 10% total revenue to 25% in the matter of 2 years. And so they obviously see the demand, but that's the question. Are we getting, or are they getting, double and triple ordering? On Lam, totally different animal, in my opinion, because wafer fab equipment spending doesn't really necessarily have 100% to do with AI. A lot, some of it, obviously, but wafer fab equipment, we're hearing from the spending, we're hearing from all kinds of companies. We heard from Micron just a couple of weeks ago that it's bottoming and that numbers are getting revised higher. And that stock also, even though it's re-rated higher, it's still only at about 28 times, I think very reasonable. On a pullback, I'm much more inclined to add to both of those two, but I have no problem taking profits. And if you need the cash to buy some of these other names that are starting to outperform, meaning the broader market at large.
Bryn, I got to hear from you on NVIDIA. I mean, you've been in it a long time. You were early in it. What about that note and that question? What if AI is just another cycle? Implication being like, yeah, there's so much hype. Nowhere was the hype more acute, you could argue, than NVIDIA. But, you know, what if these expectations are unlikely to materialize as they ask?
So to think about hype, you would think that there's nothing behind it. So as I said earlier, NVIDIA had 118% revenue growth for calendar year 2023. So to call it hype, to me, you must have, or one must have never listened to Satya, to Mark Zuckerberg, to Lisa Su, to Jensen Huang, who all listen to.
You can be overhyped,
right? But I'm saying the spending. Well, I'm saying the spending is matching the narrative. And so if you look at Microsoft and Meta are the two biggest buyers of GPUs right now. They obviously see a long runway where they're trying to monetize that. Obviously, Microsoft's trying to monetize that right now with Copilot. But I just think that this is going to be a long 10-year spend. Jensen thinks it's going to be $1 trillion of data center rebuild that happens over a decade. So yeah, does it happen just in 1 year? No. Can, to your point, or the notes point, the stocks get too ahead of themselves? Sure. But I think trying to time that and be cute about it is tough. So, I mean, from a positioning standpoint, I continue, once NVIDIA right now gets close to 500, like right now I'm in the March 550 calls, which I got close to $20 on. That to me is a great way to play that right now, as the market, to his point, has not wanted this stock to get over 500, and it shuts it down every single time. But I think that this is not hype when you have the three biggest companies in the world buying billions and billions of these GPUs.
Yeah, Steph, you know, a key question is undoubtedly going to be at what level, forget the multiples, but the prices, just price coming down in some of these names, attract buyers. Alphabet, now green. Joe just pointed that out. Microsoft, now green. We'll see if it lasts. But you have to believe that at some level, believers are not going to let these stocks go down too much.
Sure. So I'm inclined actually to sell the rest of Apple. So just, I know you didn't ask, but I only own a 50 basis point position. I would be more inclined sell that because it's too expensive for what you're getting in terms of growth. You're not even getting growth in their iPhone business, which is 50% of their total revenues, and services is about to start to decline and decelerate. So that doesn't make any sense. I take my money and I put it elsewhere. What name would I actually? I'll go right back into Meta, but it would have to come down, I don't know, like 20, 25%. Because I still like it, but it was up so much last year. It had such a re-rating. It went from 13 times to the peak of 23 times. I know revenues have went from single digits to double digits, but a lot of that is priced in. So come down maybe on a quarter that disappoints. Maybe if we get a big reaction, I go back into that one.
Well, speaking of big reactions, I wonder what we're going to get today at 2 o'clock Eastern time. That's when the Fed minutes are released. Generally not that big of a market mover. Steve Leisman, let's bring him in, our CNBC senior economics reporter. But this time may be a little different because of where the market has decided that it's gone. 6 cuts are baked in now. The average Fed official only has 3. So what are we going to get this afternoon, do you think?
Well, I think I expect the minutes to underscore the commentary, Scott, that we've gotten since the Fed meeting, which is that Fed officials are essentially trying to rein the market back in. Bring it a little closer to its side. So I don't know the extent to which we get, strong language in the minutes to that effect. But I think the market, if it's looking for a date that cuts will begin or looking for a higher amount of cuts out there, I don't think it's going to get it today. I think it's going to be something where it will be a reality check. It shouldn't be a surprise to the market to the extent that all these Fed officials have been out there saying, no, not quite so fast, not quite so much. That should be the tenor of these minutes, but you just can't be sure how the market's going to react when it sees it in black and white, Scott.
Sure, but I mean, look, Barkin, cuts depend on inflation easing. It's like, yeah, we get it, but just the mere fact that, we believe that cuts are on the table as long as the data cooperates.
That's the case, Scott. The market was given an inch and it forecast a mile, I guess is the best way to put it. Barkin was, I think, reflective of where the center is. He might be a little bit on the hawkish side, but he's saying, you know what, we didn't take rate hikes off the table at the last meeting, and they're not off the table right now. So it's all going to be determined by the data. Continued progress on inflation is something that could allow the Fed to cut. There are those out there, Goldman Sachs, who thinks that, this will come in March. That's the way the market's priced. If you look at the 73% probability of a rate cut come March, and then the trouble becomes, Scott, when you look down the road. And that's where the differences seem to widen up. The market has something like 150 basis points of rate cuts built in this year. Look, there's still time for the markets and the Fed to come together, and maybe they meet in the middle, or maybe one side goes all the way over to the other. But ultimately, there's going to need to be continued progress on inflation for the market to be right. And I think the Fed has this view that these numbers don't come out in a straight line and don't behave in a linear fashion. So I think that there may be sort of sided a little bit with the Fed on this, that there's going to be sort of obstacles along the way here.
All right, we'll get some clues, I suppose, in a little more than an hour. I know you got to get over to the Fed, so we'll let you bounce. Steve Leisman, thank you very much, as always, for joining us, our senior economics reporter. Joe, I don't know. You know, hikes do feel like they're kind of off the table, irrespective of what they say. It feels like they took them off the table, they put them back in the pantry, they pulled out the cuts, put those on the table. It's just a matter of how many you may get.
Right, and how soon you get them, I think, is also incredibly important. Look, I think at some point, and I think it's probably in the first half of the year, I think we're going to be talking about some form of a growth scare. I think the consumer is going to bend. And I think at that point, you know, the reality of when you're looking at your portfolio, where do you want to add risk to? It's probably a little bit more compelling to think about the bond component of your portfolio than equities once you get that scare.
But what you bought personally, you already owned Interactive Brokers in the Joe T.
Yes.
Now you bought it personally.
Well, as I said at the beginning of the show, I'm a believer when you have this type of corrective activity, you have to have a shopping list, you have to have things that you want to buy. That doesn't mean that I'm dismissing the reality that there's probably further downside ahead for the market. But Interactive Brokers is a company that is benefiting significantly from an increase in trading activity, largely because there's been this overall improvement in the capital market environment. It's a company that has an incredibly strong acceleration in revenue growth, not only over the last several quarters, but really over the last 8 quarters. It's a company that was priced up at $95 back in September. It's here down at $85. I think it's a great way to enter the market on the belief that there's going to be continued strong capital market activity, and I see that coming as we move through 2024.
Okay. Bryn, you have a take on that before we take a quick break?
Yeah, I think that's great. I mean, Interactive Brokers, I think you could also do CME. I think if you have more volatility, more trading this year, IBKR or CME is another really good platform to take advantage of that trading take advantage of the higher level of trading this year.
All right, we'll step away for a couple minutes. When we come back, more stocks on the move today. Got a bunch of analyst calls on the committee ownership list. We'll get trades on Roblox, United Airlines, Schwab, many more. We're back in just 2 minutes. All right, let's do some analyst calls now. We're starting, Britain, with Roblox because MKM names it a top 2024 pick. Buy rating, target 50. In our view, 2024 marks the start of a 3-year period where Roblox can achieve a 20% bookings CAGR, along with 100 to 300 basis points of annual adjusted EBITDA margin expansion. What do you think? You own it.
This is like the little engine that could. I've seen like 3 or 4 upgrades over the last quarter. This is in that same basket of these small cap growth names. I think it's down about 10% over the first 3 days for no reason except people are just selling these names. Here's what you want to wait for. This stock broke out above 40. It had been stuck between 30 and 40 for most of the year. Now it's broken out above 40. If it can stay above that during this level, I think it's going to continue to have legs to trade higher to that 50. But once again, this company doesn't have earnings. The bookings grow, the daily active users grow, but I think you want to see a path to profitability before it can sustainably get towards 50 and stay above that.
Okay, United Airlines, Joe. Citi, positive catalyst watch on that one. Although demand from lower-end consumers might start to recover while the easiest transatlantic comps are now behind us, we see little risk of network airlines losing their operational edge over discount carriers this year. Underperformance looks overdone. They look at United shares versus, say, JetBlue and Frontier. You own this. What do you think?
I think fundamentally, as I said, when the strategy added Delta and United Airlines at the end of July to the JOTI ETF, there was nothing fundamentally that I would identify that got me excited about being long 2 airline names. It was all about momentum. That was the reason behind the addition into the ETF, and it ultimately will be the deciding factor as to whether at the end of January these 2 names stay in the ETF. There has been nothing fundamentally that I could recognize that changes that narrative. There has not been a significant improvement in the balance sheet. There has not been a significant improvement in terms of the revenue growth. Overall, I've always thought of airlines as nothing more than a trade. I think a lot of people in the show have also mentioned that. And I think there's a lot of challenges ahead for the airlines in 2024 in an environment where the consumer could continue to bend.
All right, Steph Schwab. Goldman downgrades it today to neutral from buy. What do we think? I mean, Piper mentions it as a top idea, so conflicting views from a couple of the firms on the street. But what about you? Because you own it.
It's my top idea in financials for this year.
It is.
There's no question about it. The stock is still down 17% from a year ago. It is up 43% from its lows. So if you want to take profits, again, fine. But I still think there's more upside. I think that if you have a little steeper yield curve, that'll help cash sorting. That's number one. NNA is actually on the rise. Last month, NNA, net new assets, grew 3.7% for Schwab versus 1.7 the month earlier. And I think their goal of 5 to 7% this year is going to be obtained, maybe not until the back half of the year, but it will happen. And I also think the Ameritrade acquisition, it has a lot of legs to it in terms of synergies on the cost side, on the revenue side. And I think that they can do something like $5.25 in earnings power in the next 2 years or so. That puts it at 13 times forward. I just don't think that it's a commanding valuation and a top-notch management team.
All right. Money center banks, the big ones. Wolf likes JPM. Your JP Morgan is their top pick. Had a great year. The stock did up better than 23, 24%, something like that in 23. What do you think?
I think you stay with JP Morgan. Go back to March. What did they do in March? They were able to acquire First Republic when everyone else we know wanted it, but JP Morgan was in the best position to take it from the government. And it's very similar to what they did in 2008 with Bear Stearns and Washington Mutual. They've invested heavily in technology. There is no other money center bank on the street who has invested in the technology like JP Morgan has. I think in 24 and 25, we're going to see the benefits of that and the First Republic.
I would say Bank of America has done a great job in terms of investing in technology. $10 billion over the last decade. That's nothing to sneeze at.
I'm coming back to you for Sherwin. Bear downgrades it.
Another downgrade.
Right, to neutral. Well, they say...
They hate my stocks.
No, you always focus, like one of the main things you focus on, margins.
I do.
Right? Talk about it all the time.
Yep.
They say cost-driven margin expansion is largely played out and is priced in.
I don't think that's the case. I mean, I know the stock's had a nice run. It's up 26% on that whole margin recovery thesis, but I think they have pricing power. In the meantime, they're taking market share. I think they're going to grow double-digit total revenue growth. And if I do think like kind of what the earnings power is over the next couple of years, $12 or so, that makes this at 23 times forward. And I don't think that's very commanding for a #1 leader and a play on housing, which I am bullish on.
Last but not least, Rockwell Automation. UBS takes it to buy. The secular laggard poised to catch up. Target 360 from 305. You own that.
Yeah, we do. It's in the ETF. This is an absolute quality company, reasonable valuation, strong revenue growth, great balance sheet. I think the cycle might be a little bit more delayed than is being cited within this report. I think when you're looking at automation, there are some headwinds ahead. But I think as you move through the second half of 2024, this is a company that you want to own because those headwinds will begin to dissipate and you'll see the tailwinds.
All right, let's get to Bertha Coombs, who has the headlines for us today. Hi, Bertha.
Hi, Scott. U.S. national debt just hit a new record. It surpassed $34 trillion, according to a U.S. Treasury Department report. It comes as the U.S. faces the threat of another government shutdown. Congress has just weeks to meet a deadline to agree on a new federal funding plan. 2023 was the busiest year for air travel, but it was also the lowest rate of flight cancellations in at least 10 years. That, according to a new report from the Department of Transportation. Cancellations were below 1.2% out of a total of 16.3 million flights for the year, while during the holiday season, we saw less than a 1% cancellation rate, even with a record number of passengers flying. We had fairly good weather. Meantime, NASA released images from its spacecraft Juno in the closest ever approach to Io, one of the moons of Jupiter. The spacecraft flew within 930 miles of the moon's volcanic surface. It's one of the 95 moons orbiting Jupiter, and according to NASA, has volcanic eruptions so intense they can be seen by telescopes on Earth. Juno has been circulating Jupiter since 2016. And Scott, now I have drops of Jupiter by train running through my head.
All right, you go ahead. Bertha, thanks. Bertha Coombs. Up next, get ready to expect the unexpected because the committee is laying out their top contrarian ideas for the new year, including the one stock Steph has her eye on. We'll debate them next.
CNBC.
All right, new year. We need new ideas, which is why we want some contrarian plays from the committee. Bryn, I'm going to you first. What's your top contrarian idea for the new year?
Okay, so I'm going to talk to China. So we will not be making this trade, by the way, but I think in the spirit of the question, it's a really good concept to walk through. When they kidnapped Jack Ma, we said, thank you, but no thank you. Here's what the deal is. China, as we all know, is a complete dumpster fire. They have huge unemployment. We have a Taiwan election this year. The K-Web hit a high of 100 back in February of 2021. It's around 25, 26 bucks right now, on top of our election. So there's a million reasons why China should continue not to work, but that's the spirit of a contrarian trade. Maybe some things can go right.
Yeah, why aren't you making it, though? Right? I mean,
I don't believe, like literally, Scott, when the CCP kidnaps one of the most innovative CEOs of all time, he goes away, and then you're required to have these big companies must have a member of the CCP on their board. That just stifles innovation. So I just think there's a structural problem with China because of that. How can a company grow when you have a communist regime sitting on the board? So that's why we're not just like, it doesn't make any sense to me. But it's a cheap space. China's a very important country. It's the second largest GDP next to the US. And so from a contrarian side, you could have some things go right, but we are not going to participate when you have that element of stifling of innovation within such big companies. It just would not be a trade we would enter into.
Steph, give me a contrarian play that people should consider making.
Yeah, it's one that I'm considering making. It's in housing. I do think interest rates are going to fall throughout the year. 30-year fix has already fallen from almost 8% to 6.7%, 6.5 on average, actually. And that has actually we've started to see housing starts improve, up 15% last month. Single-family starts and permits were up 18% each last month. And I think that momentum will continue off of very, very low expectations. Home Depot has lagged. It's only up 10% in the past year. But they've done a pretty good job in terms of profitability, lowering their inventories. Pricing has been under control. They have a $500 million cost program that will buffer margins this year while we wait for demand to come back. And I think demand will come back because for the last year and a half, they've had to deal with the COVID overhang. And so we've had 4 straight quarters of negative comps. I think we're nearing the end. Is it this quarter? I don't know. Is it next quarter? Possibly. But I definitely think second half of the year, we're going to see better momentum on the comp side, and they have very easy comparisons as well. And so this is one that is definitely on my radar, so I just need to figure out my cash situation.
Okay.
Stay tuned.
Oh, I'm gonna make you spin yours too. I want a contrarian play that you would make. So what's something actionable for our viewers from a contrarian standpoint is what?
So
because you said firm landing,
right? And firm landing implies.
Is that what you believe?
Yeah, I do. I think firm landing implies it's something in between soft and hard.
Okay, so give me then a contrarian, actionable contrarian.
So I think
play
what
around
happens in a scenario where you have a firm landing, and I think we're really going to get that moment of feeling that that's what's unfolding at some point in the first half of the year. I think in that environment, the Fed comes to the rescue, and the first place I would look would be at corporate debt. I would look to buy something like the LQD. I would look to buy something like even the HYG. I would buy high yield debt. I would buy investment grade debt. And then I would also say to the viewers who have this on-off light switch approach to positioning with the mega caps, I think you're going to appreciate that you still own the mega caps in that type of environment. And I think one name that stands out above all the rest, we've already mentioned it on the show, I'm looking to personally buy Alphabet. I think Alphabet will benefit you at that moment. Alphabet clearly is trading with relative outperformance to the other Mag 7 over the last week.
Yeah, it is. Over the last week, it is down, but it's not down quite as much as some of these others, so you make a good point. All right, coming up, top picks in biotech as well. The committee laying out their favorite names in that space. Are these stocks going to have a better year this year? We'll debate it next.
Are you following the Halftime Report podcast? What are you waiting for? Look for us in your favorite podcasting app. Follow the Halftime Podcast now.
Asset.com.
Our senior markets commentator, Michael Santoli, sitting at the desk. We talked yesterday about this appetite to buy the dip in the mega caps.
Yeah.
When you would start to see it materialize. Well, maybe it is in a couple of names, Alphabet and Microsoft.
Yeah, I guess it was a one-day wobble. And really, we should dial it back to the end of October, where you did see the relative performance start to change. Yesterday certainly felt very kind of forced and mechanical about this. I mean, the models would say, let's go into the lesser-owned laggard areas. Mega caps seem like there was deferred pent-up selling. So, yeah, you're seeing a little bit of a bid there. The other thing I would keep pointing out is that of those 7 stocks, none of them are at a peak valuation. I mean, they're all below where they traded relative to earnings 2 years ago, 2+ years ago. So it's not as if they somehow, just because they were dominating performance for 10 months last year, are way, way, way out on a limb versus where they have been fundamentally. I think what's interesting to some degree today is, you know, the good inflation number in November, which was for October, released the market to treat good news as good news. Right? Inflation, we have confidence in it. Therefore, we want to see the economy do better. Vice versa, too. Because the JOLTS numbers, you're seeing nice disinflation numbers, but also is the labor market wobbling a little bit. So you see discretionary pullback on an equal weighted basis. You're seeing the industrials, the Russell 2000's back in its old range. It cracked a couple percent. So, you know, we're having a gut check on that trade. At the same time, Atlanta Fed revised higher, you know, for the fourth quarter. So nobody's saying the economy's falling apart. It's just we priced ourselves for, you know, no challenges to the perfect path of a soft landing.
Looking at the 10-year, you know, got back at 4, a little bit above that, and now
and then it rallied on the JOLTS and ISM.
And so the 10-year, the yield is now at 393.
Yeah.
Now, you know, an hour and 15 minutes from now, you're going to get the minutes.
Yes.
Now we're going to see what the temperature is when we have to, you know, digest a little of that.
It's going to tell us the starting point from which this latest round of the Fed debate began. You know, we had Powell's version of what they discussed in terms of rate cuts. Now you see in the minutes if it was a real discussion or if they're going to look for excuses to prolong the pause.
All right, I'll see you in a couple hours on Closing Bell. That's Mike Santoli coming up. A healthy start to the new year. Today's best performing stock in the S&P 500 is a biotech name, and it just got crowned a top pick at Bank of America. Even better, Joe owns it, which is why we trade it and debate it next.
time to waste.
All right, welcome back. Told you earlier about Steph's new buy of Bristol Myers. Well, another large pharma stock getting some love today. Eli Lilly named a top biopharma pick at Bank of America. Joey, you own that.
Listen, they are sitting in a position where, as it relates to GLP-1 drugs, they literally can dominate the market in 2024 and 2025. And that is what has driven the stock in terms of price performance. I've said on the show in the last several months, it almost trades as if it is a biotech company. And to a certain extent, the type of revenue growth that it's delivering, it's warranted to trade as a biotech. Over the last 36 months, you're talking about this company having 8% revenue growth. However, in the last year, 28% revenue growth. In the last quarter, 36% revenue growth. They're in the middle of a very strong momentum period, technically and fundamentally, and it's the reason why we reestablished the position in October at 550.
All right, it is the healthcare is the strongest sector over a month. Now, it's done a lot of it lately over a week. It's gotten 2%. Bryn, so Wolf today of healthcare says very quietly healthcare at 2-month relative highs. One of our favorites, since we were talking Contrarian a minute ago, one of our favorite Contrarian views. We continue to like the sector's prospects after getting smoked last year. The question is, do you?
Yeah, I mean, outside of Novo and Eli, the space just did not participate last year. You know, I own AbbVie, which, you know, talking about Steph's Bristol Myers, you know, AbbVie just in the last quarter did $20 billion of acquisitions, yet they still have a free cash flow yield of like close to 8%. And so I think that, are we late cycle, early cycle? If we are late cycle, you know, healthcare staples and utilities tend to do best. And I think within healthcare, you have more of this GARPy growth at a reasonable price, where you can have these companies with really high free cash flow yield acquiring new verticals, while you still have that more defensive play. So I love healthcare going into 2024.
Steph, what about you?
So we talked about it earlier. Bristol, I'm excited about. I'll slowly build
broadly?
that.
More broadly than JJ, Bristol, you know, things like that?
It's smaller for now. So, you know, because I think it's going to take a while for us to see the revenue growth, the earnings growth that I talked about with these products in the pipeline. But I like it. I like it a lot, and I will be building it throughout the first quarter. J&J I like a lot, and that's one that I think is really at a great value. 15 times earnings, 3.1% dividend yield. They have increased their dividend 61 years in a row. The stock was down 11% last year. I like spins, Scott. You know that. They spun off Kenvue. So they have pharmaceutical, and they're going to grow. They've got a great pipeline, especially in cancer. And then the med tech, they keep on making M&As. The other two names, Zimmer and GE Healthcare, I still like an awful lot as well as utilization rates increase. So, yeah, I mean, I like healthcare, especially, again, the mean reversion theme into the beginning of the year.
All right, we'll take a quick break. We'll come back. We're going to trade two of the day's biggest winners, two of the day's biggest losers. We'll do them next.
According to CoinDesk, Goldman eyes Bitcoin ETF roll via BlackRock and Grayscale.
Protect your trades from macro headline risk with Financial Juice Pro. Now only $99 a year for our real-time service.
50% off.
I want to highlight two big winners and two big losers for you. Maersk today got a Goldman upgrade. Stock's up 4.5%. So we're keeping our eye on what's happening over in the Suez disruption, of course. And there's Marathon Petroleum as well. Take a look at that one. Energy is the only sector higher today, at least it was. Healthcare popped positive too, I think. But you own Marathon.
I do.
Comment on that?
Yep. Get ready for a record high. That's what's coming for this company. For the entirety of 2023, when energy equities were underperforming, this was one of the leading energy equity names. As it relates to downstream, they are in the sweet spot. And if you don't believe what I'm saying, the analyst community thinks this stock has a price target of 165 on it. It's 156 today.
All right. The losers we want to highlight today. SoFi is down 13.5%. On a downgrade today, and the Grayscale Bitcoin Trust is down. Bitcoin retreating a bit. Bryn, after the best performing asset class of last year, what's your take here as you own GBTC?
Yeah, I think that what you see, especially on some of the decentralized exchanges, there is a tremendous amount of leverage via derivatives in the crypto market. And when these exchanges allow 10, 20, 30 plus times leverage, when they get to a certain level, you have big selling, you get sold out. And so I believe that's really all you had here across the board is some de-levering when these exchanges got to the max level. So I think it's really nothing more than that. I still think people think that we're going to get an ETF at some time soon, which will reduce, obviously, the friction to buy and sell at much cheaper prices.
All right, we'll step away. We'll come back. We'll do finals next. We're going to kick this market around. Closing bell, 3 o'clock Eastern time. Josh Brown, Anastasia Amoroso joining us, as is Roger Altman. Get everybody's take on what's happening in this market, which, by the way, Joe, as I give you final trade, is rallying a little bit. Dow's off the lows. Russell's getting hit a bit, but NASDAQ's coming back a little bit.
NASDAQ's coming back. S&P's coming back.
What do you got?
What I have is there's a technical formation. It's called I missed it. And that's exactly what happened to me in Merck. At the beginning of the year, I identified Merck as one of the names that I wanted to own. Came into the year trading below 109. Here it is, 115.50. Merck's going a lot higher.
All right, Stephanie Link.
Gasoline prices look like they're falling below $3 a share. I think that's positive for the consumer. The low end, McDonald's should be a beneficiary, especially given their digital strategy. I expect total revenues to increase and accelerate this year, as well as better margins.
Bryn.
Free cash flow yield's one of the top screens you can use. Pacer Cows had a good year last year at 14%, has a free cash flow yield close to 9% right now. You'll own AbbVie, Bristol Myers. Great trade for 2024.
Thank you. The exchange is now.
Thank you, Scott, and welcome to The Exchange. I'm Kelly Evans, and here's what's ahead. Stocks are falling again, with the NASDAQ yet again the worst performer after its worst start to a year since 2016. Is weak data the culprit? Manufacturing activity did contract for the 14th straight month. Job openings came in at their lowest level in nearly 3 years. But earlier, the Richmond Fed's bargain left rate hikes on the table, and the 10-year yield was briefly back above 4% again. We'll try to figure out exactly what's ailing this market. Fed minutes also loom top of next hour. And another cargo ship attacked on the Red Sea overnight, bringing the total to 24. Our expert says the U.S. will almost certainly decide to attack Houthi targets in Yemen as fighting across the region intensifies. We'll talk fallout for energy prices and the global supply chain. And we're watching Microsoft getting closer and closer to surpassing Apple's market cap for the first time in a couple of decades. So is tech in trouble, or is the leadership just shifting? A top analyst weighs in. Before all that, let's get to Dom Chu, though. He's got the latest on these markets, and we've lost steam throughout the session today, Dom.
We have, and we are sitting right there now, though, just in the middle of the trading range, at least for the broad S&P 500, which currently sits at 4722, down roughly 0.5%. Again, right in the middle of the trading range so far today. The Dow Industrial is down about 0.5% as well, 37,569. The last trade there. And the NASDAQ Composite at 14,662, which is, again, as Kelly mentioned, the underperformer on the day, down nearly 0.75%. Kelly also mentioned some of the Middle East tensions, the Middle East issues happening because of what's happening in the Red Sea, the Suez Canal region. All of that, in addition to U.S. interest in refilling the SPR to a certain degree, 3 million barrels or so, is propelling oil prices for U.S. benchmark West Texas Intermediate WTI crude's up about 3% now to $72.57. And we're sitting just at about, from these levels, $95 to where we are here, roughly about 24% to the downside. So we'll keep an eye on that move in oil prices and whether there's sustained movement higher in some of those prices. And then the technology trade is fairly thematic with regard to the underperformers today. Enphase and First Solar, the two new energy, renewable energy stocks that are really facing some downside. First Solar and relative outperformer after analysts at Mizuho call it their top pick in renewable energy. Enphase is down 6%. Meanwhile, on the semiconductor side, onsemi, Skyworks, Qorvo, some of its chip names that have been talked about as part of Apple's supply chain, still kind of reeling from that big downgrade from Apple yesterday by analysts over at Barclays. That's having reverberations today. So those chip stocks, among those down nearly 2 to 3%. So keep an eye on solar stocks and those chip stocks tied to Apple. Kel, I'll send things back over to you.
All right, Dom, thank you very much. Is bad news again for the market? Manufacturing activity and job openings remained at lower levels in the latest data this morning. And we'll get more clarity on the Fed's thinking from that last meeting, which had those dovish rate hike projections when their minutes come out at the top of the hour. Steve Leisman is at the Federal Reserve with more. Steve, what do you make of it all?
Well, we got the soft landing scenario this morning. Kelly got a little bit of help from the economic data with a decline in job openings and the quit rate, along with the manufacturing report showing easing inflationary pressures. Take a look at the data. The ISM manufacturing, it was up 0.7 to 47.4, but it's the third straight month it's indicated a contracting economy that is below 48. ISM, the index, though, the price index, it declined, and so that's a good measure for the inflation outlook. Job openings, the Fed looking for easing in the labor market, did get a little bit, 8.79, lowest level since March 21, but still well above the pre-pandemic level of around 6 million. The quit rate at 2.2% also declined back more towards normal. Now, Richmond Fed President Tom Barkin this morning, perhaps giving a preview of what those minutes are going to say. Yes, cuts are penciled in, but no, they're not guaranteed and may not come as quickly or as extensively as markets expect. Yeah, Barkin saying a soft landing is increasingly conceivable, but not inevitable. There's a potential for rate hikes remain on the table, and cuts depend on inflation easing. About that, he said, well, weaker demand or more Fed hikes may be needed to bring down inflation, and the recent decline in yields and the rise in the stock market It's going the wrong way. It could stimulate demand. So he's a little bit nervous. Markets, unfazed, trading with a 74% probability of a March rate cut. They priced in a quarter-point hike at most meetings after that. So the January 25 contract, that's the one we look at for the full year, shows 6 full cuts baked in with that current yield of 3.84. That compares to the average Fed official who's baked 3 rate cuts into their forecast. So like Barkin, most officials have leaned against the market's aggressive pricing, but to little avail. The minutes, maybe they'll do this. They'll do the same, and we'll see if it has any impact at all, Kelly.
We'll see. Steve, stay with us. So my next guest is in the camp that thinks the Fed won't cut as much as expected this year. Mike England joins us now. He's chief economist at Action Economics. Mike, I mean, it is fairly common for us to hear people saying, no, the Fed's not. I don't know. Maybe we'll continue to be surprised by this disinflationary impulse, and they will cut in March, like Goldman thinks. Why are you not in that camp?
You know, that certainly is the hope. If you think back to last year at this time, we ended December of 2022 with a pretty distinct downtrend in inflation, and the markets really got excited about that, really didn't follow the lead from the Fed. Turns out through seasonal adjustment changes and then some ugly inflation numbers for January and February, by the time we got to March, the downtrend in inflation was still evident, but not nearly as steep as seen at the start of the year. Here we're sitting in kind of a similar situation. We are assuming that there's going to be a continued downtrend in inflation, but there's risk in January, for instance, that big minimum wage hikes in quite a few states, like 20 states, are going to be hiking minimum wages. That's going to have an upward impact on the wage data. And if we get some bad luck on the core numbers, we could easily completely quash a lot of this market perception of this string of easings. I think the Fed's probably got it right in looking for 75 basis points in cuts. Since they revised their economic outlook 4 times a year, we assume they'll skip March, which is the next time, and start their cutting sequence in June.
Yeah. I guess the question then is, how the market is likely to react to that. Not that that's what you have to think about one way or the other. But what do you make of the kind of weak trading action to start the year off? And Mike, you know what I mean? In the data, I don't know, you could look at it as maybe it was good, maybe it was not so good.
I think the market really got ahead of itself. If you look at the drop-off in mortgage rates, it started in the 3rd week of October. That's when we hit the peak. It's exactly the same as last year. In 2022, mortgage rates peaked in the 3rd week of October. This time they dropped pretty dramatically into year-end. Stock markets rallied quite a bit. I think the market just has gotten ahead of itself. The overall outlook is good. I think the prospects for inflation slowing through the year are positive. It's just that they're pricing in too aggressive a move, and I think part of the reason why we've backstepped a little at the start of the year, aside from the problems we're seeing in the Red Sea and the uptick we've seen in oil prices. Beyond that, I think maybe the market's just catching its breath.
I heard Steve, our friend David Kelly, talking today about how, especially if things like auto insurance prices drop, we could be back to 2% on core PCE. But then I'm seeing stories this morning about, home insurance rates going up and car insurance rates going up. So maybe that prospect is maybe that's not going to happen the way people think.
Yeah, and let me give you, Kelly, a little behind-the-scenes reporter stories here. Mike and I have been talking over the past several weeks about what happened last year, and we've been trying to get the data together to show this. But to make the long story short and less complicated than it needs to be, the Fed thought that the market thought that inflation was coming down pretty strongly at the end of last year and the beginning of, the end of 2022 and the beginning of 2023. That was revised away, and plus we had a little uptick in inflation in the beginning of the year. So it was a bit of what Fed Governor Waller called a head fake. Now, Mike has some good reasons that we've been talking about why that may not happen again, but the important point from that is that markets seem to be priced for this linear movement in what is essentially a very volatile, nonlinear series. So I'm a little bit concerned about that you could get a pop in the CPI or the PCE, and it may not mean anything in terms of the overall trajectory, but it would be something that could really cause markets, which are all the way on one side, to have to adjust.
And we were talking about that a little bit yesterday, Mike. But even if that's true, even if the CPI readings come in sticky for a couple of months' time, do you think anyone would interpret that as a serious problem for the Fed? In other words, do you think they would change their trajectory if the inflation reading is half a point higher than we'd like it to be?
I think the Fed is pretty well positioned to stay its course. It's got a 75 basis point cutting path for 2024 and 25, 100 basis points. So basically, with each quarterly SEP or revisions to the economic forecast, they can cut, and then another 75 after that. If you look at that broad picture, their forecasts for inflation are actually kind of pessimistic. They plugged in some pretty high inflation numbers, a very gradual reduction. So I think if we do see some backtracking with the inflation numbers, it's actually already marked in by the Fed into their official outlook. And so I think they actually have a pretty solid path here as long as the economy stays strong. Obviously, if the economy starts to weaken more dramatically than we thought, they may want to react to that. But if growth continues, taking a slow and careful approach to cutting rates is probably their best path.
Do you think, Steve, it's fair to kind of boil this down to the market wants the Fed to do victory cuts, not cuts in defeat?
That's a great way to put it, Kelly. I hadn't heard that before. I think that's exactly right. In fact, Powell even talked about that at the last press conference when it comes to relative to whether the Fed would and how it might end quantitative tightening. It depends on what's going on in the economy. I think that is a definition of a soft landing. It's one of the critical ones, that the Fed ends up cutting rates because the economy is relatively strong, but that inflation has come down and the restraint is no longer needed.
Yeah, that's Dave Zervos' line. It's still his base case that we're cutting from a good place. It's a good one. Gentlemen, we'll leave it there. Thank you both. Steve, we'll see you next hour. For the minutes, our Steve Leisman and Action Economics' Mike England. Meanwhile, more cross-border fighting in the Middle East, pushing oil prices higher today and spurring OPEC Plus to announce a monitoring meeting on the 1st of February. This follows Iranian reports of explosions at an event honoring one of its generals killed 4 years ago in a U.S. airstrike. State media reporting at least 103 people have been killed, calling it a terrorism attack. Lebanon's Hezbollah and Russia's Putin both condemning the incident, with Putin sending condolences to Iran. On top of all of it, Iran-backed Houthis attacked a 24th container ship on the Red Sea overnight. And my next guest says the U.S. will very likely decide to attack Houthi targets in Yemen in the next week or two. Here now is Amrita Sen. She's founder and director of research at Energy Aspects. And Amrita, welcome. Put that into context for us. How would the energy markets take it if those strikes do happen?
Look, I think so far as well, we've seen that with both the Red Sea and just generally geopolitics, we haven't seen prices react much, in part because fundamentals are softer for crude right now. We've seen some inventory builds towards year end, and that's why the market just isn't sensitive to this. Even if there are attacks, we're not expecting any oil supply losses on the back of it. And I think the market is going to really look for specific supply disruptions that actually helps tighten balances before we see a significant increase in prices.
And to that point, I guess the larger question is what it would signify for the Middle East more broadly. So we've seen this escalating tension even as the oil prices remained relatively calm.
Mm-hmm. Yeah, and I think you could argue that, our oil prices just not reflecting some form of geopolitical risk premium. It isn't right now. And is that fair? I think the challenge we have right now is that crude demand seasonally is weaker because refineries undergo maintenance at this time. Product markets are tighter, and I think that's kind of where the imbalance is right now. But what we are likely to see, and once you kind of start to realize that inventories are still relatively low, especially versus this time last year. And if we start to get supply disruptions, then you are going to get the markets kind of paying more attention to these attacks in the Middle East. And you've already seen a lot of ships divert. It just means you're going to tie up shipping on much, much longer routes, which ultimately means Asia has to pay a higher price, consumers there. And it does affect inflation overall.
Yeah, another headwind for China, perhaps, or for the region. I'm curious, so if it's the case, as I saw an analyst put it earlier today, that the Houthis rule the Red Sea right now, what more is the international community going to have to do to get a passage back and normalize supply chains and help with oil prices and all the rest of it?
Well, I think it's a great question because we just haven't seen, even with U.S. carriers attacking and destroying some of these Houthi ships, that the counterattack, or rather the attacks from the Houthis, have stopped. If anything, they continue as well. So I'm not expecting a de-escalation in the Red Sea anytime soon. And I think that's where the real risk lies, is that right now the market's quite complacent to things. It has a lot of inventories, but these things don't take a lot of time to turn. And if you do get any kind of disruption, which is already causing quite a bit of diversion for these ships, we're just going to need prices to go up even further to actually reflect what then would mean a pretty significant tightening in balances. Again, I'm not saying it's happening right now, but there is a risk that that does happen.
Yeah, and in fact, there was just a joint statement put out by the UK and 11 other countries saying we call for the immediate end of illegal Houthi attacks against commercial vessels transiting the Red Sea and the release of unlawfully detained vessels and crews, saying the Houthis will bear the responsibility of the consequences should they continue to threaten lives, the global economy, and free flow of commerce in the region's critical waterways. This is an extremely strongly worded statement, but statements aren't going to amount to much.
No, and exactly.
Shortly expecting results from the Fed reverse repo facility.
Carriers or boats being destroyed, and that hasn't deterred them whatsoever. And if anything, we are seeing continued attacks on vessels that are still going through the Red Sea. If anything, I think what you're going to see is more and more Western companies just saying, look, yes, we have to eat the cost, but we are just not willing to send our ships through that route. I think that is the real outcome right now, unless and until you see either a de-escalation or one way or the other, this kind of situation getting sorted out.
And if it's correct to sort of substitute Iran every time we see the word Houthi, if that's where the funding is coming from and perhaps the direction of activities, then is the U.S. at some point going to respond to all of this provocation by levying more sanctions on Iran and affecting its oil output in a way that could maybe have a bigger impact on the price of energy?
That's a great question. And I think one of the challenges the U.S. faces right now is that the bulk of Iranian oil, illegally, of course, is going to only one country, which is China. The companies that are buying this Iranian oil are actually not even a part of what I would call the global financial system. They don't transact in US dollars. So what if you sanction them? It doesn't really affect them. I think it's fair to say that the US administration had turned a blind eye towards Iran raising exports last year. That's why Iran managed to raise exports by about 700,000 barrels per day. So even if you were to see a significant tightening and the US actually says, no, companies that are popping up in the UAE, shell companies, helping to sell these Iranian oil, maybe those, you do get a clamp down on that. But beyond that 700,000 barrels per day, Iran will continue to sell the oil to China because the companies just don't care about sanctions at this stage.
That's fascinating. It suggests then the U.S. might have to use some leverage if it has such on China, or offer them some other opportunity, out there. You think to Russia and so forth. Just a quick final comment on the fact, Russia did come out with this statement in support of Iran, and we see this continuing widening of this Middle East situation. What is the fact that they came out in support of Iran after the explosions tell you might really be going on behind the scenes in terms of what bigger shape this may take in the coming months?
Well, I think I wouldn't read too much into it because, Russia, again, interestingly, has always straddled this, right? They've always supported Iran on some issues, but especially given the war in Ukraine, they also don't have a lot of friends, and they have very strong allies in Saudi Arabia and UAE when it comes to at least, OPEC plus. They're a part of that, and that is just simply not going to change regardless of their support for Iran. And Russia has played this role for several years now, where they are actually supportive of kind of both. You've seen relationships with the GCC, but also politically with Iran.
And finally, Amrita, before we let you go, there's been speculation that it will be Saudi Arabia who ultimately capitulates, maybe allows for more of their barrels to come on the market, takes the lower price, but guards their market share, while others suggest they can't do so. They're running a budget deficit. They need a higher oil price for some of their, Vision 2030 goals. What's your expectation on that front?
I would just say, look, Saudi Arabia is a revenue optimizer. They will continue to look at markets and say, look, if we continue to cut production and keep the prices at a stable level, are we better off on a revenue basis rather than flooding the market and letting prices down but increasing exports? So they continue to revenue optimize. And we continue to believe that Prince Abdulaziz will keep the market stable. He has enacted additional cuts through Q1, and I don't expect them to come back overnight, even if they gradually start coming back in Q2, but they probably will get extended because the focus very much is stability in oil prices and making sure inventories don't build.
All right, I'm Rita Sen. Thanks for joining us today. We appreciate your time.
Thank you.
From Energy Aspects. Coming up, we're officially 2 years removed from the S&P 500's record close, and we've climbed nearly all the way back up. We're less than 100 points away from that level now. My next guest is looking for opportunity in the catch-up trade. He'll tell us where that is next. Plus, we've got 2 weeks worth of mortgage application data to dig through. Did the year-end drop in rates push homebuyers to take the plunge? And could we see a mini wave of refis? That's ahead. As we head to break, here's a glance at the markets. The Dow's down 130 points today. It's off the session lows, but it's still red, and the S&P 500 is down almost 0.5%. The Nasdaq, the laggard, down 0.75%. The 10-year yield briefly over 4% earlier, now at 3.927. We're back in a moment.
This is The Exchange on CNBC.
Welcome back to The Exchange. The S&P 500 is nearly on the cusp of taking out its record high from 2 years ago. But my next guest says it's time to start buying the beaten down parts of the market. Let's dive in further with David Bahnsen. He's CIO of the Bahnsen Group. David, so far the market's in your mood the last couple of days, don't you think? Welcome.
Yes, Happy New Year, Kelly. It does seem as if the start of 2024 feels more like 2022 than 23. Of course, it's only a couple of days, but obviously those big momentum names in the NASDAQ are facing a valuation wall. They're just extremely expensive, and many names can execute really, really well from here and yet already have it priced in, where I do think some of the defensives in 2023 that were still up in many cases, some of the utility names may not have been, but they weren't up that much. They didn't get overstretched. I think 24 is going to produce some of those opportunities.
So before we kind of dive into those opportunities, does that mean the Magnificent Seven, that they're not part of your portfolio? Because even though I take everybody's point about the size of the companies and the performance this year, on a 2-year basis, it's not that spectacular. And on a PE basis, some of them are, 30x. It's not, crazy.
30x would be the cheap ones. I mean, some of them are 100x and 50x. I mean, as a group, they're 55x.
Wow.
Evenly weighted among the
Isn't
seven.
that Amazon,
right?
though, largely Amazon? Because even NVIDIA's at, what, 30, Microsoft 30, Apple probably, I don't know, 20-something?
Yeah, I mean, again, some of it is if you're looking forward versus trailing, that makes a huge difference too. I think the idea with some of them is absurd that they can hold their margins and get some of the revenue growth that's projected. And so you have a lot of issues with that. But you make a great point about the 2-year view. You had such an incredible performance in 2023 for some of them. Let's take NVIDIA out. A lot of the rest of them are negative return or even returns. You recall like a group like Netflix, which isn't the Magnificent Seven, but the old FANG nomenclature. It gave back 10 years of returns in 2022 in like 6 months. Wow. I mean, these things are capable of falling very quickly.
So, and perhaps you're kind of hinting we could see that happen again. I mean, certainly the places you're looking, do you expect big gains out of them, or are they just ways to stay defensive?
No, I mean, what it is for us is a permanent philosophy of investing, Kelly. I believed it in 22 as well. Dividend growth was up about 6 or 7% when the S&P was down 20. Dividend growth was not up as much as the market in 2023, but it still had a mid-teens performance, which most people would take any year. And on a 2-year basis is beating the S&P by over 10%. And so you made a really good point before the break. We're not back to our high with the S&P. As great as 2023 was, based on 22, investors still haven't got back to that level they were 2 years ago. That's the market I think we're going to be in for years. Big years up, a few years down, but range bound. And the problem, the reason I believe that is because of valuations. You just simply cannot get the earnings growth to get double-digit returns compounded for the next 10 years with a market starting at 20 times earnings.
But see, now you're making us nervous again because for the new year, you know, we have to fund some 529s and things like that. And in the back of our mind, we're like, please let this not be the year that the market tops out for the next 5 or 10. But then, you know, you'll feel like that might always be the case.
And one of the frustrations I have is that you want to make that consideration on a rational basis, not with the Fed hanging over your shoulder. And there's been this wall of when the Fed would stop tightening. Investors dealt with that all of 23, and they felt like they got that Powell pivot at the November meeting. And I most certainly agree with consensus that you're going to see rate cuts in 23. And I don't really care if it's 100 basis points or 200 basis points. It's going to likely be somewhere in between there. But fundamentally, you just have earnings projections that are really optimistic, and you're doing that at a starting point of a high valuation. I'm a child of the late 90s, early 2000s, beginning my professional investing career. I saw incredible companies that have performed magnificently for 25 years that never got back to those levels that they were. Cisco, Intel, some of those great examples, because if people entered at too high a valuation, you just couldn't recover.
You know, this is not help. What am I going to do? Buy bond? They give you 4 options in these investment accounts. Like you can do the S&P, you can do some, you know, bond fund. There's not a lot out there. I can't go buy American Electric Power, Clorox, and Gilead like you're recommending.
Well, of course, individual portfolios like the ones we manage, this is the part where I get to talk my book. That's where you can do it. You're right. In some of these target date funds and 401ks or packaged 529s, they don't have that option. A lot of 529s do offer some form of an active, maybe a value fund.
But
I mean, that's one way to mitigate the risk is at least be value biased versus growth.
I know, but you know, the fee structure and the perform. I don't know who the fund manager is, and then I got to go look. It just feels, you know, it's nerve-wracking. But to your point, so when you put these portfolios together, you're not doing sector selection. This is all stock by stock.
Yeah, we're individual stock buyers, and it ends up with the sector allocation. I mean, you mentioned American Electric Power is one of the names I presented today. It's a utility name that we think is best of breed. Big dividend growth. It's the only utility name we own, though. I'm not trying to go get the utility sector. I'm trying to get American Electric Power, which I think fell last year because utilities were down 7%, but it's a name that belongs higher. It's underpriced and a great dividend growth.
All right, David, we'll leave it there. Thanks for the wisdom, although now you're making me nervous again, like I said, but I appreciate it very much today. It's good to see you.
Thanks, Kelly.
David Bahnsen of the Bahnsen Group. Coming up, Disney eked out a 4% gain in 2023 to narrowly avoid its longest annual losing streak in over 2 decades. But the proxy battle that loomed over the stock last year is back in the spotlight. We'll bring you the latest and what it could mean for Iger's legacy, with shares now negative since his return as CEO. The exchange is back after this.
Here.
Welcome back to The Exchange, everybody. I'm Tyler Mathisen with your CNBC News update. In the latest prisoner exchange since the war started, more than 200 Ukrainian and Russian POWs returned to their home countries today. The deal was reportedly brokered by the United Arab Emirates, which has kept close ties with Moscow since the Russian invasion began. Prisoner swaps aren't new, but have slowed recently. The last exchange happened way back in August. At least 4 state capitals complexes were evacuated because of bomb threats earlier today. The state capitals of Georgia, Kentucky, and Michigan, as well as Mississippi, were targeted, but authorities say no dangerous items were immediately found. Investigations into the threats are ongoing. It is the latest in a pattern of threats made against state capitals this week. And meet the newest breed to be recognized by the American Kennel Club. Known for its smile, yes, its smile, there it is, it's smiling right now. This Lancashire Heeler is now eligible for thousands of dog shows, including the Westminster Kennel Club show, the granddaddy of them all in the U.S. According to the Kennel Club, they're known to be, quote, courageous, happy, and affectionate. Owners say the Heelers sometimes pull back their lips into a smile when they're content, Kelly. Just like me.
Now we just need a new, Dogecoin, a crypto named after
Heeler
it.
Dogecoin.
Yeah.
That would be a dog coin, Doge. Okay, see you in a half hour.
Tyler, thanks.
Bye.
Coming up, the home builders are having their worst day since October after a historic run to end the year. The ITB Home Construction ETF down 1.5% today as mortgage rates rebound from their lows last week. After the break, we'll see whether last month's drop was enough to get buyers back into the market. And as we head to break, take a look at some of the healthcare names hitting all-time highs today. To the discussion we were just having with David Bonson, you've got Amgen, McKesson, Regeneron, and Vertex, which is now red, all hitting 52-week highs, along with the healthcare sector spider ETF, the XLV. It is less than 4% away from its record intraday high. The exchange is back after this.
CNBC.
Welcome back to the exchange. Lower mortgage rates, not enough to spark demand at the end of the year, but refis were a different story. Let's get the latest with Diana Olick. Diana, what do we find out?
Well, Kelly, the drop in mortgage rates during December seems to have had very little effect on home buyers, but a little help to current home owners. So the average rate on the 30-year fixed ended the year at 6.76%, lower than where it was 2 weeks ago, higher than where it was a week ago, but still well below that 8% high we saw in mid-October. As a result, total mortgage application volume ended the year 9.4% lower than it was 2 weeks ago, and that is seasonally adjusted. Now, because the numbers for the 2 weeks are kind of messy, I'm going to give you year-over-year comparisons. Applications to refinance a home loan ended the year 15% higher than a year ago. Applications for a mortgage to buy a home ended the year 12% lower. So those who can benefit from a refi, and there's very few of them, but those who can are clearly trying to get in while they can. Home buyers, though, are still contending with very little supply and very high and rising home prices. Now, mortgage rates started this week higher after also edging up Friday and again today. So we're now at the highest level in more than 2 weeks, still in the 6% range, but that is probably why the home builders are not so happy, Kelly.
Well, exactly. And it doesn't take much to move them one way or the other right now. Diana, stay right there. With mortgage demand lower, our next guest says it should rebound as affordability improves this year. Let's bring in Andy Walden. He's Vice President of Enterprise Research at ICE. Andy, it's good to see you again. Am I saying that correctly? You do actually expect things, affordability to get better, buying demand to pick up?
Yeah, I think gradually as we move throughout 2024, if you look at the interest rate forecast, they're for rates to come down about 0.5% throughout 2024, should give buyers about 5 to 6% more buying power and should improve demand. And I mean, it's really hard to take too much away from the couple holiday weeks there. But if you look from October, when Diana was mentioning rates got up near 8%, through the end of the year, we have seen demand rebound a little bit gradually. And roughly, if you adjust for kind of week-to-week comparisons, we're at a similar level to where we were back in May, the last time interest rates were at 6.5 to 6.75%. So borrowers very much behaving like you would expect them to behave in a mid to high 6% rate environment.
One thing I always think about, though, and maybe you have the data handy, Andy, or Diana does, but is there's so many more either cash buyers or people to whom this is not the swing factor. And again, you wonder how much that has played a role in the way the whole economy has responded to rate hikes.
Yeah, I mean, certainly you're seeing more of that. Now you're seeing cash buyers even back out a little bit, but they're certainly making up a larger share of the market just because of the compression you're seeing in mortgage demand out there. So a little bit more cash dominant world than we've been in the past, but you're seeing some compression in demand across the board.
Yeah, Diana, what would you add to that?
Well, I think it's going to be all about supply, because when you say rates are coming down a little bit, maybe 0.5 percentage point, do we get into the high fives at some point? It really depends on the supply. And will the seller, we've talked about this so much today with these mortgage numbers, will the sellers finally decide that they're willing to trade their 3% or lower rate up to a 6% lowish rate in order to get into the market and put more inventory on there? That's the only way we're going to see affordability. But Andy, I don't see that really happening unless rates came considerably lower, which that's not really in the forecast.
Yeah, and we haven't seen that last year. I think that was kind of the thought process. We moved into the 2023 home buying season. Falling rates should improve inventory and sellers' willingness to sell. We haven't seen sellers move with rates at all. You certainly see a very linear reaction from buyers. They react as you'd expect to rates. I haven't seen any signs of sellers moving with rates getting down into the 6% range last year. So maybe if we get in the fives, that changes. Maybe this year's different. We just haven't seen that actually play out in the numbers just yet.
Diana, last word.
Well, I think it's going to depend on that. I also wonder if falling rents aren't going to help a little bit, because if we see perhaps downsizing baby boomers or people who don't need to buy another home might consider selling at the top of the market and getting into a rental because rents are coming down a bit. Maybe that helps the market a tiny bit, but I'm looking for the silver lining, Kelly.
Aren't we all? Diana and Andy, thank you very much. We appreciate it today. Our Diana Olick and Andy Walden. Coming up, Bob Iger scoring a point against Tryon in the ongoing battle for Disney board seats. But with the deadline for those nominations closing tomorrow, could Nelson Peltz fire one last salvo? We'll talk about that next.
CNBC.
Welcome back to the exchange. Shares of Disney higher about 1% now, despite what's being seen as a vote of confidence for CEO Bob Iger and the board from a key activist investor. Let's get out to Julia Borson with the very latest here. Julia?
Hey, Kelly, that's right. Disney announcing an agreement with activist hedge fund ValueAct to advise it on strategy, and ValueAct will support Disney's slate of board of directors at its annual meeting. Disney CEO Bob Iger is saying, quote, ValueAct Capital has a track record of collaboration and cooperation with the companies it invests in. Now, ValueAct owns about 5 million shares in Disney. That's according to sources close to the situation. This helps Disney defend against Contrarian, which votes nearly 33 million shares, including about 25 million shares owned by former Marvel Entertainment chief Ike Perlmutter. Contrarian saying Disney's agreement with ValueAct does not change its approach to this proxy battle. Now, analyst Gordon Haskett weighing in today saying that this gives Disney an important backer and it will, quote, put this endorsement to work while it campaigns for votes ahead of its annual meeting. All of this comes after Contrarian last month nominated Peltz and former Disney CFO Jay Rizzullo to Disney's board. Back in November, Disney named 2 high-profile new board members, former Morgan Stanley CEO James Gorman, who has had experience with proxy fights as well as succession planning, as well as Sir Jeremy Darroch. He's former head of Sky Media. Now, there's another activist firm which says it supports Iger, Blackwell's, which owns just about 55,000 shares. It nominated 3 of its own directors to the company's board. Contrarian saying it, quote, welcomes other shareholders attempting to fix this iconic but wayward company. But Kelly is certainly very strategic here for Disney to align with ValueAct.
And again, I was thinking about it just as Jeff Ubben has wound down his other new firm, thinking about some of the success that they've had there in the past. Anyway, I wanted to ask you about kind of to the point about which way Disney should go. We got this data point about how Universal overtook Disney as the highest grossing studio in the box office last year, Julia. And it really does speak to the decline Disney's experienced at the box office. It was, they didn't have one of the top 3 movies for the first time in a long time, first time since 2014. None of Disney's movies crossed the $1 billion benchmark. So there are real challenges here.
Yeah, I mean, look, there have been a bunch of movies that are scheduled for this year, some big Marvel movies. So there's some expectation that the box office will be strong this year, in part because of those Disney franchise films. There are concerns about superhero fatigue, franchise fatigue in general. But I also think the question with Disney is whether audiences became accustomed to watch first-run Disney movies at home because of some of the programming decisions during the pandemic, programming decisions made by Bob Chapek, Bob Iger's predecessor. So I think the question now is really getting the content that's going to get people out to get audiences out to theaters in the same way that Barbie and Oppenheimer did this summer. Of course, Oppenheimer being one of those big Universal films that helped with its box office totals. But this is something that Bob Iger has said is a key focus of his. And he has said that this is, an area he's really going to be focused to make sure that the films are the kinds of blockbusters that they've traditionally had. Yeah. And there was also some acknowledgement of the fact that maybe some of Disney's films this year, like Marvel's, suffered because of the fact that they were being produced in part during the pandemic.
I mean, there are some out there like Barton Crockett, as you know, who still say, maybe a breakup is the way to go. So the fact that that's even, not considered implausible, I think tells us a lot about the struggles at that division, or whether it makes sense to keep it with parks and all the rest of it. In any case, they've got a lot of work cut out for them. That's for sure. We'll see what the next 24 hours bring.
I would just say, Kelly, that the movie studio has always been seen as an engine for the rest of the whole company. So the characters and franchises developed for the film slate, for the movies, are then exploited across the different platforms, not just Disney Plus, but also the theme parks. Think how intricately intertwined those businesses are. You go to the theme parks to see the characters that you saw on the big screen.
No, it's true, and it's all the more reason why they kind of have to sort out their box office woes as soon as they sort out the board woes, I guess. Julia, thank you very much. We appreciate it today. Julia Borson following that story. Coming up, shares of this small cap tech name are up 55% over the past year, and several firms see more room to run, naming it a top pick for 2024. But with the NASDAQ under pressure, are growthier names in jeopardy? We'll discuss that with an investor and a top analyst next. Welcome back. Shares of Apple are lower again today, now down more than 4% since Barclays downgraded the stock to underweight yesterday. And that's helping Microsoft edge closer to overtaking Apple's market cap for the first time in decades. You can see about 100 billion shy right now. And that bearish call also dragging down Apple's ecosystem. AMD among the hardest hit, down more than 8% over the past 2 days. Taiwan Semi down 4%. And that translated into the worst first day of the year for the NASDAQ since 2016. But our next guests both see opportunity in technology, if you know where to look. Joining me now is Nancy Tangler, CEO of Laffer Tangler Investments, and Mark Mahaney, Evercore ISI's head of internet research. Welcome to you both. I don't want to totally, well, Mark, let me start on kind of the big picture theme here, and maybe Nancy, I'll ask you both. If this is just a change in leadership, is Microsoft the new Apple? And Nancy, I'll put this to you first. For a couple years, Apple has literally kind of been the stock market. As it goes, so goes everyone else here. Is that changing now?
Well, don't underestimate Apple. I understand that growth is slowing, but one of the things I think the market is missing is that the company has announced $100 billion in share buybacks, and the Magnificent Seven alone has announced 190. Apple's 100 of that. So that puts a floor under the stock price. But that said, we took it out of our 12 best ideas portfolio about 2 years ago. We still own a small piece of it, and we do own Microsoft in our 12 best ideas portfolio. And the last thing I'll say about that is I think Mark and I both were investing during the 90s. We think this market is analogous to that market. And at that time, at the end of the decade, the four horsemen were trading at ridiculous valuations at peak earnings. For Microsoft, it was 51 times peak earnings, and it's trading at about 30 not peak earnings today. So I think there's plenty of opportunity. It's a much more robust company with a lot of levers to pull and a lot of monetization still to come in AI.
Mark, do you want to speak to that? Because this is now the second time, actually, this analogy to the 90s and 2000s has come up. But when David Bahnsen used it earlier this hour, he used it in a negative way, meaning, that he saw that as, yes, that was the peak.
Well, I think Nancy has a better memory than I do, and I'll also defer to her in terms of Microsoft and Apple. I would hope that one stock doesn't move the market. And the Magnificent Seven, yes, I would hope the market moves are broader than that. To me, the take on the Magnificent Seven was last year, after a pretty severe 18-month rout in tech and growth stocks, you had the seven highest quality tech stocks lead us out of that. Well, of course you'd want that. You want the most speculative stocks to lead us out? No, you want the highest quality, and that's what we had. Now I think we'll get into, and as we have for the last 2 or 3 months, kind of a diffusion in the stocks that outperform. So I think that creates some new opportunities. Doesn't mean some of those Magnificent Seven can't continue to work. Amazon and Meta, for example, are two of my favorite longs still for 2024. Amazon and Meta are. I think we showed Pinterest going into the break. What are your thoughts there? Well, Pinterest is our top mid-cap long, so this is part of the diffusion trade. I think Pinterest under new management, and it's been about 18 months under new management. It takes time to turn these ships. But under new management, I think it's improved tools for advertisers, things they call mobile deep links and direct links. But the return on ad spend for marketers who are working with Pinterest has been rising. The CMO of Walmart talked about a 15x increase in return on ad spend with Pinterest. And then they've got this partnership with Amazon that's really going live now. And I think that's big enough to cause that growth rate to jump up a couple of points. So I think it's a clear revenue growth acceleration story into this year with much greater cost discipline than they've had in the past. So you're going to have real nice accelerating earnings growth this year, too. It's one of the reasons why it's our top long in mid cap. All right. And Nancy, just to go back to kind of what's going on with Apple and so forth, I mean, maybe some would make the case that Apple's growth is peaking. But I don't think they make that case for Microsoft. It would be hard to, right, given everything going on with the AI cycle.
Yeah, I mean, and thank you, Mark, for saying I have a better memory instead of that I'm just a lot older than you. Yeah, I think we know the total addressable market is an estimate, but it seems like some of the numbers from Fortune Business Insight is that we're going to see 45% compounded annual growth rate in generative AI spending through 2030. If you look at cloud computing, that's not over yet either. The total addressable market there being something like $1 trillion and about 51% of all IT spend going into cloud computing. So if you step back and you say labor shortage, which we still have, we have a productivity improvement that we've seen much like we did in the 90s. I think you can draw an analogy as I did and say, look, we can coexist. Tech stocks can go up with higher interest rates as they did in the 90s. 90s, as long as we're seeing improvements in productivity. So we're going to use this weakness, as we did in the fall of 2020, to add to some of the names. We don't own all of the Magnificent Seven, like Mark suggested, but we do like names like Broadcom, which we call a poor man's NVIDIA, or Amazon is one of our top picks as well. Andy Jassy got Tim cooked when he took over. And Tim Cook, by the way, since he took over, Apple's up 1,600%. It's a free cash flow story, Amazon that is, and by 2026 they'll be generating $100 billion in free cash flow. That's after spending $50 billion on capex. So I'll be patient, and we'll be stepping in. Our other favorite name is ServiceNow, and those are all run by excellent CEOs, and we think that's critical.
And Mark, meanwhile, we have to go, but I love how you talk about the internet Mag 7. So Duolingo, Meta, Uber, Spot, Roku, Shop, Dash. Those were names that had a monster 2023 and maybe can continue to outperform. We'll leave it there. Thank you both. We appreciate it.
Thank you, Kelly.
Tech's not in turmoil after all, it seems. Nancy Tangler, Mark Mahaney with the Dow down 170 points. That does it for the exchange. We've got the Fed Minutes next. Power Lunch picks up coverage right after the break.
Welcome, everybody, to Power Lunch alongside Kelly Evans. I'm Tyler Mathisen. Glad you could join us. Stocks continuing to sell off to start the new year.
Down 174 points on the Dow right now. Take a look at the NASDAQ. Its 0.8% decline continues the stretch we started off with yesterday, which was the worst first day for the NASDAQ composite since 2016. We did see more upward pressure on rates earlier. We've backed off, but let's get to Steve Leisman for the Fed Minute, shall we?
Yes, indeed.
Kelly, thanks. And I'll cut right to the chase on these December minutes and tell you that to the extent there was a discussion about cutting rates this year, it was not a very robust, in-depth, or resolute or confident discussion. Fed officials saying that they did see the current policy rate at or near the peak in this rate hike cycle. The projections showed that most agreed a lower target range would be appropriate this year, as in 2024. But there was a high level of uncertainty around those rate projections, so uncertain, in fact, it was possible the economy could require further rate increases, the minute said, or keeping the rate unchanged longer than expected. They did agree that it was appropriate to keep policy restrictive, quote, for some time. Now, a number of participants, this is a place where they did kind of hint at rate cuts, highlighted that there were downside risks from keeping the policy rate too restrictive for too long. And some said the Fed should begin thinking about when it might communicate the possibility of winding down balance sheet runoff, but that seemed to be far into the future and very, very obscure in terms of a comment. Now, more importantly, on the issue of inflation, the risk of inflation, we're seen moving towards greater balance, and they said it was clear progress had been made on inflation, but they underscored they needed more evidence to be confident that inflation was moving back towards the 2% target. There was some optimism about it surrounding, for example, labor supply and demand coming back into balance and housing inflation coming down. The labor market remained tight, but coming into better balance. The participants saw momentum of the economy as stronger, perhaps, than currently assessed. Now, there was a bit of an upside and downside to the inflation discussion. I'll go through it, and to give you one important point here, many remarked that the easing of financial conditions could make it more difficult for the Fed to reach its goal, noting that that yields had declined pretty substantially in the lead up to that December meeting. On the downside part, there were lagged effects of policies and potential weakening of household balance sheet. Just one more thing. The staff forecast, which is pretty important in terms of the Fed making their decisions, also saw continued upside risk to inflation. Kelly, Tyler?
All right, Steve, thank you very much. Stay with us as we're going to return to you in just a moment. But meantime, our next guest says rate cuts seem like a matter of when, not if. But it might take a downturn to get to that when point. So he bought the sectors that he thinks are best for safety along with him today. Joining us is Ken Stern, Lido Advisors president. Ken, welcome. Good to have you with us. Do you still feel, based on what you just heard Steve say, that rate cuts are a matter of when, not whether?
Then sign up today and get our
I absolutely think that there has to be some rate cuts. What I worry about is what's going to happen, because the market, as we all know, is a leading indicator. And what has been hoping and driving this market is the fact that employment has been so strong, and we know that. And employment being strong has saved, I think, a lot of pain. The market rallied so high last year while rates were going higher. If we see rates starting to come down too fast, I think the market's going to spook.
And they would be coming down too fast because the market would be anticipating that the economy is in some distress, sputtering.
That's exactly right. If we start seeing, this is the time to stress test. This is the time to take a step back and say, we've got a lot going on in the world today. We have a lot going on with the consumer. We're starting to see consumer debt, coming up a little bit. We're starting to see savings rates go down. I think this is the time that we do a little bit of a stress test and a little bit of election protection here.
How do you do it? What do you do?
So instead of betting how quickly rates are going to go down, let's just say that we think the long term is positive. And with that in mind, let's do a little hedge. Let's do a little downside protection. Let's do something that's going to protect if the overall market goes down. Days like today where we're seeing volatility, why are we afraid of that? It's going to happen. Why don't we embrace that? Have the cash available. And I do think, and I think this is similar to your last guest, Kelly, I think this is a balance. Could the Magnificent Seven still rise? Yeah. But why not go into more interest rate sensitive healthcare names, financial names? Why can't we start broadening back the portfolio out?
You can. Some people are just afraid to because they don't want to underperform again or they want to stick with tech. Let me just circle back in a moment. If I can just go back to Steve Leisman on the minute. Steve, the market initially had a knee-jerk reaction to the downside. We're stabilizing somewhat here. How much should we read into this idea that maybe you can put it better than me, they weren't exactly gung-ho in the discussion, at least, about cuts. It was more in the projections?
I want to go a little off topic here.
Sure.
This all reminds me a little bit of a Bruce Springsteen line where it says, take a right at the light, go straight into the night, and then, boy, you're on your own. To the extent the market is forecasting 6 rate cuts next year, or this year, sorry, it's on its own. These minutes do not back that up, would be my personal opinion here. I think the minutes are backing up this idea that there's likely to be rate cuts this year. Those are in the projections, but that the extent to which the market has that certainty, and I did see it, by the way, in the probabilities in the last couple of minutes, back off just a touch. It's still a 70% probability of a rate cut coming in March. But that is something the market has to own on its own and cannot really point to the Fed to come to that conclusion. And it's okay. It's not wrong if Ken, for example, wants to advise his clients, hey, the Fed is going to cut rates in March and do so 6 times because my inflation forecast is X. I don't think you can go back to the text to support that conclusion.
Yeah, so the words do seem a little bit more like they're holding back. They are indicating that the sort of the peak of this cycle, Steve, has been reached, but they're not really committing, at least verbally.
No, and like I've said, Tyler, it's okay to have that conclusion, and that could be the right conclusion. There's no, the Fed doesn't have any lock on getting forecasts right, and God knows it may actually have a lock on getting them wrong sometimes. But that said, if you do this on your own recognizance, essentially. You go out there and you say, okay, I have this inflation forecast that comes down to the point, and this is the key point here, that it provides the Fed the confidence that it says in this document it needs in order to cut rates, and that's going to happen between now and the March 20th meeting.
So, Ken, you mentioned a couple of sectors that you think are well positioned for defense. Let's go back through those a little more slowly, and obviously there are big sectors. Finance is a big sector.
That's right.
There are insurance companies in there. There are big banks. There are medium-sized banks. Healthcare is vast.
That's right.
So where within those sectors?
And also what Steve said is super important. I don't think that the market necessarily needs to decide, I think rates are going down in March. I don't. And I think that things are very dynamic right now. If, for example, we start to see a slight tick up of unemployment, you're going to see all of that go out the window, and you're going to see the Fed's going to want to save this into that soft landing that everybody's hoping for. And we have an election year, and we have political risk, and we have oil prices that are in flux right now with what's happening geopolitically. So I think the idea is to plan for the volatility, to have some defense in place, to have some hedges in place, and then you're right. I think that big pharma didn't do so well last year. It looks pretty, from an absolute standpoint, it looks promising now. So this is an entry point for that. Same with regional banks. Same with brokerage firms. These types of sectors and industries, regardless of what happens with the Feds, because it's a probability game at this point. Do I think that rates are going higher? No, I really don't. Do I think rates stay the same? Maybe. Do I think rates are lower 12 months from now? Yes. Based on those two probabilities, I can overweight those sectors with a little bit more confidence, the house confidence, if you will.
If you had to guess, would you guess that the rate cuts will be backloaded this year rather than beginning sooner? In other words, later rather than sooner?
I would, but again, if you're waiting till it already happens, it already happened in the market.
Yes.
The market's a leading indicator.
Yes, the market's been saying this.
This is right. And
for 3 months now.
Yeah, that's right. And we all know a broken clock is right twice every 24 hours. So I do think backing this in right now makes a lot of sense, and just erring on the side of caution. So when we do have these big down vol days, these are days to start accumulating.
Ken Stern, thank you very much. Ken Stern of Lido Advisors. We appreciate your time today. Thank you.
With the yield on the 10-year note briefly back above 4% earlier, let's get a pulse check after the minutes with Rick Santelli out in Chicago. Rick, what do you make of it?
Well, I'll tell you, here's what I think of it. When the chairman walked out and began Q&A, he was pretty much seeding the market for aggressively pricing in eases. When he said basically, you know, guys, today's discussion was basically about easing. Now they're walking it back a bit. So what did they accomplish? In an election year, they accomplished the previous December, which was just, you know, a couple weeks ago, hitting the highest level in the Dow Jones ever on multiple occasions. They raised up the equity markets. They built in eases. We hit $34 trillion in debt today. So obviously funding costs at higher versus lower levels is quite significant between the Fed and the Treasury. I think they did a marvelous job of kind of guidance as they walk it back now. But in the end, the markets are going to get what they want if the Fed can't get the markets to change their outlook. And a whole set of other variables coming into the equation. Weakness everywhere we look. Let's look at ISM, new orders. 16th month, consecutive month under 50. All right, JOLTS, nearly a 3-year low on job creation going back to March of 21. Now let's look at an intraday of 10s. It hits 4%, then it anvils off the Empire State Building and drops in yesterday's low yields at 391.5. Makes a new one, and then it stabilizes on the minutes. We haven't closed above 4% in nearly 4 weeks, the 12th of December. And when all our guests talk about market rates moving down, they better really be more specific on the Fed versus the market, because the yield curve is the biggest trade for 2024. Every source I have thinks long-dated treasuries have a chance to hit 5% again, but they certainly don't feel that aggressive about two-year note yields. Kelly, back to you.
Rick, could you comment on the dollar, please? We saw a big increase yesterday, one of the strongest gains in some time, and then today it looks like it's continuing after the minutes.
Yeah, no, it hit 101 on a closing basis, and it held. And I do believe that the yield curve, if it comes to fruition, that long-dated yields are going to be bucking the trend of short-dated yields. It's going to make trading the dollar index a lot more dicey, because we're going to get strength on the steepening of the yield curve. We're going to get weakness on the notion that the market may be more correct on Fed eases than many think. So if I had to make a comment, I'd say that the dollar index isn't going to get trashed, but I would be pretty confident we're going to be trading a bit under 100.
Interesting. Rick, thank you. As always, we appreciate it. Rick Santelli. Coming up, the high end holding on. Luxury real estate was a bright spot in the broader housing market last year, but can that continue? We'll speak to Douglas Elliman's Noble Black about that next. Plus, the auto market starting off with some good news. December sales the strongest since 2019. Are consumers more flush, or is this just a post-COVID pickup? We'll be right back.
Protect your trades from macro headline risk with Financial Juice Pro. Now only $99 a year for our real-time service.
$85.55.
Welcome back, everybody. While sales in the broader real estate market plunged in 2023, the high-end market seemed to hold up better than expected. Let's hear more from Robert Frank. Hi, Robert.
Tyler, good to see you. Manhattan home prices rising for the first time in over a year, driven largely by the high end. Median sale prices rose 5% in the fourth quarter to $1.16 million. That's according to Douglas Elliman and Miller Samuel. The average price for a Manhattan apartment also increased to just over $2 million. The total number of sales fell due to a lack of inventory, sales volume dropping 6% in the quarter and 29% for the year. But sales above $5 million, that's kind of mid-market in Manhattan, that increased in the quarter. Most of those are wealthy buyers. They pay in a lot of cash, so they're not as reliant on mortgage rates. 2/3 of apartments in Manhattan were sold for all cash. That marked an all-time record. Meanwhile, nationwide, the ultra-high end held up fairly well in 2023. There were 34 homes sold for more than $50 million. You had 5 homes selling for over $100 million. Most of those were in Palm Beach, the Hamptons, Connecticut, the usual hot spots for the wealthy. The most expensive deal of the year was that $190 million sale of an oceanfront home in Malibu that went to Jay-Z and Beyonce. It had been listed for $295 million, so they saved $100 million.
Do we know if they paid all cash?
I would guess they did.
Yeah.
Because they can.
I just missed out on getting that.
Yeah. You bid $1 less, right?
About a couple dollars.
Next time it comes around. Yeah. Robert, stay with us. Let's get an agent's take on the state of the luxury real estate market. Noble Black is also with us. He's a real estate broker at Douglas Elliman. You've sold over $3 billion worth of property, so you know a thing or two about this space.
Let's hope.
How would you describe the market right now?
I think the market's strong. I mean, it's definitely a tale of different markets, right, depending on where you are in the city and what the product is. But overall, as you said, we've held up far better than we thought we would going into 23 with the rate hikes. And we're certainly finishing it on a very strong note.
Was 2023 in your sliver of the market in Manhattan a story of the fourth quarter being particularly strong compared with the others?
It really was. Yeah, we started very slow.
Why
and starting.
was that?
I think rates, right? I think it was rates at the beginning. We started slowing very dramatically in 22, and then into 23 that continued. There definitely was a hangover. At some point in 23, people got tired of waiting. They had other life reasons. They just had to go forward with it. So even with those high rates, they came back in. Some of the wealthy that were waiting for the market to adjust because of the high rates decided to come in. They weren't financing, but they were waiting for kind of blood in the water. So sellers started capitulating. You just had all of those things start to happen. And then finally in December, when mortgage rates started ticking down, that's when really we've seen more activity.
So in the high end, I live in the suburbs of New Jersey, okay? And in my particular town, a house comes on the market, and there are fewer and fewer of them that do, but they typically go very quickly and above asking price. When one of these high-end properties comes on the market in Manhattan, do they sell above the asking price or below it typically?
So it depends on how you're defining high end, right? Yeah. So for the true high end of Manhattan, and let's talk about maybe above 15 to 20 million, those are not typically going above the asking price. No, right. There's usually still some discount to that.
Some negotiation.
But what you are seeing is for certain true trophies, maybe something downtown in the West Village that's turnkey, those are not going above ask, but they're going at astronomical numbers, at least compared to everything else. So it's not so much that there's a bidding war driving the price higher in those instances, but they're still holding up very, very well. The bidding wars tend to be kind of below $3 million, where there's very little inventory and people are really, exasperated. They've been looking for a long time. They haven't found anything. So once they see something good, they pounce.
That's like the first-time buyer cohort in Manhattan, basically, totally. Robert.
Yeah. And what really helped the high end during 2023 was the supply of new development. And a lot of that, it seems, is kind of running out because of financing, the trouble getting financing from banks right now. There's not a lot of new development that's been started in the last year. So what will be the fuel to help 2024 if that's gone, at least for New York?
Well, the pipeline's definitely running dry. So you're right, we're not going to have that. We're running through what remains of that. There's a couple that are downtown. There's one in particular that's coming, but that's a few years away, right? So what we've had to rely on for the last few years is gone. I think as rates continue to lower, you're going to have sellers that start putting their properties on the market, right? They've been locked in great mortgage rates for however long. There's no inventory for them to go towards. So once that starts relaxing, we're going to see the market unstick. But there's not that big driving force that we've seen. I think we're going to go where we are here, kind of sideways and up a little bit, but it's going to be a better story than 23, but much continued where we were.
Is there a hot building right now or a hot address in Manhattan or a couple of them?
Depends on what you want to buy. Downtown, if somebody's looking for new development, there's one in particular that's done very well. And again, that's partly a story of a good product, and also there's not much competition for that. That's over One Highline, so that's West Side. We've done a nice few deals there. Very good developer. If you're looking uptown, there's one building that continues to just do astronomically well, and that's 220 Central Park South.
Yeah.
So very little that's available.
Even I've heard of that one.
Everyone has,
That's
right?
the Ken Griffin building, yeah.
And you heard of 15 Central Park West before that. This is the newer version of that. Both are great buildings, but if you're talking about popular and kind of it building and popular culture, that's getting crazy prices.
One quick final question. How is it being affected? A couple of years ago, the whole story was people leaving. We were just joking about Miami with this lovely scene behind us. What impact is that having, if any? Because it seems like some of these prices are still at records or activity levels are at records.
I think it's a lot of impact in the press, but the thing that's often overlooked is a lot of those people are changing their tax residency, but they're not selling their apartment, right? So those people that are moving down, in some instances, they're still coming back up. They don't actually want to be there year round. But even if they do, they still want to have a footprint in New York. They still want to come back for the cultural reasons. They want to come back for kids, for shopping, what have you. They're not giving up on an apartment in the city. They may just change their tax residency.
Very interesting. Very interesting. Thank you very much, gentlemen. Robert,
Thank you.
Appreciate it very much. Up next, a domino effect with billions of dollars on the line. Apple's big downgrade yesterday from Barclays trickling down now to the suppliers. We will break down the moves down the chain on Apple. Be right back.
CNBC.
Welcome back to Power Lunch, everybody. Shares of Apple lower once again today, down 4% in the first two trading days of the year. And when Apple falls, its suppliers take a hit too. Steve Kovac joins us now with a look at the collateral damage.
Yeah,
Steve?
big time. And look, this is really from the playbook back in 2022 when Apple sneezes and a slew of its suppliers catches that cold. So that Barclays downgrade yesterday on Apple spurred that 4% drop in shares. And the same concerns we've been talking about forever, iPhone demand, Mac and iPad demand. and lackluster services growth all on the horizon. Down another % or so today, kind of waffling around there, but also following many of Apple's important suppliers. Let me just rattle off a few examples here. Han High Precision, better known as Foxconn here in the US, they assemble Apple devices, fell a bit yesterday and today. TSMC, that's of course the chip maker for Apple devices, fell 3% yesterday and another % today. Broadcom, they make the Wi-Fi and Bluetooth chips for Apple devices, fell nearly 3% yesterday, down another 2% or so today. Qualcomm, maybe you've heard of it, they make the modems for Apple's devices, fell almost 3% and down another 2% today. You get the idea of what I'm going here. Now, these companies supply a lot more than just Apple. But the size of Apple means there's just a lot of revenue exposure for all these names. Look, we're going to get earnings from Apple here in a few weeks, and it's going to be telling about Apple and all those suppliers and more than I just named, especially commentary on the March quarter, which in that downgrade yesterday from Barclays, the analysts predict will be weaker than the street is expecting. December quarter, by the way, Apple says to expect flat,
I know this is a hard question and maybe a naive one, but as you look at the stock price declines of those suppliers, are the declines commensurate with the percentage of revenue that is traceable to Apple? Or is the stock market overdoing it?
In some cases, yes. In some cases, no. Historically, there have been some suppliers where, they get like 80% of their revenue from Apple, so you see a bigger fall there.
Right.
But my point here is it's also a signal that other consumer electronics demand is falling because there's a lot of those names.
Because Qualcomm doesn't only do business at all.
Nor does Broadcom. Qualcomm is also in every single Android, or just about every single Android phone, for example. So, it's also a signal that if people aren't buying iPhones, they're probably not buying Samsungs and those premium phones as well. So, at the same time, PC market, a lot of commentary going into this year that it's going to recover, that we finally hit rock bottom. So maybe that can benefit some of those names I just rattled off. But when Apple falls, all these names fall along with them.
And Apple has a high, by some reckonings, a high PE right now.
Yeah.
But wasn't Apple within the past week, 10 days, within dollars of an all-time high?
Yeah, just December and November, they were at that $3 trillion market cap mark again, and also, like you said, yes, all-time highs. They had all-time highs last summer, into the fall again, and here we are.
And here we are lamenting and once again wringing our hands over.
It just takes one downgrade to have these ripple effects throughout all these suppliers.
I also wonder if we are experiencing a leadership shift. Apple has been the most important stock to the market, arguably size, influence, whatever, for a long time. Is Microsoft starting to edge in there now?
That is. I am watching this every day, tick by tick, because Microsoft has the AI narrative, right? They are, at least on the software side, NVIDIA on the hardware side, the leader as far as what they're selling and so forth. Apple has nothing to show on AI. Everyone wants to see something. What does Apple have cooking when it comes to this user-facing AI? And they don't have anything yet.
To sort of back out for a second and see, the iPhone arguably was the most important product to the world for the past 10 years, right? That's why we're talking about the supplier ecosystem. But is the most important product now generative AI and the way that it affects those chip stocks and that ecosystem? I just wonder if that's going to kind of supplant.
It could be, and like so many of those chip stocks claim they're AI chips and so forth, but they're not yet. I mean, ARM is trying to make a case for itself to be an AI company, but right now what they do is not as capable as what NVIDIA or AMD can do. Look, the iPhone's not going away or going to be replaced or disrupted anytime soon. I know there was that downgrade that commentary from D.A. Davidson this morning kind of saying, where's the innovation and so forth. That story's been asked about Apple so often. It's usually wrong.
What you just said, though, is so interesting to me because a decade ago, ARM was exciting because it was an Apple supplier.
Exactly.
And now they're trying to say, no, we're a Microsoft. We're a generative AI supplier. And does that kind of capture the shift in sentiment that we're seeing?
Yeah, it's hard to tell. But look, the mobile business is going nowhere. This is still the gateway. The mobile devices still the gateway to all these technologies we're talking about. The question becomes, can Apple capitalize on that? We're going to have to wait months. If they have something, it's not going to come out till June or be announced until
In
June.
terms of a large language
In
model?
terms of an LLM or whatever kind of thing they're cooking up. We're getting these whispers that Apple's doing something there. But for now, Apple is carrying it all away, even above Google, above anyone else. And that's largely because of their partnership with OpenAI.
Microsoft, yeah.
All right, Steve, thank you.
Thanks, guys.
Appreciate it. Let's get to Courtney Reagan now for a CNBC News update. Courtney?
Hi, Kelly. Well, court officials say names of people associated in some way with late sex offender Jeffrey Epstein will be made public as soon as today. They're part of documents from a settled lawsuit involving Epstein, who took his own life in 2019 following his arrest on federal child sex trafficking charges. Some of the names in the documents have already been disclosed in the case. Minor victims listed in the documents will not be identified. A New Jersey religious leader was critically wounded in a shooting outside of his mosque today. Newark, New Jersey police say a man in all black shot the mosque's imam early this morning and then took off on foot. The motive of the attack not clear yet, but the state's attorney general issued a statement this afternoon saying there is no evidence the shooting was motivated by bias. The U.S. joined 11 other countries today to condemn attacks in the Red Sea carried out by the Iran-backed Houthi rebels in Yemen. The militant group has said it will continue to target any vessels in the area they believe support Israel, but the joint statement issued today warns the Houthis the attacks are illegal and the group will feel the consequences. Kelly, back over to you.
A pretty significant show of force there. Courtney, thanks. Still to come, peaks and valleys in the tech hub. Over the last few years, we've seen startups and big money flowing out of Silicon Valley to other parts of the country. But is the AI boom bringing it back home? We'll talk about that next. Before we go to break, let's also get a quick power check. On the plus side today is Marathon Petroleum. Mizuho out with its sector outlook, saying they're positive on the name. Those shares are up about 5%. On the downside, Enphase, along with the rest of the solar space, Enphase shedding more than 5%. That's your power check. Power Lunch will be right back.
Asset.com.
Welcome back. Where will the next trillion-dollar company be founded? Investors are increasingly looking outside Silicon Valley to cities across the U.S. with cheaper cost of living. A recent journal article highlighted the growth of new businesses in Atlanta, Georgia, and census data shows them outpacing the rest of the country, along with places like Mobile, Alabama, and New Orleans. Here to discuss in today's Tech Check is Duncan Davidson. He's co-founder and general partner at Bullpen Capital. It's good to see you, Duncan. Do you experience this where you are?
Oh, I think that story got it exactly wrong. It might have been okay a couple years ago, but now, no. Everything's coming back to Silicon Valley because of AI as you started the whole
Okay, but wait a minute.
Session.
Let me just to come to their defense for just a moment. Can both things be true? In other words, are we seeing a real boom in startup activity elsewhere across the country and also at the same time seeing AI kind of revitalizing the original Silicon Valley?
Well, you must understand, I love startup culture, and I've spent time around the whole world trying to generate startups in various communities. It's a very different question whether you can diffuse startups and whether Silicon Valley remains the center. I agree. We've seen other places like Nashville seems to be a nice spot to consider starting, but none of these places can challenge the center. And the idea that a $1 trillion company is going to emerge out of Atlanta, I just don't see it.
What about,
Seattle?
What about Seattle?
Not anymore. Now, Seattle's got hope because Microsoft, your last segment is spot on. Microsoft may be the new leader because it's so well positioned in AI as opposed to Apple. But I don't think Seattle's a place you're going to see it. Right now, all this main activity is happening down here.
Why do you not think Seattle is going to be a place that is going to see that kind of development? They've got Amazon, biggest cloud company on earth. They've got Microsoft, maybe number 2 in cloud, and they're both going to play very heavily in AI.
We have had companies up in Seattle, and they have a hard time in Seattle. They've actually, one of them moved out to Nashville. It's just too hard up there. But the center of AI work, OpenAI, which Microsoft is so close to, is down in the San Francisco area. And that's why. And this is how it always happens. Whenever a new factor production comes in, like PCs or the internet, everything centers where the core of it is. Because, well, let me ask you, have you read Elon Musk, the book about Elon Musk that just came out? Fantastic book by Walter Isaacson. Hardcore. He is an advocate. You've got to come together. You got to not be remote, but in a building, and you got to work hardcore. Yes, he's spot on about that. And that's happening in the AI world down here, not in the diffused world out there.
Let me ask it to you this way, Duncan, because one other effect we saw accelerate during the pandemic for sure was just a boom in startups, period. Now, maybe you could say, we don't know if all those are going to pan out yet, but the mix of software and remote working is, and maybe you could throw AI into the mix, I mean, maybe the software, is that inherently causing us to have more creative destruction, more startups? So yes, Atlanta gets more. Yes, Mobile, Alabama gets more. Yes, the Acela corridor gets more, you name it. That there's kind of just more of this activity in general. And maybe the business models are easier to scale these days because you can take 8 or 10 people and all of a sudden have a really interesting startup. You don't necessarily have to be in just one part of the country.
You can find great startups all over the place. I agree with that. Our own portfolio used to be about 50% San Francisco area, and then it diffused during the COVID and the lockdowns to be broader outside and not in the center, but it's coming back. I think what you want to think about is that we just came through an historic bubble. It may have been caused by the Fed keeping interest rates too low, too long, and certainly the lockdowns led to remote work. But an historic bubble always makes people think it can happen everywhere. But when the bubble's over, people recenter, and that's what we're seeing right now. We're coming back home again.
I assume you will say it was ever thus, but California has serious fiscal problems right now and major deficits, and their taxes are very, very high, and they're talking now, according to a report we had on yesterday, of instituting potentially a wealth tax. Would that in any way dampen the supremacy of San Francisco and the Valley in what we've been talking about?
There is a point at which we're going to kill the golden goose, and you may be right. We may be getting this close to it because a lot of people I know with net worth are bailing out to lower tax states. But I don't think people really believe that the current administration in California really destroy the thing. They might, but they don't really believe it's going to happen.
How would you describe, Duncan, the general state of activity in San Francisco and the vibe out there in Silicon Valley and kind of in the whole region these days? Obviously, it reached a nadir during COVID, but it sounds like you're saying, it's coming back.
Somewhat. San Francisco's a mess. I mean, the fact Gavin could clean it up for that big summit in a couple of days and let it go back downhill again, the priorities these people have are completely wrong. And so parts of the city are still a war zone, or nobody wants to go there. But there are parts that are very healthy. And when I say San Francisco, I'm really saying the whole Bay Area. This is not just the city phenomenon. It's all the way down the peninsula.
But you are seeing, and maybe you can give us an example, I don't know how active you are in, for instance, the AI space in particular these days, but are you seeing a raft of new business formation, people renting out, office space across the area? I mean, things like that?
Well, Y Combinator is a huge factor. And I think in the most recent cohort, it went from 20% AI-based to 60%. And these are all being spun into areas around the San Francisco area. So yes, we're seeing a big pickup. The data I've seen says in the last 6 months, seed and Series A deals have been twice as many in this area than anywhere else. New York's number 2, Boston's number 3, but it drops off really fast. So yes, you can actually see in the data, it's recentering here.
That's really interesting.
Fascinating. Really, really interesting stuff, Duncan. Thank you so much. We appreciate it.
Take care. It's going to be a great year this year.
Oh, Happy New Year to you, my friend. Still ahead, pedal to the metal. Auto sales ending 2023 in high gear, hitting their highest levels since 2019. We will break down where consumers bought and where they could start buying in 24. Power Lunch will be right back. We'll talk car. Welcome back, everybody. Auto sales kept revving higher into year end, with 2023 hitting the highest levels since back before the pandemic in 2019. Phil LeBeau live with the latest figures from key automakers released today. Hi, Phil.
Now only $99
Hey, Tyler,
a year.
a nice end of the year for the automakers. Almost all of them did much better than what I think a lot of people expected earlier in the year. Toyota, these are strong numbers from Toyota. For the fourth quarter, sales were up 15.4%. Hyundai up a little over 5%, GM fractionally higher. And the breakdown in terms of the types of vehicles that were sold in really all of 2023, it shows the rise of the hybrid. ICE vehicles, they continue to lose their momentum, down about now to 84%. Look at hybrids, outselling EVs in 23, up to 9% of the market. And there you see EVs at 7%. For General Motors, they end the year with 16.3% market share. That is up 0.3 of a percentage point. So it's a nice move higher in terms of overall U.S. market share. They end number one. Then you have Honda. Take a look at Honda. Their December sales were up 31.5%. Hybrid's a big part of the story at Honda, and it's also a huge part of the story at Toyota. Toyota dominates the hybrid market here in the U.S. Oh, they flexed that muscle in the December time frame, up 63%, guys. 63%. I have said it time and time and time again. Hybrids will stay hot because of the pricing. It's about 10 grand cheaper right now to buy an average hybrid compared to an average EV. Doesn't mean you can't find EVs lower priced, but the average EV sells for about $51,000, average hybrid $41,000. Do the math. People are clearly right now pivoting towards hybrids.
And the fuel economy is attractive. Phil, do you know what share of hybrids generally these days are plug-in versus the kind we think of in the classic
Oh, it's a
Prius?
small percentage.
They charge
it's a
while
small percentage.
braking.
Yeah. I would say maybe 5 to 10%. And that's, when you look at the numbers, the plug-in hybrids, there's a very few number of models are plug-in hybrids versus conventional gas-electric hybrids.
And I imagine the latter is what appeals to people who want to avoid the hassle of the plug-in and just be able to get the extra mileage.
Absolutely. Look, what Prius started way back when, it's had a rebirth in the last year. People are saying, I want better fuel economy. I want to start moving towards electric vehicles, but I'm not ready at the price point right now to go all electric. And that's going to be the key here. When you bring down the price of the electric vehicle substantially, it can't have one or two models where with incentives you go under 40,000. You've got to have a lot of them. That's when you will really see EV sales take off.
And
I agree with you. It's
range anxiety will never go away.
It's price and range anxiety. Once you get the price down and the range up and the charging infrastructure up, then EVs become a lot easier of a sell. Toyota has gone very heavily into hybrids, right?
Well, they've been there, and they realized a while ago. And look, there are some people who sit there and say, Toyota got a little bit lucky here because the market pivoted towards hybrids when they really haven't done much with electric vehicles. Call it luck, call it strategy, call it whatever you want. They realize that they are the leader. They dominate the hybrid market. And as a result, look at the sales in December, 63% increase in hybrids. People want them right now.
Yeah.
It's an amazing vindication of sticking with that strategy.
Yeah. Luck is the residue of
design or what have you. Yeah.
Preparation.
Phil, thank you.
All right. Thanks, Phil.
Coming up, can you hear me now? Verizon higher on an upgrade at KeyBank, saying wireless is set up for success in 2024. It's one of those stocks that often had a higher dividend yield than a PE. We'll trade it and other movers of the day in a 3-stock lunch right after this.
Sit.com.
All right, time for today's three-stock lunch, the speeded up edition. First up on our menu, Verizon higher on an upgraded KeyBank, saying wireless is set up favorably for 24. Jerry Castellini's in the hot seat, CIO at Castle Arc Management. What do you do with Verizon here, Jerry?
You know, Tyler, this falls in the category of a lot of the names I'm looking at right now that are basically value stocks. They're just so cheap. They're cheaper than they were when they rallied 3 years ago. This is the time when you have to look at names, given that you've taken the rate increase cycle off the table and you've got a lot of earnings estimates that are depressed. Verizon is the perfect example of this. It sells at roughly, a fraction of what it used to one day, and it really does have the ability to generate free cash. This is one of my buys here, and let the stock run. Don't take advantage of the folks that want to say, well, it's bounced from the low. Stay with it.
All right. Thank you, Jerry.
Well, Carnival is our next name, starting off the year slowly along with the rest of the cruise line stocks. It's down 11% in the past 2 days, Jerry, after it more than doubled last year. Would you get in here, or what do you think of it?
Yeah, so again, investors are trying to say to themselves, any kind of bounce off the low of a very deep cyclical business is an opportunity to exit. They're trying to argue that what we should always do is move our money back into tech when it bottoms. And they're missing the point that the economy itself is the driver of earnings power for these kinds of names. In Carnival's case, yes, they're building a lot of extra capacity. Yes, they're much more competitive environment today, but the overriding view is that the revenge travel's behind us, and we have to move along. That doesn't have to be the case. Just because people have been in a cycle of jumping on a boat, so to speak, doesn't mean they're going to stop. And I do think this is a name where you could have upside earnings surprise. And again, given how cheap it is, this would be a time that you'd really want to jump in.
Let's move on to our final name is Sunrun, pulling back to start the year after a 52% gain in December alone. Jerry, what do you say?
Yeah, I take the other side on. This is good to be lightening up here. You know, the state of California threw a brick wall at them, and there are opportunities there. The business itself is really significantly dependent on access to capital. It's not clear. There's more and more examples now of the business itself now contracting. It's contracting in Germany. It's not going to grow in California. And you have to ask yourself the question, what is the point of owning a business that is solely dependent on government subsidies and cheap capital? There are so many other places that you can put your money to work today, and you don't need to play a theme that probably has sunset in terms of some of these green energy plays.
All right.
All right, Jerry, thanks very much. Jerry Castellini, we appreciate it. Quick programming note, Sunrun CEO Mary Powell will join us for an exclusive interview right here tomorrow at 2 p.m. Eastern Time. Maybe we'll play some of Jerry's tape. Don't miss it.
Maybe. Still ahead, what's brewing at Starbucks? The new step the coffee giant is taking to eliminate waste. That and more when we return.
here.
Welcome back. 2 minutes left in the show. Several more stories to cover. Let's start with the national debt, which just hit a new record. It's now surpassed $34 trillion, according to the Treasury Department, and it comes amid the threat of another government shutdown. Congress just has weeks to agree on a new federal funding plan before the next deadline.
I can't remember what percent of GDP 34 trillion is, but it's
We're at about,
1.3.
we're nearing 100, right?
It's over. It's more than,
Yeah.
Our GDP is something in the 20
The
trillion.
real problem with that is it means every year we're running the deficit, it's going to continue to add to the debt. The debt is now making the interest service cost the biggest component.
The biggest item other than
Right.
military spending,
and
I think.
half
Maybe even
of
bigger.
the deficit. So we're trapped in this loop where the high interest costs keep increasing the deficit, which adds to the debt load and increases the deficit. And I still don't, we're going to be lucky if we muddle our way out of it.
Perpetual motion machine there. All right, let's talk about Starbucks taking further steps to reduce waste. Beginning today, the coffee chain is going to use reusable cups or accept them for use at drive-through and online app orders. It previously only accepted personal cups for in-store transactions. Drive-through and app orders account for 70% of Starbucks business. I guess you take a cup, you'll deposit it there at the drive-through lane, and in a sanitary way, they bring it into the store, fill with your drink, and away you go in your cup. And it keeps the beverage hot.
Will you be doing this?
No.
Okay.
No.
Let's get to an amazing buzzer beater in women's college basketball. Caitlin Clark of Iowa sinking a three-pointer from the logo to give her team the win. After review, let's see if this shot right here. There's the pass. There she is in the paint, and boom.
Oh, man, it sounded like the horn had sounded before she shot that.
Wow.
She is a phenomenon, though. I mean...
This is new to me, but she is apparently becoming a must-see player.
Yes.
Iowa was in the football stadium, and 55,000 people showed up to a game earlier this year, and they play Rutgers this Friday. The game is sold out. Tickets on the secondary market are going 5x face value, and last night's game was on Peacock.
Wow, look at that. Look, did she get it up? Yeah, I think it was out of her hand when the lights on the backboard went off. I say swish! Hawkeyes beat the Spartans. Thanks for watching Power Lunch.
And closing bell starts right now.
Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. This make or break hour begins with buying the dip in tech because it's happening as we speak. And we're going to ask our experts over this final stretch if now is the time to step in to some of those stocks or whether you should wait a little bit more. In the meantime, here's your scorecard with 60 minutes to go in regulation. NASDAQ is still lower. I do want to show you intraday charts, though, both Microsoft and Alphabet, because they started to see some buying around noon, and we're going to watch both of those closely here on out. There they are in the green. I also see Meta was toeing the line, too. So we're going to watch all of those over the final stretch. Elsewhere, stocks mostly lower. Energy, healthcare, a couple of bright spots, and an otherwise red day for equities. We are watching interest rates, too. The 10-year hit 4% much earlier today, then slipped back down after some economic data came in a little light. It was just about an hour ago as well when the Fed minutes showed most members agreed a lower target range would be appropriate this year. Still, obviously, a good amount of uncertainty around that. In other words, the debate over rate cuts continues for another day, another week, and probably for many months. It does take us to our talk of the tape, how to play the markets right now as the Santa Claus rally ends and investors position for whatever a new year might bring. Let's ask Josh Brown, CEO and co-founder of Ritholtz Wealth Management. He is with me here at Post 9. All right, so 2 days of red in a row. I said we had some buying of mega caps. You had to believe at some point investors are going to look at declines in those stocks and say enough's enough. Enough is enough. The best stories in the market, and those are the best plays still.
So I agree, and we talked yesterday on the half about just like why are people selling? Obviously, nothing fundamentally changed. People have massive gains in these stocks, especially if they held them through the fourth quarter. And if they did that and they were waiting for an opportunity to take the profit, I'm on the wealth management side, so I already know the way financial advisors think, the way high net worth investors think is, all right, we're going to take 10% off the table, but why would we do it in this fiscal year and owe the taxes in April? Let's push that decision a little, let's push that tax liability a little bit further out without taking significant risk. This first week of January, after a massive, very sector-specific rally in the market, makes perfect sense to see profit taking. I also think there's a lot of rebalance activity. You combine those two things on the scale of trillions of dollars, that's how you get these stocks start the year looking like they're stumbling, but really, fundamentally, their businesses are not stumbling.
Let's talk about this a little bit deeper, because Tony Pasquarello of Goldman Sachs, head of hedge fund client coverage on this program a lot, just sent a note out before we came on the air, and it plays right into that story and the question that all of you want answered, right? Because he's thinking the same thing all of us are.
Yeah.
Is mega cap tech a consensus position? Of course. Is that a problem? Not necessarily. Here's what he says, quote, a set of stocks that are very well owned and dearly valued. Okay? Now, I would argue these are the best balance sheets on planet Earth. They are generating and returning an immense amount of capital. They have the most direct leverage to the most attractive new theme. Where I come out, continuing to quote, these stocks are not cheap and they are widely held. So one should be a little choosy on adding length up here. Bigger picture, however, I'm inclined to keep my eye on the ball and would look to add on meaningful dips. Now, one day or a day and a half doesn't make a meaningful dip, obviously.
I'm with you.
However, the point is clear. These stocks went up the way they did for a reason, and they're going to remain in favor for a reason.
Look, I happen to think Alphabet and Amazon are two of the best stocks to own for this year. I don't love the valuation. Do I wish they were 10 turns cheaper on PE? Of course I do. But these are the cards in front of us, right? We don't always get to pick. I think these stocks will be very stable this year. I don't know that they'll outperform everything in the way that we saw big cap tech last year outperform everything. But I think they can work because they are two of the biggest beneficiaries of AI. This is the year that AI goes from a concept to an actual product. Microsoft's got an early lead, but I think when you look at the ownership of Anthropic, you look at Amazon now using their own chips to train large language models, you look at Alphabet's opportunity to incorporate these tools into all of their existing products for literally hundreds of millions of people on day one. These are companies that are going to benefit, and I don't think they're so expensive that we have to look past them on a valuation basis. So maybe it's not as great of a setup as it was last year. I still want to be there, but I want to be in other places too. And I think you don't have to choose. You can do both things at once. Energy got off to a great start this year. This is the third worst performing sector last year. This year it's in the lead. XLE plus 3%. There's no reason why that couldn't continue, and actually crude caught a bid today. So there are other things to do. It's not Amazon or energy, in my view. It's Amazon and energy. I think you want to look all over the world, quite frankly. There's a lot of value elsewhere.
So we see for another day that the small caps, the Russell 2000, how it's represented obviously in the markets, down 1 2/3%. Of that, Tony's looking at this too. Again, he speaks to everybody, so I pay attention to his notes when he puts them out. Here's the take. Does strength in spaces like small cap make sense given positioning and the seasonals? Yes. Is it more favorable climate for the stuff that was most under the hammer when the Fed was draining liquidity? Yes. However, I don't want to abandon ship in tech, and it's not obvious to me that the squeeze in truly low-quality exposure will persist beyond a quarter or two. As my father would quip, he says, buy cheap, get cheap.
Look, I think there was a catch-up trade. To Tony's point, there was a catch-up trade that started sometime around November. Small caps had an absolute gangbusters December. It makes sense that they did. There were a lot of people that needed to make up for everything they missed in the market. It's easy to go down in cap size as a strategy to compete with the S&P 500 seasonally in that time of year. We see it a lot. It doesn't mean it'll continue throughout the course of this year. You have to ask yourself, is there going to be earnings momentum to match stock price momentum in the first half? Again, I think it's a sector-by-sector story. It's hard for me to make the case that you're going to see more consistent growth out of the Russell 2000 than you will out of the Russell 1000, and certainly the S&P 500. I'm not sure where you can come up with that thesis. So in the absence of that fundamental momentum, he's probably right. This has probably got some weeks or some months to it, probably not a full year's worth of gas, especially compared to companies where we know the earnings consistency already is.
So the minutes of the Fed came out an hour and just about 7 minutes ago, and the market gyrated a little bit, trying to figure out what's going on. 6 cuts, which the market was pricing in, always seemed a little bit of a stretch. Don't you think? I mean, but the bottom line is that they're obviously talking about when they're going to lower the target rate. There's no big consensus on a date target. However, obviously the market seems to be taking some level of comfort in the fact that it thinks that cuts are coming, even if 6 was a little aggressive to get way over your skis on to begin with.
So thank God we don't make these kind of like macro predictions and then invest based on them, because I was very wrong on what I thought the Fed would do last year versus what they actually did. I was not expecting 75 basis point rate hikes, 4 of them consecutively, and I thought the Fed would have said on the heels of the mini banking panic that probably they had done enough and they could wait and see, but they didn't wait and see. They kept going. Now they're going to give us those hikes back. In my opinion, they didn't need to do them in the first place, but again, I don't work there. Bigger picture, I don't think that we need 6 or 7 rate cuts in order for the market to find stability. I think a better story, we get enough rate cuts where the yield curve uninverts. We're now, I think, at negative 35 basis points, 2s and 10s. If that uninverts, we don't have any kind of major issue in the labor market. I think stocks remain bid. I think they remain competitive, even with elevated money market rates. And my bigger prediction for the Fed is that we say goodbye to Jerome Powell this summer. That's a more interesting story to me than anything they might do at an FOMC meeting. That's something that I think happens, especially given where Trump is in the national polls. I don't think he wants to work for the same boss again. And for me, that's the big market moving event, if and when we get some kind of inkling that that's going to happen.
Okay, so let's bring in Steve Leisman, our senior economics reporter, who was watching the release of the minutes with all of us. So, Steve, it's good to see you again. I'm looking at a 10-year yield, which is at the lows of the session. Looks like to me 390. So we went down 10 basis points today, because it seems to me, and you can opine better than me, obviously, that the most important part that the market's hanging on is a lower target range would be appropriate later this year. Those words are important. 6, as I said to Josh, cuts always seemed a little aggressive anyway, but the idea alone that they're talking about cutting, who cares exactly when? But the fact that they're talking about it is far different than what they were talking about a year ago or a couple months ago or even a few weeks ago.
Yeah, so I'm not sure I completely agree with that assessment, Scott. And I'll get to that in a second. I want to just point out, I think Josh has his eye on the right prize, why all this matters. The guys in the financial departments on Wall Street are really focused on when and how this curve might disinvert. And that's a pretty important moment for the market this year. If you have a situation where short-term yields are lower than longer-term yields, it brings back things like floating rate notes and all kinds of things that can happen that normally happen when you have a yield curve that's in a normal position. Maybe that's a discussion for another day. I just thought it's important to point out, I really think Josh has his eye on the right prize here, why we're talking about this, because the guys I'm talking to want to know when this happens, how this happens. The steepener is the biggest trade right now, I think, or one of the bigger trades in the fixed income market. We'll come back to that in a second. I really don't think the minutes provided more information than the markets previously had, Scott, when it comes to the issue of rate cuts. The paragraph you read, it referred back to the Fed officials' projections. And to the extent that there was a discussion there about rate cuts, it was really hard to find in these minutes other than the noting of the projections. I think what happened here is the Fed did decide they were done cutting rates. They did decide last year that this year, as in the year we're in right now, would probably be a year for lowering rates, but there was no discussion of the magnitude or the timing.
I guess my overall point is that the minutes don't upset, I don't think, in any way the story that the market was telling itself, Steve. Now, I'm not talking about the number of cuts, but the mere fact that the market thinks there are going to be cuts, it's pretty confident of it. It's confident that the Fed's done hiking, and I don't feel like the minutes really threw water on any of that.
It didn't, unless you were looking in the minutes for how deep or broad or persistent the discussion was about rate cuts, because there wasn't much there. I was very much kind of doing a double take when I read it. Okay, where is this discussion? What is this discussion? It's a simple notation, really, that rates are going to come down this year because that's what's in the projections. Also, some discussion that the inflation outlook is more balanced, also very uncertain. You probably need to also mention, Scott, that in there is this notion of the possibility of rates also going higher. I do not think there's much support in there for the most bullish or most dovish standpoint of the Fed cutting 6 times. That's not to say it's wrong. It's just to say that that's not where the Fed is at. To the extent the market has this projection, they do so, I believe, on their own, with their own forecast. You can't be wrong at the end of this year and go back and say, the Fed told me 6 rate cuts beginning in March, because that's not in this document.
Do you want to comment on what Josh said about the big wild card is Jay Powell leaving before the end of 2024? I mean,
if you don't mind, Scott, I'd like to hear more about that. The Jay Powell I know will stay through the end of his term if he's physically capable, and I have no information that he is not physically capable. Looks pretty fit to me. Maybe Josh has a thesis that would be convincing.
I'll let Josh say what he was saying a few moments ago.
Let me give you the other side, and I don't know anything more. I don't know anything more than you do, and you're more well sourced than I am. Just thinking out loud as a person who has managed to literally bring about the exact right amount of disinflation needed without raising the unemployment rate 1 iota. Granted, he missed inflation. No one's going to pin a medal to him. But this is probably the absolute best case scenario ending to the inflation battle that anyone in their wildest dreams could have envisioned. Who the hell would stay after that? It's like Belichick staying after Brady left. What is possibly the way to win post this recovery that we're now having? Does he want to stick around for the next recession, or does he want to be tweeted at by Donald Trump every day during the next period of time where we need to bring rates higher? That's all I'm saying.
That's not a bad idea there, Josh. But you're talking about like a summertime inflation mic drop from the Fed chair.
Jackson Hole mic drop. Just saying, could happen. Tell me where the polls are in August. I'll tell you how likely.
Let me tell you what I think I know of Jay Powell. I think he is a proud individual. I don't think he's prideful. I don't think he stays on because of his pride. But I think he stays on through the term in order to complete the term. He's mindful of his legacy. It's why he has been so persistent about bringing inflation down and getting it back down to 2%. I don't think he walks away in the middle of a term.
All right. We'll make that the last word there. Steve, thank you. I appreciate that very much. Anastasia, what do you make of all this?
Well, I think the most important sentence that you sourced from the Fed minutes is that they are talking about rate cuts, and that was not the case. And so the markets may be interpreting the statement initially interpreted as a little bit hawkish, but I think the only reason why that's the case is because the soft landing scenario right now is priced to perfection. I mean, whether you look at yields and how much those yields retraced, whether you look at equities and how much they rallied. So I think the bar is set pretty high for the Fed to surprise positively, for the economic data to surprise positively. And Scott, that's kind of what's happening today. Job openings are lower. The Fed maybe is hinting at rate cuts, and the market is still selling off. So, back, I think, to Tony's note, you've got positioning, you've got sentiment. All of that is pretty stretched. And I think after this really strong finish to the year that we've had, we're just due for some of the give back.
You think, so we pulled some forward, but do you think that the bull case is mostly intact for stocks for this year? I mean, I mentioned Tony's. No, they have 5,100, does Goldman. And there are some forecasts that are a little bit higher than that. Yeah. Maybe a couple that are a little bit even, more aggressive. But what do you think?
Yeah. Well, I think near term, we do need to see a pullback, and we just need to see this rotation. But I do think the bull case is intact, because speaking of keeping an eye on the prize, we should keep an eye on prize knowing that the Fed is likely to cut rates. And by the way, it's not just the Federal Reserve. It's the European Central Bank that may cut rates as soon as April. It's the Bank of England. And in fact, I think it's Bank of America that's forecasting this 152 rate cuts this year. So this tidal change is pretty massive. We went from 3 years of tightening of monetary policy globally to now loosening policy this year. So I think that's really bullish for stocks. And then the other reason, Scott, why I think the bull case is intact, some people will say, well, we're bumping into the swall of 4,700 or 4,800 on the S&P because you do the math and it's 244 and you apply a multiple to it. But the reality is, as the year progresses, earnings estimates should bleed higher because the next year's earnings estimates come into the picture. So I think the bullish case is intact, and I would be looking to buy the dips across a variety of sectors.
See, Tony just says when he lays out what's the bull case for equities, Josh, he says, look, to get there, you're taking the over on 19 times as a PE, or you're taking the over on the consensus earnings estimate, to Anastasia's point, of $244, or you're taking the over on both. I mean, at this point, because we ran up so much at the end of 2023, I mean, now you gotta believe you can have it all. You can have these elevated historical multiples, and you can have earnings outpace expectations in the kind of environment that we think we're in, which is still a slowing economic environment, just not a crashing economic environment.
It's a slowing economic environment, but importantly, the input costs are slowing even faster. And this is really the key thing. You're not investing in the economy when you buy the stock market. You're investing essentially in the income and the revenue prospects of the 500 best companies on planet Earth. It's not the same thing. You wouldn't necessarily look at small businesses and say they're doing great, but it's inarguable that the 500 largest publicly traded companies are by and large doing great. Margins never took that hit. We were supposed to see mean reversion in profit margins since 2012. That's on everyone's lips every year. Here's my prediction. This is the year profit margins revert to the norm. They're not going back to 1975. I'm sorry. This is a new plateau where profit margins have been for 10 years. You could keep making that bet every year. Maybe one year you'll be right. I don't think it's going to be in 2024 if the labor market's cooling off and if we have some relative stability in commodity prices. The dollar's a wild card. Fine. I stipulate that. So if you're not betting on some sort of massive re-rating because of some sort of like earnings event or profit then why would you make the opposite bet? Like, what is the catalyst that's all of a sudden going to make people decide they don't want to be invested in these companies?
No,
I don't know what it is.
But I still have to believe that the economy is going to do well to invest in things I would think like materials, or at least think that they'd outperform. Industrials, materials, things that are more sensitive to the strength of the economy, wouldn't you?
Yeah, and by the way, some of those sectors have been outperforming, obviously, very early this year. But you see this big rotation out of tech, given how much it's rallied. But you look at financials, you look at real estate, you look at utilities, you look across the board. In fact, the thing that's really catching my attention is the S&P 500 equal weight index. It's down just barely, even though parts of the tech sector are down 2 or 3%, or in some cases 7%. And I think that goes to show that this should be the year where the investment opportunity set broadens out. And Scott, the reason why so many things could not work in 2023 is because the Fed was hiking rates, and that was hard. It was hard to carry that higher cost of leverage. But if all of a sudden the cost of leverage goes down, and maybe the lower rates do actually spur an uptick in economic activity, that's a lot of other things that can participate in that. So that equal weight portfolio, you know, if you look at the market cap rated S&P versus the equal weight, it outperformed by 13 percentage points. That's the largest since '98. I think that's due to unwind.
I want to jump on the end of your sentence, because not only do I agree with you, I want to take it a little bit further. Internationally, a lot of stocks worked overseas this year. Not many people know about it. We almost never talk about it on television. But there were some huge gains in different markets last year that not a lot of people were predicting. There's no reason to think that that couldn't continue as a theme into this year. I want you to consider the fact the All-Country World Index, ex-US, right now is trading at a 34% discount to the S&P 500. Over the last 20 years, the average discount has been 16%. I'm telling you, overseas, developed market stocks are twice as cheap as they have been over the last 2 decades. Yes, you can give me all the reasons why it's 13 times versus 19 times. Yes, there are some good reasons. Yes, geopolitics. I'll take all of that, and I'll still tell you that if we're going into a rate-cutting cycle, even if it's a modest one, these stocks can work, and you're taking less risk because starting valuation is not just a little bit cheaper. It's a multi-decade level of discount that you're getting, and you don't have to buy low quality. You could buy overseas high quality in Japan, in Europe, and you could win. That's another, I think, smart thing that people are rebalancing toward and doing for 2024.
All right, we'll leave it there. Guys, thanks so much. Appreciate that. Josh Brown, Anastasia Amoroso. A little bit of green on the board, not much, right? Microsoft, we mentioned top of the program. Alphabet as well. The VIX, too, is about 13.5. Not a big move there, but nonetheless, it is one area in positive territory today as we do head towards the close. Let's send it to Steve Kovac now for a look at the names that are moving right now. Steve?
Hey, Scott. Yeah, let's look at Xerox. Shares plunging after announcing earlier today it lay off 15% of its employees, that's about 3,000 people, as part of a broad restructuring. In addition to the layoffs, Xerox saying it'll simplify its products within the core printing business. Shares down more than 10% on that news. But pharma moving the other way, having a strong run so far in 2024. That includes Eli Lilly, which is up more than 4% today. Bank of America analysts calling it a top biopharma pick this year, thanks to optimism around Zepbound weight loss drug launch coming soon. Scott, send it back over to you.
All right, Steve Kovac, we're just getting started. Josh was just leaving. Up next, Evercore's Roger Altman is back, and he's flagging two key headwinds that could derail a strong 2024. He'll explain, break down his forecast for the Fed after this break. We are live from the New York Stock Exchange, and you're watching Closing Bell on CNBC. Welcome back. Fed officials indicating 2024 will be the year of rate cuts. It's unclear, though, when those cuts might start. That's the big message from the December Fed minutes, the meeting minutes released this afternoon. Let's bring in Evercore's Roger Altman to discuss. Nice to see you again. Happy New Year.
Hey, Scott. How are you?
I'm good, thanks. So what's your takeaway on all of this? Are the markets and the Fed, are they too far apart?
No, I don't think so. First of all, the Fed statement is exactly what you would expect the Fed to have said if you or I or anybody else like us were responsible for that statement. Because the last thing the Fed can do is cut too soon and find out that inflation actually isn't under control. So they're sending a watch and wait message, just as they should, and it should be reassuring to investors, and I think generally it is. But beyond that, look, the economic outlook is remarkably good. We're seeing stunning data. Look at the latest data on personal income, on consumer spending, on consumer confidence. Look at the inflation data. Take the last 6 months on core PCE, annualize it, 1.9%. Remarkable. None of us 6 months ago or 12 months ago would have seen the growth data that we're seeing. Atlanta Fed tracker at 2.6 right now. Goldman Sachs just coming out, I think, a couple of hours ago, estimating high twos for the whole year on real growth, together with this inflation progress. As somebody said, it's the immaculate disinflation, and it's very positive.
But I mean, the Fed doesn't sound like it's ready to cut as many times as the market is betting it will. How much does that matter?
Not enormously. For example, we at Evercore ISI project that the Fed's first cut will come in the middle of the year, June, and that there'll be 5 cuts before the end of 2024. But whether it's 5 or it's 4 or it's 6, once the Fed begins to ease, it's going to continue to ease on a smooth, steady trajectory. And so whether there are 4 cuts in 2024 and 2 in 2025, or the reverse of that, I don't think it makes a lot of difference. Once the Fed starts to ease, it's going to continue to do so.
In other words, don't fight the Fed. Rules and reign supreme.
But the Fed, look, the Fed deserves a lot of credit. Yes, as was said a few minutes ago, it misjudged inflation at the beginning, and that was a big mistake. But it is engineering so far a remarkable outcome. As Powell himself said at his press conference, we think it's going to get harder, but so far it hasn't. I think that was the quote. And you have to give them credit, because to see 1.9% inflation and 2.5% real growth this late in the recovery, they should get a straight A for that.
What about the makeup of the market right now? It's like the clock struck midnight, right, figuratively and somewhat literally. And all of a sudden, mega cap stocks started to sell off, and the market seems to be going through a bit of a reshuffle. I look at it right now as I'm asking you this question, and we're about the lows of the day. Dow's down 250, Nasdaq's down more than 1%, Russell 2000, which surged to end 2023, is down almost 2.5%. What should we make of that? What do you think about it?
I don't think we should make much of it, Scott. After all, the market had a red-hot 6-week run going through the end of 2023. And I just think the market's taking a breather, as it so often does after a run like that. It's hard to say how good the 2024 outlook will be for stocks, but my instinct is the worst that happens is neutral, and probably somewhat better than that, just because the growth and inflation outlook is so good. Now, there are 2 big risks. One is war. One is the U.S. election. Very hard to tell how investors view those risks as the year goes on, in particular, the Middle East risk, because we're awfully close to a wider war there. If you look at the events, for instance, of the past 24 hours, and that could be pretty negative. Hopefully we'll avoid it, but it's a big risk. And the election, it's going to be an ugly election, no matter how you think of it. And maybe investors will ignore it, and maybe they won't. But other than that, I think it's going to be a good year.
What do you think CEOs are thinking about in terms of those big risks that are sort of out there? One a little bit closer, obviously, with the geopolitical tensions that we've already seen bubble over the surface. In terms of the deal flow, which you care about a lot.
Well, I think the biggest thing on the minds of CEOs is that 6 months ago, 9 months ago, so many of them were concerned about the likelihood of a U.S. recession. And now that is increasingly off the table, which is obviously positive. And so I think CEO confidence today is quite a bit higher than it was 6 or 9 months ago. And that bodes well.
Roger, we'll leave it there. Again, I wish you well. We'll see you soon.
All right, Scott. Thank you.
All right, take care. Roger Altman joining us live on Closing Bell. Up next, your playback your pullback playbook, I should say. Bank of America's Chris Heisey, he's back. He'll tell us where he sees stocks heading from here, how he's navigating the uncertainty as well. Closing Bell's right back.
Gobble, gobble. I seen bigger legs on a turkey. Rude. Who are you? I'm an investor in a fund that helps advance innovative sports tech, like this smart fitness mirror. I'm also Mr. Leg Day 1989.
Anyone can become an agent of innovation with Invesco QQQ, a fund that gives you access to NASDAQ 100 innovations.
I go through a lot of pants.
Before investing, carefully read and consider fund investment objectives, risk, charges, expenses, and more in prospectus at Invesco.com.
AG1 works by making foundational nutrition easier. Combining vitamins, probiotics, and whole food source nutrients into one comprehensive formula. Start simplifying your nutrition today at drinkag1.com.
We have a garage door that doesn't lift.
So I went on Angie. It took me just a handful of minutes.
So vendors who were knowledgeable, they did higher quality work.
They wanted us to be happy with the work done as well. It is a beautiful garage, I will say.
Get started today at Angie.com.
Hi, I'm Jay Jackson. For almost 20 years, Abacus Life has been purchasing life insurance policies from seniors. And in just seconds, you can use the free calculator at abacuspays.com to learn what your policy might be worth.
For many of my clients, selling their life insurance to Abacus was right for them and their estate plan.
Don't sell or lapse your policy without going to abacuspays.com first. There are no fees and no obligations. Get the real value from your life insurance when you need it with Abacus.
What's it gonna be? All right, 60 seconds to draw the perfect gift. What's it gonna be?
A bottle of Don Julio 1942 delivered.
Delivered with Drizzly. Gifting without the guessing. Drizzly. What's it gonna be?
My parents came from Poland. I called my father to tell him I had just made a partner of Goldman. He understood the significance more than I did. And he started crying on the phone. You establish your goals and you work hard to reach those goals. That's ambition. I don't live large and I'm committed to give away all my money. Start with nothing and make a lot of money and share that success with others. I'm a capitalist with a heart.
We're back. Stocks facing some early January jitters. The major average is currently on track to snap that 9-week winning streak. But is this just a pause in the market's momentum or the start of a deeper pullback? Let's ask Chris Heisey, CIO of Maryland Bank of America Private Bank. Happy New Year.
Happy New Year, Scott. Great to be here.
So what is your outlook? Because I think you were pretty cautious through much of 23. Now we've turned the calendar. Have you turned your view?
Well, actually, no, not a big turn in view. We were so-called balanced. We were right on our strategic targets the entire time. We thought that stocks and bonds would have a reasonably good year. Obviously, bonds didn't for most of it, and then stocks ultimately took off the last two months of the year or so. We basically had a year in 2 months, as you've widely discussed. We've been balanced. What does that mean? It's fully invested. We picked our spots here or there. Sectors didn't work too well for most people, including us. But certainly being dedicated to U.S. large caps for most of the year, if not all of the year, really helped. We haven't changed our tune. I think it's really important to know that going balanced into next year with still high unpredictability is really important, but also staying fully invested, and that's the key. You know, most of the time in the markets is much better than timing the markets, and you and I have talked a lot about this over the years, and I'll say this. If you know the wedge in the markets going into a year, you have a very good, reasonable chance of not just outperforming, but staying on goal. What's the wedge last year? Inflation. We got that out of the way. What's the wedge this year? It's probably fiscal restraint, not to mention geopolitics and politics. If we can get that at bay, then you're talking about high predictability in earnings, margins, real yields declining, yields have peaked, and the Fed is telling us what they're going to do.
But I want to go back to something you just said and I think I'm reading between the lines a little bit. You said sectors didn't work too well.
Yeah.
I take that as you saying that you didn't have enough exposure to mega caps to really catch that powerful momentum that they had last year. Does that suggest, and you said your sort of playbook hasn't really changed that much. Does that suggest that you're still not well overweight those types of stocks?
Yeah, that's correct. We were basically neutral tech for most of the year. We had a little slight overweight to start the year, but as the year progressed and they had a 6-time outperformance, we maintained neutral exposure. We're still there at this point. But when I said sectors didn't really work, you didn't have the defensives working in a year where most people thought we were going to recession. You didn't have the cyclicals really working. It was bifurcated, very much so, towards tech and communication services and a little bit of consumer discretionary. But sectors are so diversified nowadays that using your normal sector rotation when you're late cycle or early cycle is now moving more towards what is the factor that's working in the market? Earnings momentum and high interest coverage. And we see that being the areas that are going to outperform again heading into 24 or
I'm
through
trying to
24.
figure, why aren't you more optimistic though, right? If we've come for a pretty long way, right, from where the Fed was to where we are now and where they are, as we learned yet again from the minutes, right? The economy looks like it's progressing towards a soft landing. I mean, obviously not there yet, but that's the bet. And the big bet is that the Fed's going to cut multiple times this year. Who knows when that begins? So if rates are going to come down and the economy is going to be pretty decent, earnings, you would figure, would be pretty good, thus justifying a reasonably good multiple. What am I missing?
Yeah, you're not missing anything. You've nailed the story. Now you got to talk about what could actually come in that we're all worried about to balance out some of that uber optimism, to bring us back to earth a little bit and become more of a realist. What's a realist? 7-8% returns in stock returns. That's good. We'll take that every year. Bond returns somewhere around what your yield to maturity is. We'll also take that. 60-40 working again. Very much take that. But balancing out by high geopolitical risk, U.S. political diversion also could be there. And then ultimately, do we really know what's going to go on with the debt maturity refinancings, particularly in commercial real estate? We don't know yet. We think it's going to be contained. But these are balancing acts and wild cards that could come and go throughout the year. But generally speaking, for the year, yeah, I would say we're optimistic.
What do I do? I'm looking squarely at the Russell because, you know, as our show has progressed here over this final stretch, the Russell's gotten uglier, right? So it was a huge winner over that stretch from November 1st till the end of the year. And now we've had a rollover. Right now it's down 2 2/3%. It's down 5% in a week, and a lot of that's happened in a couple days. Are you a believer in that broadening out trade, or did that get too far ahead of itself?
It's a tough type of dynamic to kind of dissect. I think that small caps in general, lower quality areas, when you're in this long period between late and early, and there's optimism about Fed cuts and the next expansion, you can get a lot of head fakes in the lower quality areas. And I think that's what you're getting when you saw that big move up in addition to some of the other lower quality areas. I don't think they're yet ripe for a full upgrade. I think they should be on the upgrade watch list as well. Same thing for emerging markets. Now, we don't want to try to time these things too much, but what do you need for small caps to actually have a sustainable rally? Not just a couple of months, but 6, 12, 18 months or more. You need margins to expand again. And that's quite likely in 24 because input costs are coming down and you're seeing some sticky pricing power. And if you can get that, that's where the upgrade in small caps is much more sustainable.
Oh, rate cuts aren't enough, right? Because when rates started coming down, small caps started going up.
Right. It's not enough because generally speaking, if you're cutting rates, now our belief is you're cutting rates because real yields are actually too wide, not because you're going to have an economic hard landing. But the market's going to try to feel that out, at least in our opinion. And at the initial stages of Fed cuts, usually the lower quality areas are not the ones that participate. Could be different this time, but the playbook is usually they don't participate. Same thing with emerging markets. And then after the third or so cut, you start to see that come back because now the market begins to sniff out an expansion again, perhaps later in 24 into 25.
Maybe we had a pull forward, too. Chris, take care. We'll talk to you soon. Chris Heisey, Merrill Bank of America, joining us here. Up next, we are tracking the biggest movers as we head into the close. Steve Kovac is standing by once again with that. Hey, Steve.
Yeah, Scott, rough day out there for a couple renewable energy names, and cloud security will reveal which ones when Closing Bell comes back after this.
We're less than 15 minutes from the closing bell. Let's get back to Steve Kovac now for a look at the key stocks he's watching. Steve?
Hey, Scott. Yeah, check out these renewable energy names. Shares of Solar Edge falling about 5% today, and Enphase Energy down about 7%. Big reason? Well, these are growth stocks, especially solar energy names. They're typically hurt as those treasury yields tick past 4%. Now let's move over to cybersecurity. Shares of SentinelOne down about 7% so far today, announcing it would acquire cloud security company PingSafe in a cash and stock deal. SentinelOne saying the deal will boost its offerings to provide security for cloud applications, but no valuation on the deal, Scott.
All right, Steve, appreciate that. Steve Kovac. Up next, SoFi shares, they're tumbling today. The stock's down double digits. We're going to tell you what's behind that leg lower, what it might mean for the rest of the fintech space as well. That's just ahead. Closing bell right back.
Protect your trades from macro headline risk with Financial Juice Pro. Now only $99 a year for our real-time service.
Coming up next, the big battle over Disney's board. We're going to break down all the latest activist activity and what it could mean for Disney stock over the long run. That and much more when we take you inside the market zone. right, we're now in the closing bell market zone. CNBC senior markets commentator Mike Santoli here to break down the crucial moments of this trading day. Plus, Leslie Picker on the latest activist action around Disney, and Kate Rooney on what's behind that sell-off in fintech stocks like SoFi. We'll get to that in a moment. But, Mike, we're at the lows of the day for the Dow, the 300-point loser. Russell's down 2.5%. NASDAQ's getting kind of ugly, too.
The market's treating it as pretty routine. You're not seeing a lot of distress. You're not seeing volatility blow out. And it seems a bit like just collective portfolio readjustments coming into a year when you've got a lot of things stretched. Now, it'd still be routine if the S&P went down 3% in a straight line from here. It wouldn't feel that way. So I think that's the precipice we might be on here a little bit. When does it go into a little deeper of a gut check for now? Treasury market also treating the Fed minutes as net dovish.